हेलो एवरीवन, वेलकम टू द चैनल जेवी एंड सीआईवी मेड सिंपल। दोस्तों, बीएफएम का मॉड्यूल ए जो कि सबसे महत्वपूर्ण मॉड्यूल है, सबसे ज़्यादा वेटेज यदि किसी मॉड्यूल का है तो वो मॉड्यूल ए का है। और फ्रेंड्स, इसका केस स्टडीज़ आज इस वीडियो में हम लोग जितने भी पॉसिबल केस स्टडीज़ हैं, मैक्सिमम केस स्टडीज़ को कवर करेंगे एंड दैट इज़ ऑल्सो इन इंग्लिश लैंग्वेज। फ्रेंड्स, इंग्लिश या हिंदी बैरियर नहीं होता, मेन चीज़ होता है कंसेप्चुअल क्लैरिटी। हमें ये इंश्योर करना है कि हमारा कंसेप्ट क्लियर हो, आवर कंसेप्ट शुड बी क्लियर। और फ्रेंड्स, इस पार्टिकुलर सेशन में ये लाइव रिकॉर्डेड सेशन का एक कंपाइलेशन है जो कि मैंने इसी बार के जो पिछले पैटर्न जो एग्जामिनेशन के आ रहे हैं उसी बेसिस पे मैंने इसे तैयार किया था। तो फ्रेंड्स, आपको एक एक क्वेश्चन को पहले खुद से ट्राई करना है, फिर एक्सप्लेनेशन को सुनने हैं, सबसे बेस्ट तरीका होगा। और मैंने एक क्वेश्चन से 4 या 5 कंसेप्ट समझाए हैं जो कि आपको हो सकता है कि वो क्वेश्चन ना पूछे लेकिन उससे रिलेटेड जो कंसेप्ट है वहां से सवाल आ जाए। तो चलिए दोस्तों, शुरुआत करते हैं अपने इस केस स्टडी के सफर को मॉड्यूल ए के साथ। इसी प्रकार से बीसीडी का भी सेपरेट वीडियोस आएगा। और यदि आपको इसकी पीडीएफ की रिक्वायरमेंट है तो हमारे कैप्सूल कोर्स से जुड़ जाइए, डिस्क्रिप्शन में लिंक अवेलेबल है, या मुझे पर्सनली व्हाट्सएप कर सकते हैं इस पार्टिकुलर नंबर। लेट्स स्टार्ट विद आवर फर्स्ट क्वेश्चन एंड आवर फर्स्ट क्वेश्चन यू कैन सी ऑन योर स्क्रीन that if the interbank spot USD oblique INR rate is 75.0050 oblique 75.0075 and the margin is 10 paisa, what will be the rate for inward remittance? Fine. Options are 75.0075, second option is 75.1050, third option is 74.9050 and fourth option is 75.2050. Take a moment to note the question and the option. It is very important to carefully analyze the rate and the margin. Think about what inward remittance means and what calculation might be needed. I hope you are ready with your pen, paper and calculator. So just start solving it. So let me explain this particular question. What is given here, right? So let's start with the first part of the question. The first part of the question says that what is the interbank spot buying rate mentioned in the question, right? So the first part of question is what is the interbank spot rate? So tell me, drop your answer in the chat box. I will give you 10 seconds. Can you tell me what is the interbank spot buying rate mentioned in the question? Please write in the chat box what is the interbank spot buying rate. In this particular question, what is the interbank spot buying rate? What do you think is the interbank spot buying rate? Isn't it 75.0050? So the interbank spot buying rate is what? 75.0050, right? Do you think the same? Interbank, please interact, please type in the chat box because I want to make this session interactive. You should also type whatever you think in the chat box. Okay, so the spot buying rate is 75.0050, right? I hope the whatever I'm writing on the screen is visible to you now. Now, interbank spot buying rate is 75.0050 because the bank uses the buying rate for inward remittance. You can see the word written here, inward remittance, right? Inward remittance means what? Inward remittance means money is coming to our country, right? And obviously it is a case of export. It is a case of export. That is why buying rate has to be taken. So we have to take the buying rate, and buying rate is how much? 75.0050, isn't it? Okay, now next question is, what happened to the rate when there is a margin of 10 paisa? You can see there is a margin of 10 paisa written. So do we add or subtract the margin for inward remittance? Please type in the chat box. Your participation is necessary. That what happened to the rate when there is a margin of 10 paisa? Do we add it or subtract it? Do we add or subtract the margin for inward remittance? Think about this and answer in the chat. My question is, do we add or subtract the margin for inward remittance? Okay, just minus. Other people who have joined the session, please type what do you think about margin. Yes, just correct. For inward remittance, the bank buy at lower rate, so the margin is deducted from the interbank buying rate, right? So now let's calculate step by step. So start with the buying rate. The buying rate is 75.0050. You subtract the margin of 10 paisa, right? Which will be how much? Which will be 0.10, right? The margin is 10 paisa, so it is 0.10. Now take a moment to calculate this and drop your final answer in the chat box. Tell me, what is the final answer you are getting? After this calculation, what is the final answer you are getting? Please type in the chat box. Just do the calculation and tell me which option do you think is correct. The four option has been provided to you. Option number C, correct. Very good. It is 74.9050, right? 74.9050. Awesome. Because this 75, if you subtract 0.10 from 75.0050, you will get 74.9050. So let's quickly understand why we subtracted the margin. See, let me explain you what has happened in this particular question. So in this question, as you can see, inward remittance. Inward remittance means bank is buying foreign currency. So here the keyword is inward remittance. It means that bank is buying foreign currency, right? And bank always buy at a lower rate to account for their margin or spread. Bank always buy at lower rate. Remember it. So inward, whenever you see this word inward remittance, it means bank is buying foreign currency and bank always buy at lower rate. That is why we deducted 10 paisa, right? That is why we deducted 10 paisa from the buying rate of 75.0050, arriving at 74.9050. Let me know in the chat if this explanation is clear or do you have any doubt. Please let me know in the chat that whether is it clear now, whether this explanation is clear to you. If you have any doubt, please type. Okay, fine, very good. So understanding the logic behind this calculation is key to mastering such question. Let's move on to the next question, right? Let's move on to the next question. So this is the explanation part. Question number 2, as you can see it here. So question number 2, let's move to our next question. This one is similar to the previous one, but it focus on outward remittance, right? But it focus on outward remittance. Here is the question. If the interbank spot USD versus INR rate is 75.0050 oblique 75.0075 and the margin is 10 paisa, what will be the rate for outward remittance? Your options are 75.0075, 75.1050, 74.9050, 75.1075. Take a moment to note the question and the option. Think about what happened when we talk about outward remittance and how the margin come into the play. I am providing you 30 seconds to solve the question. I hope participants are able to see whatever I am writing on the screen, right? If you are unable to see whatever I am writing, please type in the chat box. Yes, very good. It is visible. Very good. Okay, so one answer I am getting is option number D. Let me explain. Okay, let me check whether your answer is wrong, correct or incorrect. So let's start with a simple question. So in this particular question, let's start with that what is the interbank selling rate mentioned in the question? Drop your answer in the chat box. Let us solve step by step. What is the interbank selling rate mentioned in the question? You have got 10 seconds to just type your answer. What is the interbank selling rate mentioned in the question? So please tell that what is the interbank selling rate? Whether it is 75.0050 or 75.0075. Please, I request you to type whatever you think is correct. No issue, because it is a live session. So your interaction is the most important thing that is required here. Right? Yes, correct. 75.0075. Yes, excellent. This interbank selling rate is 75.0075. This rate is used because here the keyword written is outward remittance. The keyword is outward remittance, right? And the outward and for outward remittance, the bank sell foreign currency. Outward remittance, what does the bank do? Bank sell foreign currency, right? So for outward remittance, do we add or subtract the margin? Think carefully or answer in the chat. For outward remittance, do we add or subtract the margin? Please think carefully and type your answer in the chat box. So one answer I have got, add the margin. That's right. For outward remittance, banks sell at the higher rate, so we add the margin to the interbank selling rate. Right. Now let's calculate step by step. So as you can see, start with the selling rate. We will start with the selling rate. What is selling rate here? As you can see it here. So selling rate is 75.0075, and we add margin of 10 paisa, which is 0.10. So you do the addition and take a moment to calculate this and share your answer in the chat. Let's see who is quick with their math. Please share your answer in the chat. What do you think is the you will get after addition? Yes, one answer I am getting is option D by Jess. That is 75.1075 you are saying. Yes, correct. Very good. Awesome. So it is 75.1075. The correct calculation is option number D. So let's recap why we added the margin. So here the keyword, as you can see, is the outward remittance, right? So outward remittance means what? Outward remittance means bank is selling the foreign currency, right? Outward remittance means what? Bank is selling the foreign currency. Okay, so banks sell at slightly higher rate. The banks sell at slightly higher rate. Obviously, you, as suppose you are in the place of bank, you will also sell at the higher rate. So banks sell at slightly higher rate to account for their margin. That is why we added 10 paisa here, right? That is why we added 10 paisa here, and this will gives us option number D is the correct answer. Very good. So let me know if the explanation is clear. If you are unsure about any step, feel free to ask in the chat. If you are unsure about any step, if it is clear, please write clear in the chat box that yes, explanation is clear. Then we will move to the next question. So let us keep the momentum going and let's move to the next question. I hope it is clear to everyone now. Yes, very good. It is clear. Now let's see the next question. Question number 3 on your screen. So this is question number 3. We are increasing the level one by one, bit by bit we are increasing. So now let's move to our next question. Pay close attention as this one involve inflow and margin adjustment. So the question says that if USD 1 lakh is received as an inflow by TT for credit to an exporter account, and USD versus INR market rate is 76.09/76.11, what rate will the bank used to quote to the customer assuming a margin deduction. Your option are 76.11 minus margin, 76.09 plus margin, 76.09 minus margin, 76.11 plus margin. Take a moment to think about it. The key here is to understand whether the bank is buying or selling USD and the how margin come into play. So I hope you have understood this particular question. So let us start breaking this down. The first question I am asking you, that is the bank buying or selling US dollar in this case? Type your answer in the chat. Let us solve it step by step. So what do you think? Is the bank buying or selling US dollar in this case? You have 10 seconds to think whether bank is buying or selling US dollar. Yes, answer is buying. Okay, what other member think? What bank is doing? Please write whatever you think, buying, selling, whatever you think. Okay, because what I am providing you is how you should think, how to solve such type of problem, your methodology to think. That is what I am explaining. So is the bank buying or selling USD in this case? Well done, Jazz. Well done. The bank is buying US dollar because the customer, the exporter, is bringing in foreign currency. You can see it's clearly written that customer is bringing in foreign currency. Inflow. You can see clearly written inflow word here. So the customer is bringing in foreign currency, right? Customer here is an exporter. He is bringing in foreign currency. That is why bank is buying US dollar, and the bank credit INR to their account. Keep this in mind. It is a buying transaction. The first thing you have to keep in mind that whether it is buying or selling. See, whenever you have a doubt, please type in the chat box that yes, I have not understood this thing. That in this particular case, the bank is buying US dollar because the customer who is the exporter, he is bringing in foreign currency, and the bank credit INR to their account, right? So it is a buying transaction. Now, since the bank is buying, which rate will they use? Whether it is 76.09 or whether it is 76.11? Share your answer. Which rate will bank use? 76.09 or 76.11? Please share your answer. Whether it is 76.09, yes, 76.09, correct, Vamsi, very good. It is 76.09. The bank will use 76.09, which is the lower rate, as this is the market buying rate for the bank. Very good. Now here is the next question. When the bank calculates the rate for the customer, what will happen to the margin? Is it added or subtracted? Take a moment to think and answer in the chat whether the margin will be added or margin will be subtracted. Take a moment to think about it and answer in the chat. What do you think? Absolutely, Jazz, correct. The margin is subtracted in this case. Why? The reason being that the bank always deduct a margin while buying foreign currency to cover its cost and ensure a profit, right? तो बैंक यहाँ पे खरीद रही है, बैंक यहाँ पे ट्रांजेक्शन में बेसिकली ये बाइंग ट्रांजेक्शन है, राइट? तो बैंक चाहेगी ना कि हमेशा मुझे कम दाम पे खरीदें, इसीलिए हम मार्जिन को यहाँ सब्ट्रैक्ट करेंगे. मार्जिन विल बी सब्ट्रैक्टेड बिकॉज बैंक ऑलवेज डिडक्ट margin while buying foreign currency. Now let's put it all together. Whatever we have seen till now, let's put it all together. Just wait a minute, let me erase it. Okay, so let's put it all together. So let's start with the buying rate first. So what is the buying rate? So buying rate is 76.09. Okay, and subtract the margin from this rate to arrive at the rate quoted to the customer, right? So as you can see, What is the margin? Margin here is not assume a margin deduction. You can see it written here. So what will be the correct answer? What will be the correct answer? Tell me. Tell me your option. What do you think is the option A, B, C, D? What do you think is correct? Now it is quite easy to understand. Whether A, B, C or D, what do you think is correct? Take 10 seconds to calculate and share your final answer in the chat. Yes, Jess, very good. Absolutely. Great work. The correct answer is option number C, 76.09 minus margin, which matches option number C. So let's recap why this is the correct answer. So the bank is purchasing US dollar from the customer, right? Let's recap the important point which we have just seen in this particular question. See, whatever learning is very important. What we are learning from this particular question, that this bank, this is the customer, and this bank is this is the bank. This bank is purchasing. This bank is purchasing dollar from the customer, and this customer is an exporter. He is an exporter, right? To credit INR to this account, and this bank will credit INR to its account, right? In such case, bank uses the market buying rate, which is 76.09 in this particular case, and the margin is then deducted to determine the final rate quoted to the customer, which ensures bank profitability. So the rate becomes 76.09 minus margin, which is why the correct answer is option number C. Let me know in the chat if you found this explanation clear or if you have any doubt. If it is clear, please write clear in the chat box so that we can move to the next question. So we have now covered 3 key example of margin adjustment. Keep participating actively and let's move on to the next question. I hope this explanation is clear to everyone. Very good, Govind. Okay, so let's keep the momentum going and let's move on to our, all right, let's dive to the next question. Let's see what next question is all about. So this is the explanation part, as you can see. So this is our next question. This one is bit detailed, so stay with me and we will break it down together. The question is, what is the bill buying rate for an export bill of US dollar 5 lakh drawn 120 days from the shipment day if the following condition apply? Spot USD per INR rate is 75.14/15. Premium for 120 days is 45 paisa. Exchange margin is 0.15%. And here are your options: 75.14, 75.0270, 75.4770, and 75.15. Take a moment to think and try solving this. Remember to consider all the conditions provided. I hope you are able to understand what the question is asking to you. So now first let's break it down. So the question involve an export bill. As you can clearly see written here, the question involve an export bill, right? Is the bank buying or selling US dollar in this case? Type your answer in the chat box. Is the bank buying or selling US dollar in this case? What do you think? Bank is buying dollar or selling dollar? Just type buy or sell, whatever you think is correct. Okay, Jess, answer is C. Okay, fine. Okay, let's move step by step and we will see whether your answer is correct. So tell me whether bank is buying or selling the US dollar in this case. So as you can see, okay, so Jess, you are saying that bank is buying. Yes, correct. That's correct. Bank is buying US dollar because that it is processing an export bill. Remember, this is the key thing to remember. Other member are requested also to type whatever you think is correct, because bank is buying dollar. It is processing the export bill, and for buying we use the lower spot rate, right? So the lower spot rate here is 75.14, right? So for buying we will use this 75.14. Now that we know that bank use 75.14, here is the next step. The exchange margin is 0.15%. The exchange margin is 0.15%. So do we add or deduct this margin for a bill buying transaction? Tell me. The next question is, the exchange margin is how much? 0.15%. Do we add or deduct this margin for a bill buying transaction? Think carefully and type your answer. Exchange margin, as you can see, is 0.15%, right? So we have to add the margin or we have to deduct the margin for a bill buying transaction. What do you think? Whether margin is to be added or it is to be subtracted? Yes, correct. It has to be subtracted, right? It has to be subtracted. It has to be subtracted because the margin is deducted when the bank is buying. This is to account for bank operating cost. Fine. Now, how much is 0.15% of 75.14? Can you calculate how much is 0.15 percentage of 75.14? Take a moment to calculate this. It is simple mathematics but very important. Share your answer in the chat. So 0.15% of 75.14 is nothing but 0.0015 multiplied by 75.14, right? Isn't it? Yeah, Jazz is answering 0.11271. Very good, correct. Yeah, so it is, you are answering 0.11271. Very good, correct. If you calculate 0.0, if you multiply it, you will get 0.1127, right? So we deduct this 0.1127 from the spot rate, right? We deduct this 0.1127 from this spot rate, right? So now let's move forward. After deducting the margin, what is the new rate? Please tell. I request everyone to interact. Whatever you think is correct, please type in the chat box. After deducting the margin, we know we have to deduct the margin. We have to deduct the margin from the 75.14. After deducting the margin, what is the rate? What is the new rate? Please share your answer. Take 10 seconds and share your answer. Just deduct the margin, that is 0.1127 from the 75.14. After deducting, what you will get? So you will get, I'm just doing it here, 75.14 minus 0.1127. So it will give you how much? Any answer from your side? Okay, so fine. So after deduction, you will get 75.0273. So let's round it to 75.0270. Almost done. The last step is to account for the premium for 120 days. You can see written here. Premium is how much? 120 days, right? So what is the premium for 120 days? The premium for 120 days is 45 paisa, right? Should we add or subtract the premium for a bill buying transaction? Please type in the chat box. Think and answer. Should we add or subtract the premium? Please type in the chat box. Yes, Jazz is answering add. Yes, absolutely correct. We will add the premium because it represents the forward rate adjustment. Very good. We will add the premium because it represents the forward rate adjustment. Let's finalize the calculation first. So let's finalize our calculation. So just wait a minute. I'm just erasing it. So let's finalize our calculation. So what is our final calculation? Our final calculation is 75.02 0270 plus 0.45. You know, margin is 45 paisa, so we will add 0.45. This will give us 75.4770, right? So this is the bill buying rate. This is the bill buying rate for this transaction is 75.4770, which matches option number C. So Jess, what was your answer? What was your answer earlier? So, your answer option number C, right? Very good, Jess. Yeah, so this shows that you have your conceptual clarity. Very good, nice to see. Now, so let me explain. Here is a quick recap of this particular question. So first of all, you need to identify the transaction type. Remember, there is a way to solve such type of problem, right? The first thing you need to do is to identify the transaction type, right? Which type of transaction it is. So you need to identify the transaction type. So I have here the bank is buying. Here the bank is buying USD, right? And now we will use the lower spot rate, which is 75.14 in this case. Deduct the exchange margin. Exchange margin is 0.15% of 75.14, which is how much? 0.11227, which results in, after deducting, you will get 75.0270. And then you add the forward premium. What is the forward premium here? We will add the forward premium, which is 0.45. So after addition, this will give us 75.4770, right? Understanding this step by step ensure you can solve similar question with ease. Let me know if you have any doubt, and we will move to the next question. Let me know if you have any doubt. If you have understood this particular question, please write clear in the comment section. Is it clear now, this particular question? How to identify each and every aspect of this question? I hope it is clear, right? Just type clear in the chat box, and if you have any doubt, please type. Okay. Now let's move forward to the next question. Very good, Govind. Clear. Now, so this is the explanation part. Now let's move to the next question. So the next question is, this question involves calculation of amount payable to the exporter for an export bill. This question will test your ability to apply concept like interest calculation, commission, and exchange rate. The question is, what is the amount payable to the exporter for an export bill of USD 5 lakh? Data is the same as we have seen in the earlier question. Bill buying rate is 75.4770. Interest for 120 days is 8.50%. Commission on the bill purchase is 0.0625%. And spot rate convention is 365 days in India, right? And option has been given like this. You can see the first option is 3 crore 77 lakh 38,500, 3 crore 66 lakh 60,303. Option C is 3 crore 78 lakhs 93,110, and option D is 3 crore 74 lakh 23,500. So take a minute to think and try solving this. Okay, fine. So now let's start. First, let's calculate the basic amount in INR based on the bill buying rate. How do we calculate the basic amount in INR? Is it US dollar multiplied by the bill buying rate, or do we divide the USD amount? My question is, how do we calculate the basic amount in Indian rupees? Whether USD is to be multiplied by bill buying rate or USD is divided by the bill buying rate? Tell me. This is your bill buying rate and this is your US dollar. So whether you have to multiply these two to calculate INR or whether you have to divide these two. Please type what you think is correct. Multiplication or division. So it is quite clear this bill buying rate is given 75.4770. It means that $1 is equal to 74.4770 rupees, isn't it? So tell me whether we have to multiply it or we have to divide it. No answer I am getting. Tell me, what do you think is correct? Multiplication or division? Yes, we have to multiply it. We have to multiply it. Very good, very good. We have to multiply it. So let's calculate it. So USD 5 lakh, I think 5 lakh is equal to, it has to be multiplied with 75.4770. So it will give you how much? 3 crore 77 lakh 38,500. You just calculate it. Now we need to calculate the interest for 120 days, right? Now we need to calculate the interest for 120 days. Now you tell me that the interest rate is given 8.50%, right? Interest rate is how much? As you can see, interest rate is 8.50%. We are using the 365 day convention. How do we calculate the interest for 120 days? Think and type your approach. How will you calculate the interest for 120 days? Tell me, how will you calculate interest? You have to calculate the interest for 120 days. How will you calculate it? So you know the formula for interest rate? Principal into rate into time divided by 365, isn't it? So you know the formula, interest is equal to P into R into T divided by 365. You know this formula? I hope you have your calculator and calculator with you. So please calculate. Please calculate. Please put down the value and just calculate. So let me also calculate it here. I am just erasing this part. Okay, and I will calculate here. So just put down the value. So this will give you 3 crore 77 lakh 38,500 multiplied by 8 point. Okay, wait a minute. So I'm just calculating it here only. Okay, so let me calculate here. So it will give you how much? 377,38500 multiplied by 8.50% multiplied by 120 divided by 365. So this will be how much? This will be, if you calculate, this will be how much? Have you calculated it? Please type in the chat box. What answer are you getting after calculation? Okay, I think so let me write down the answer. Let me write down what value I am getting. After calculation, I am getting 10 lakh 54,610. Tell me whether you are also getting the same value. 10 lakh 54,610. You are also getting the same value. I hope you have calculated with you. I do have, and I am calculating using the calculator only. So I think you will also get the same value, 10 lakh 54,610. Right. Next, we calculate the commission. So what we have calculated just now is the interest. This is the interest part. Next, we calculate the commission. Right. Commission on the bill purchase. Okay, what is the commission on the bill purchase? As you can see clearly, commission on the bill purchase is 0.0625%. Right. Now we calculate the commission on the bill purchase. So now tell me, should we add or subtract this commission from the basic amount? Think and share your answer. See, whatever I'm asking you, please answer, because you have to think this way in your examination, right? BFM is a conceptual subject, and this type of subject, you can attain good marks in this subject only when you interact, when you type your answer in the comment section. So please tell whether this commission is to be subtracted or this has to be added from the basic amount. What do you think? Commission is deducted or added? The correct is commission is deducted. Commission is deducted because it is a charge for processing the bill. Commission is basically the charge, right, for processing the bill. So it will be deducted. It will be deducted, right? So let's calculate. Let's calculate what is the value of commission. The value of commission is how much? Let us calculate it here. Just wait a minute. Let me erase it. Yes. So what is the value? What is the value of this commission? So this is nothing but 3 crore 77 lakh 38,500 multiplied by 0.0625%, isn't it? So this is the commission, right? So tell me the value of commission what you are getting. Just calculate this value. 3 crore 77 lakh 38,500 multiplied by 0.0625%. So what value are you getting? Am I audible to you? Please type. I'm not getting any response from your side. Whether everything is clear, whatever I'm speaking and whatever I'm sharing on the screen. So you just calculate, you just multiply this with 0.0625 percentage, and this will give you 23,587. After calculation, you will get 23,587. Now let's determine the final amount payable to the exporter. What is the final amount payable to the exporter? Okay, fine. Okay, fine. Okay. Now Jess has replied yes. Very good. ओके, देखते हैं क्या सही आंसर है. ठीक है, स्टेप बाय स्टेप सॉल्व करते हैं. तो अभी हमने कमीशन निकाल लिया. वी हैव जस्ट कैलकुलेटेड द कमीशन, वी हैव जस्ट कैलकुलेटेड द इंटरेस्ट, एंड नाउ लेट्स डू द फाइनल कैलकुलेशन हियर. लेट्स डू द फाइनल कैलकुलेशन. So first of all, start with the basic amount, right? So first of all, start with the basic amount here. So what is the basic amount? 3 crore 77 lakh 38,500, right? Deduct the interest, subtract the interest, which is 10 lakh 54,610, and then we deduct the commission. Deduct the commission, which is 23,587, right? So what is the final amount? Just do the calculation. What final amount are you getting? Just do this calculation using calculator. 3 crore 77 lakh 38,500 minus okay, Govda has answered option number B. Option number B. Very good. Correct. Very good. After you do this calculation, you do this calculation, you will get 3 crore 66 lakh 60,303. Right. So this is the correct answer. Correct answer is option number B. So let's recap once more whatever we have done. So I'm just recapping you. In this particular question, we have to calculate first the basic amount. First, you have to calculate the basic amount in INR, in Indian rupees. How? By multiplying the USD rate by the bill buying rate, and then we deduct the interest for 120 days. We have calculated the interest using the formula P into R into T upon 100, and then we deduct this interest, right? And then we deduct the commission, and we subtract both interest and the commission to get the final amount payable. So this step-by-step method ensure you never miss anything. So are you ready for the next question? इंटरेस्ट को सब्ट्रैक्ट करना है, इंटरेस्ट को सब माइनस नहीं करना है, राइट? इंटरेस्ट को सब्ट्रैक्ट करना है. अमाउंट पेबल टू, अब ये बताइए, बैंक ना पैसा दे रही है. देखिए, इंटरेस्ट कौन लेगा? बैंक लेगी ना. तो ये जो इंटरेस्ट है वो ये जो समझिए, ऐसा समझिए कि इंटरेस्ट ये बैंक जो है कस्टमर को पैसा दे रही है. बैंक इज पेइंग टू द कस्टमर, सो इंटरेस्ट विल बी सब्ट्रैक्टेड ऑब्वियसली, राइट? इट इज नॉट बी एडेड. यहाँ पे आप शायद गलती कर रहे हो, इंटरेस्ट को हमें सब्ट्रैक्ट करना है, राइट? तब फाइनल अमाउंट जो है बैंक देगी एक्सपोर्टर को. ठीक है, इंटरेस्ट को सब्ट्रैक्ट करके फाइनल अमाउंट बैंक कस्टमर को देगी. इंटरेस्ट को हमें ऐड नहीं करना है. इज इट क्लियर नाउ? रेडी फॉर द नेक्स्ट क्वेश्चन? लेट मी नो इफ यू हैव एनी डाउट. आगे बढ़ते हैं. ठीक है, आई होप दिस एक्सप्लेनेशन इज क्लियर टू यू. So now let's see the next question. So this is the explanation part, and now this is the next question that we have. So the question is, everyone, let's solve an interesting question about forex rate. This is something that is directly related to the import bill payment. अभी तक हमने export bill का देखा, अब हम import bill को देखेंगे, right? So import bill payment से related एक question है. So let's see that what is the GBP versus INR rate for a customer retiring an import bill of GBP 1 lakh given the following detail. The detail you can see, margin is 0.20%, GBP per USD is 1.2175/85, USD per INR is 75.4770/4870. Options are 91.9809, 92.1650, 91.7970, and 92.440. Right. So take some moment. I'm providing you 20 seconds to think about this particular question. यहाँ पे आप एक वर्ड देखेंगे, रिटायरिंग एन इम्पोर्ट बिल. आप बता सकते हैं रिटायरिंग का क्या मतलब होता है? व्हाट इज द मीनिंग ऑफ दिस टर्म रिटायरिंग एन इम्पोर्ट बिल? कैन यू टेल मी? Retiring an import bill, what does it mean? What do you mean when I say that I'm retiring an import bill? See, जब भी आप whenever you see this word, retiring an import bill means paying off the amount. Okay, Jess, very good, very good, clear, very good. Okay, so retiring means what? We are paying the amount, right? Retiring means what? We are paying off the amount due for imported goods or service, right? When a business in India import goods from another country, they usually need to pay the supplier in their currency. The supplier send a document which we call as import bill, which shows how much needs to be paid. Then Indian business then retires the bill by arranging the payment, usually through their bank, right? So this is called retiring. So don't confuse with this word. Retiring is simple to understand. So in this case, customer is paying or customer is retiring an import bill of 1 lakh Great Britain pound, right? And they need to calculate how much Indian rupees they will need to convert to GBP for this payment. So friends, now let's calculate this step by step. So let me explain some key terms here. So as you can see, some key terms are GBP per USD. You can see written here GBP per USD. What it means? It means the price of 1 GBP in USD, US dollar. Similarly, USD per INR, it is the price of 1 US dollar in INR, right? And finally, there is some margin. Now, tell me, what is the rate at which we can buy Great Britain pound? My question is, what is the rate at which we can buy Great Britain pound? Take a moment and let me know in the chat. What is the rate at which we will buy Great Britain pound? So this is the concept question regarding the cross rate, application of cross rate, right? किस रेट पे ग्रेट ब्रिटेन पाउंड को खरीदा जाएगा? Whether it is 1.2175 or 1.2185. देखिए क्वेश्चन में क्या हो रहा है, मैं थोड़ा समझा दूं. क्वेश्चन में ये हो रहा है कि आप कुछ सामान यूके से खरीद रहे हैं, राइट? यूके से यानी लंदन से खरीद रहे हैं और आपको ग्रेट ब्रिटेन पाउंड चाहिए उसको पेमेंट करने के लिए, लेकिन आपके पास है इंडियन रुपीस, बट यू हैव इंडियन रुपीस. तो आपको फिगर आउट करना है कितना आईएनआर आपको चाहिए ताकि आपको जीबीपी मिल जाए. तो आपको जीबीपी खरीदना है ना, तो जीबीपी खरीदना है तो कौन सा रेट आप यूज करेंगे? 1.2175 और 1.2185. Okay, so one answer I'm getting is 1.2175. मीन्स आप कह रहे हैं कि लोअर रेट पे खरीदेंगे 1.2175. ओके, you are telling that we will buy at the lower rate which is 1.2175. other people, what do you think? आपको क्या लगता है 1.2175 होना चाहिए या 1.2185 होना चाहिए? प्लीज आंसर. यहाँ पे जो दोस्तों, यहाँ पे एक बात समझिए, यहाँ पे जो रेट पे हम बाय करेंगे दैट विल बी 1.2185 नॉट 1.2175, राइट? व्हाई? बिकॉज द हायर रेट, बिकॉज वी आर बाइंग जीबीपी, राइट? प्लीज ट्राई टू अंडरस्टैंड. बैंक के पर्सपेक्टिव, बैंक जब सोचती है तो बैंक यहाँ पे आप है, यू आर कस्टमर, राइट? कस्टमर रिटायरिंग एन इंपोर्ट बिल. फ्रॉम बैंक पर्सपेक्टिव we have to take the higher rate 1.2185. ये केस देखिए, बैंक जब भी परचेज करती है या बेचती है तो वो वहां पे अपना प्रॉफिट देखती है, बट हियर फ्रॉम कस्टमर पॉइंट ऑफ व्यू वी हैव टू टेक द हायर रेट बिकॉज वी आर बाइंग द जीबीपी, सो हियर वी विल टेक 1.2185. Now what is the rate at which we can buy USD? Now come to this particular USD per INR. What is the rate at which we can buy USD? किस रेट पे हम लोग USD बाय करेंगे? Whether it is 75.4770 or 75.4870. देखिए जैस, यहाँ पे आप कस्टमर के पॉइंट ऑफ व्यू से सोचेंगे. फॉर अ कस्टमर रिटायरिंग एन इंपोर्ट बिल, क्लियरली रिटर्न इन द क्वेश्चन. यस यस, बाइंग लो सेल हाई कंसेप्ट क्लियर, वो बिल्कुल वही होता है, लेकिन यहाँ बैंक पॉइंट ऑफ व्यू से नहीं है. देखिए यहाँ पे कस्टमर पॉइंट ऑफ व्यू से हम सोच रहे हैं, तो जस्ट अपोजिट होगा उसका. Here we are not taking bank into consideration. Whenever we take bank into consideration तो हमारा वो लॉजिक लागू होगा. बैंक हमेशा प्रॉफिट देखती है, वो कम दाम पे खरीदेगी, ज्यादा दाम पे बेचेगी. But here we are thinking from customer point of view, right? So it will be opposite of what you are thinking. So now in this case, first thing we have to buy GBP. So we will use 1.2185. Now similarly for USD per INR, we will take 75.4870, not 70, right? So higher rate here because we are buying USD. Okay. So now there is some crucial calculation. What do you get if you multiply 1.2185? If you multiply 1.2185 with 75.4870, tell me what is the value you will get if you multiply both of them? Why I am multiplying? Because you have to find the GBP per INR. You have to find the GBP per INR, right? So GBP per INR is nothing but GBP per USD multiplied by USD per INR. That is why we are multiplying, right? So what is the answer you will get after multiplication of these two? हाँ, जो भी क्वेश्चन है बुक का ही है, आपकी बुक में ही, मैकुलन बुक में ही दिया हुआ है क्वेश्चन, राइट? So after multiplying, what you are getting, please tell. After multiplying these two, what you will get? You will get, please type, you will get 91.9809. So this is the interbank Great Britain pound versus INR rate. Interbank, the rate between two banks. Now we need to take margin into account. So we need to add margin of 0.20%. Tell me whether margin is to be added or subtracted. Margin is to be added or subtracted. What is to be done? The hint is given in the question itself. क्वेश्चन में ही हिंट दिया हुआ है. मार्जिन को हमें ऐड करना है या सब्ट्रैक्ट करना है, बताइए. क्वेश्चन को आप ध्यान से पढ़िए तो यहाँ साफ साफ लिखा हुआ इंपोर्ट बिल, राइट? इंपोर्ट बिल का मीनिंग होता है कि सेलिंग वाला केस हो रहा है. और आप याद रखेंगे इंपोर्ट बिल यानी सेलिंग, और सेलिंग में मार्जिन को क्या करते हैं हम लोग? व्हाट वी डू टू मार्जिन इन सेलिंग? यस, करेक्ट जैस, वेरी गुड. मार्जिन इज टू बी एडेड, वेरी गुड. सो वी हैव टू ऐड द मार्जिन, राइट? सो मार्जिन हैज टू बी एडेड. नाउ प्लीज टेल मी व्हाट इज, हाउ मच इज 0.20% of 91.9809? Please tell me how much is 0.20% of 91.9809? Please calculate it. My question is, how much is 0.20% of 91.9809? Please calculate. Have you calculated? So I hope everyone have calculated. So the value you will get is 0.1839. And I again request that whenever you join my live session, please have pen, paper and calculator, three things with you. Otherwise this session is of no use, because let's make it interactive. You will see such type of question in the examination. You have to make your concept clear, right? Now, so this is our margin, and what we'll do to the margin, we will add it to 91.9809, right? हम लोग इसको 91.9809 में ऐड करेंगे, right? So 91.9809 plus 0.1839, how much we will get? We will get 92.1648. इसको यदि हम राउंड ऑफ करेंगे तो हमें मिलेगा 92.1650. So the final answer, that is GBP per INR applicable for the import bill, is 92.1650, and the correct answer is option number B. Yes, Jess, very good, very good. Option number B is correct. Is this question clear to you? How was that? Did you find this calculation straightforward? Let us move to the next question with even more fun challenges. Is this concept clear? See, whatever question we are discussing in the live, okay, fine, I'm explaining it again. Okay, no issue, I'm explaining it again. See, what is happening here in this particular question, what is happening, that imagine you are buying something from the UK and you need Great Britain pound to pay for it, but you have Indian rupees. To figure out how much Indian rupees you need to get the GBP, that is what we are going to do. So first thing is that, what is the rate at which we can buy GBP? We have to find the rate at which we can buy the Great Britain pound. So that particular rate is, you have to think opposite of the bank, right? So that particular rate is 1.2185. So 1.2185 is the rate at which we can buy GBP, Great Britain pound. A higher rate we are taking because we are buying GBP. Similarly, what is the rate at which we can buy US dollar? Again, we will take 75.4870. Also, it is higher rate because we are buying US dollar. Now comes the crucial calculation. What do you get if you multiply both of these? Why we are multiplying? It's quite clear that GBP per INR is equal to GBP per USD multiplied by USD by INR. So if you multiply these two, you will get 91.9809, which is the interbank GBP per INR rate. You know, interbank, when one bank send money to other bank, this is the rate we will use. But here you have to apply the margin, which is given 0.20%. So you have to calculate what is 0.20% of 91.9809. So this will give you 0.1839, right? And since this is import bill, so import bill means we are selling. Remember, जब भी export bill रहे buying वाला केस होगा, जब भी import bill रहे selling वाला केस होगा. Whenever import bill is there, it will be selling case, and in the selling case we always add margin. In the buying case we always subtract margin. So this margin has to be added. So 91.9809 plus 0.1839, the final rate you will get is 92.1648, which you will round off. The answer will be 92.1650. Now is it clear? Okay, customer is an importer or exporter. See, I have told you earlier that in this case you are buying something, you are buying some material from the UK, right? Because this is an import, you are retiring an import bill. You are retiring an import bill, right? मैंने आपको पहले बताया था रिटायरिंग का मतलब क्या होता है, कि जब आप गुड्स इंपोर्ट करते हैं दूसरे कंट्री से, तो आपको जो है सप्लायर को उसके करेंसी में पे करना होता है. और सप्लायर का करेंसी क्या है? ग्रेट ब्रिटेन पाउंड करेंसी है, राइट? सप्लायर का करेंसी है ग्रेट ब्रिटेन पाउंड, तो आपको जीबीपी में उसे पेमेंट करना है, राइट? और सप्लायर आपको एक डॉक्यूमेंट देता है जिसको हम लोग इंपोर्ट बिल बोलते हैं, कितना पेमेंट करना है. तो आप बिल को रिटायर कर रहे हैं. कैसे रिटायर कर रहे हैं? पेमेंट अरेंज कर रहे हैं. अपने बैंक से ही तो अरेंज करेंगे पेमेंट को. तो देखिए यहाँ पे व्हाट इज, आप जैस आपको लग रहा होगा कि उल्टा क्यों हो रहा है, क्योंकि आप कस्टमर पॉइंट ऑफ व्यू से सोच रहे हैं. अभी तक जितने क्वेश्चन हमने डील किया वहां बैंक पॉइंट ऑफ व्यू से हमने सोचा है, इसलिए वहां पे बाय लो सेल हाई का कंसेप्ट लगता है. हियर वी आर थिंकिंग फ्रॉम द कस्टमर पॉइंट ऑफ व्यू, दैट इज व्हाई द थिंग्स इन रिवर्स. Okay, so I will share this PDF, and this video will also be available in this particular course. This video will also be available in the recorded session, so you can watch this video again. No need to I will share the PDF also. Now I hope this concept is clear. Let's move to the next question. So now try this question. So this is an interesting question about forex rate. So the question is what is the forward rate? This one is about calculating the forward rate for an export bill. Don't worry if you are new to this, I will break it down step by step and keep it simple. So be ready to think and share your answer in the chat. What is the forward rate to be quoted for an export bill of USD 1,50,000 to be realized in December if Spot USD per INR rate is 75.45/50. Forward premium has been given October 18-19 paisa, November 30-32 paisa, December 41-43 paisa. Margin is 0.05 paisa per USD. Options are 75.75, 75.80, 75.70, 75.45. So I hope the question, you are able to see the question clearly. Friend, just I want to ask you one thing, that when you open our app, whether the link of this live class is displayed on your homepage, whether it is displayed on the homepage of the app. How, please tell you, are you facing any issue to join the live class? Whether it is displayed on the homepage or how do you join? Please let me know. So let's understand for this question what this question is talking about. So let's start with the spot rate. What is the spot rate given? 75.45 oblique 75.50. So these represent the rate at which bank are buying and selling the dollar. And now the question is written export bill. This is the one of the greater hint. It is an export bill. So tell me, for an export bill, the bank is buying dollar from you. So which rate should we pick? The lower rate or the higher rate? The question is, see, आपका thinking process कैसा होना चाहिए? What should be your thinking process? That is what I am telling you, right? So it is an export bill. Export bill means what? Bank is buying USD from you. Bank is buying dollar from you, right? So which rate should we pick? The lower rate, that is 75.45, or the higher rate, that is 75.50? Please type your answer in the chat. Okay, 75.45. Very good. Very good, Jazz. Very good, Gopda. Very good. 75.45. Okay. So the bank used the lower rate, that is 75.45, because they are buying US dollar. So we will start with 75.45. Okay. Now, next we need to look at the forward premium for December. You can see realized in December clearly written. Now, what will be the, look at the premium given in the question for October, for November, for December they have given. So which one should we use? Right? Which one should we use? The lower number, that is 41 paisa, or the higher number, that is 43 paisa? Please let me know. Which one should we use? The lower number or the higher number? Because clearly written, we need to add, since it is premium, right? You can easily see it is premium, right? So we need to add the premium. We know it very well. So which one should we use? 41 paisa or 43 paisa? Think and let me know. ओके, 0.30 लेना है. अच्छा, आप नवंबर का बोल रहे हैं? अच्छा, जैस आप कह रहे हैं कि नवंबर का लेंगे. ओके, टू बी रियलाइज इन दिसंबर. देखिए जैस, इसमें पॉइंट वाइज यदि आप कहें तो नवंबर का ले सकते हैं हम, बिकॉज दैट विल बी बेनिफिशियल फ्रॉम बैंक पॉइंट ऑफ व्यू, बिकॉज इट इज लोअर, राइट. लेकिन यहाँ पे क्वेश्चन में साफ साफ लिखा हुआ है दिसंबर में रियलाइज होगा, राइट. सो नो नीड टू टेक नवंबर है, दिसंबर ही लेना है आपको, राइट. यहाँ पे आपको दिसंबर ही लेना है. सो आप ये बताइए कि कौन सा रेट लेंगे, 41 पैसा लेंगे या 43 पैसा लेंगे? प्लीज टेल मी which is to be taken, lower number or higher number? So we take the lower premium, right? We will take the lower premium. I request you, whatever you think, please type in the chat box, right? हाँ, आपको जो भी सही लग रहा है प्लीज आप सही लिखें चैट बॉट में, इंटरेक्शन बढ़ाइए, क्योंकि अल्टीमेटली आपको एग्जाम में इसी तरह का क्वेश्चन फेस करेंगे आप. तो आपका थिंकिंग प्रोसेस कैसा होना चाहिए वो हम लोग क्लियर कर रहे हैं, राइट. तो हम लोग लोअर नंबर लेंगे, दैट इज 0.41. 41 पैसा वी विल टेक बिकॉज इट इज फॉर एन एक्सपोर्ट बिल, राइट. सो नाउ लेट्स कैलकुलेट. You just add 0.41 to it, so you will get 75.86. Now the next step is to adjust the forward margin. So margin, margin. What is the margin? 0.05 paisa per USD. Now tell me whether margin is to be deducted or margin is to be added. Please write in the chat box plus or minus. Margin को क्या करना है, जोड़ना है या घटाना है? Whether margin is to be added or deducted, please tell. I hope we have done similar question earlier. You can easily answer, right? So margin is to be subtracted, right? Margin को क्या करना है, घटाना है, क्योंकि export transaction है, buying transaction है, right? So margin has to be subtracted. So bank will deduct 0.05 paisa, right? So after deduction, how much you will get? You will get 75.81, right? अच्छा, तो ये आप देखिए 75.81 आ रहा है कब, जब हम दिसंबर का ले रहे हैं, राइट? अच्छा, अब एक काम कीजिए, अब आप नवंबर का लेके देखिए. नाउ यू टेक द नवंबर, दैट इज 30 पैसा. जो आप जैसा आप बोल रहे थे 30 पैसा, आप वो लेकर देखिए, ठीक है? सी, यहाँ पे मैं एक कंसेप्ट समझाने का प्रयास कर रहा हूं, वो समझिए. 75 पॉइंट, ट्राई टू अंडरस्टैंड. यू टेक 75.45, ओके. यू टेक नवंबर मार्जिन, नवंबर प्रीमियम, that is 0.30, right? This you will get 75.75, okay. And then you subtract the margin, which is 0.05, you will get 75.70. Now you look at these two rate. Please look at these two rate. Please tell which rate should bank opt. कौन सा रेट बैंक ऑप्ट करेगी, 75.70 या 75.81? प्लीज टेल. बैंक के लिए कौन सा रेट बेनिफिशियल है? 75.70 बेनिफिशियल है या 75.81 बेनिफिशियल है? प्लीज टेल. ऑब्वियसली बैंक बाय कर रही है ना, तो बैंक को कौन सा रेट बेनिफिशियल होगा? 75.70 और 75.81. So you will, suppose you are buying something, you will always try to buy at the lower cost, right? So for bank, this 75.70 is beneficial. That is why we take November premium, not December premium. देखिए, इस क्वेश्चन में मैं जानबूझकर दिसंबर का आपको शो किया हूं, ताकि आपको ये समझ में आए कि क्यों हम नवंबर का लेंगे. Why not we take December? Because it has to be realized in December only. But why we are taking November premium? The reason being that यदि आप नवंबर का लेते हैं तो आपको जो बाइंग रेट मिल रहा है वो कम मिल रहा है. आप सोचिए, आप बैंक है, आपके सामने दो रेट दिया गया, एक ये रेट है लेफ्ट साइड, एक राइट साइड, तो आप किसे ऑप्ट करेंगे? आप लेफ्ट वाले को ऑप्ट करेंगे ना, राइट? यू विल बी ऑप्ट 75.70. इज इट क्लियर नाउ? Okay, it was an interesting twist, right? So the forward rate for the export bill is 75.70 and option number C is the correct one. देखिए, ऑप्शन 75.80 भी लिखा हुआ है. यदि आप दिसंबर का लेंगे तो ऑप्शन नंबर बी पे आप क्लिक करेंगे और आपका आंसर गलत हो जाएगा, और फिर आप बोलेंगे कि मैंने तो सही बनाया था एग्जाम में, फिर गलत क्यों हो गया? क्योंकि आपको कंसेप्ट नहीं क्लियर था, इसी कारण गलत हुआ है, राइट? इज इट क्लियर? मान लीजिए इसी क्वेश्चन में एक्सपोर्ट बिल की जगह इंपोर्ट बिल होता और दिसंबर में रियलाइज करना होता, तब आप कौन सा रेट लेते? Suppose in this question, instead of export bill, import bill would have been there and it has to be realized in December, then which rate would you would have taken? तो चूंकि इंपोर्ट बिल है तो वहां पे हमारा सेलिंग ट्रांजैक्शन होता है, वहां पे फॉरवर्ड सेल होता है, राइट? इन दैट केस यू वुड हैव टेकन हायर रेट, right? Because you are selling something and you always sell at the higher rate. That is the basic concept. So in that case you would have taken 43 paisa. Is this question clear to everyone? Can we move to the next question? I think next will be the last question of this session. So if there is any doubt, please type in the chat box. I will again explain. See, explanation is given in this particular PDF. I will share this PDF in your group, right? So just look at this particular question. Yes, I will provide the question. No issue. Do not worry about that. Okay. Why not consider October? Very good, Kalyan. Very nice question. Why not consider October? See, October, यदि हम October consider करते तो if we have considered October, then it had been the greatest beneficial for the bank. But remember one thing, यदि हमारा बिल दिसंबर में रियलाइज होगा, if our bill will realize in December, then either we can take November or December. No, we can't take October, right? We can't take October. Either we can take November or December. So this is the basic thing. We can't take October. Suppose our bill will realize in November, then we can take either October or November. We can't take December, right? So if our bill is realizing in December, we can take October. Sorry, we can take November. We can't take October. Is it clear? मतलब आप वो महीना ले सकते हैं या उसका प्रीसीडिंग एक महीना ले सकते हैं, ठीक है? यस 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 यस, हम लोगों ने पहले डिस्कशन किया था, इससे पहले वाले सेशन में हमने डिस्कस किया था इस चीज को. ओके फाइन, चलिए अगले क्वेश्चन पे आते हैं. नेक्स्ट क्वेश्चन है, आई थिंक दिस इज द लास्ट क्वेश्चन ऑफ टुडे सेशन, सो प्लीज ट्राई टू आंसर दिस पार्टिकुलर क्वेश्चन. The question is, what is the forward rate to be quoted for a forward contract of USD 1 lakh for retirement of an import bill due on 15 September given the following. Spot USD per INR is given 75.27/29. Forward premium for June, July and August has been given. August to 15 September is given forward premium. Margin is 0.20% on the spot rate. And options are 75.70, 75.75, 75.85, 75.29. You can see how much closer the option are. आप थोड़ा सा भी गलती करेंगे तो आप गलत ऑप्शन टिक कर सकते हैं, इसीलिए इसको सावधानी से सॉल्व करें. उम्मीद करता हूं आप लोग पेन पेपर और कैलकुलेटर लेकर बैठे होंगे, तो प्लीज ट्राई टू सॉल्व ऑन योर ओन फर्स्ट. So first let's talk about the spot rate. Okay, so let's move step by step. First let's talk about the spot rate. So spot rate here is how much? 75.27/75.29, right? So these rates represent the bank buying and selling price for US dollar. Now here is a question for you. Since this is an import bill, आप क्वेश्चन को ध्यान से पढ़िए. अभी हमने रिटायरमेंट वाला केस एक बात किया था, रिटायरमेंट ऑफ इंपोर्ट बिल. रिटायरमेंट का मतलब होता है कि आप जो है इंपोर्ट बिल को रिटायर कर रहे हैं, उसका पेमेंट कर रहे हैं. यू आर अरेंजिंग फॉर द पेमेंट ऑफ दैट पार्टिकुलर बिल. सो here it is import bill. Since this is an import bill, so which rate would you take, right? So this is an import bill, means bank will sell USD to you. Bank will sell USD to you because this is an import bill. So which rate would you take? The lower rate 75.27 or the higher rate 75.29? Please answer it. Which rate would you take? 75.27 or 75.29? Yes, higher rate. Very good. So you will take 75.29, right? Exactly. For import transaction, bank uses the higher rate as they are selling USD to you. So you start with 75.29. Now step number 2. Now you can see forward premium is given. Add the forward premium. Look at the premium given for August and August to 15 September. You can see premium is given for August and August to, this is for August and this is from August to 15 September, right? So here is a question for you. Which premium should we pick? The lower value 32 or 6 or the higher value 34 and 7? Think carefully and share your answer. Which premium should we pick? So these are the steps you should follow, that which premium should we pick? 34, 32, 6 or 34 and 7? Please answer. Let's make this session interactive, because this is the main focus, main purpose of this live session, that you should interact. You should know how should we go about solving a particular question. हमें कैसे अप्रोच रखना चाहिए क्वेश्चन को सॉल्व करने के लिए. What should be our thought process? That is the main point which we are covering in this particular session. So what do you think? Either we take 32/6 or 34/7. So since this is import transaction, we add the higher premium. Remember, import bill means we are selling, and for selling we take the higher premium. So which are 34 paisa, you can see 34 paisa plus 7, 34 paisa for August and 7 paisa for August to 15 September. So after you add 34 plus 7, you will get 41. So just convert it into 41 paisa. Just convert it into rupees, you will get 0.41 rupees. 41 पैसा को यदि आप रुपीज में कन्वर्ट करेंगे तो क्या मिलेगा आपको? 0.41 पैसा मिलेगा, isn't it? चलिए, तो ये आपको 0.41 पैसा मिलेगा. नाउ यू विल ऐड टू द स्पॉट रेट. सो आफ्टर एडिशन यू विल गेट 0.41, you will get 75.70, right? Now then we need to include the margin. Margin is how much? 0.20%. Now here is a question for you, right? Whether we will add the margin or subtract the margin, please tell me. You have to calculate 0.20 percentage of this 75.70, whether margin is to be added or is to be subtracted. Already we have covered so many questions. I think this is a cakewalk for you to answer this. Whether margin is to be added or subtracted. Answer is C. Okay, yes. Let me see what is the correct answer. Answer is C. So margin is to be added. Very good. Margin is to be added, right? Because it is an import bill. Margin is to be added. And what is 0.20% of 75.70? Please tell what is 0.20% of 75.70? Actually, one thing I want to tell you that here we don't take 75.70. Instead, we take 75.29. Right? We have to calculate 0.20 percentage of this, not 0.20 percentage of 75.70. Right? So 0.20 percentage of 75.29. What you will get? So you will get 75.29 multiplied by 0.002. So how much would it be? Yes, स्पॉट रेट से लेना है, बिल्कुल सही. स्पॉट रेट का 0.20% लेना है, राइट? तो हमें we will take 0.20% of spot rate. Spot rate is how much? 75.29, right? So यहाँ पे आप 75.29 का 0.002 परसेंटेज निकालेंगे, 0.2% निकालेंगे, तो आपको मिलेगा approximately you will get 0.15. Please calculate it. You will get 0.15, right? तो आपको कितना मिलेगा? 0.15 मिलेगा, राइट? अब क्या करेंगे आप? इसको आप ऐड कर देंगे प्रीवियस रेट में, जो हमें रेट मिला था उसमें ऐड कर देंगे. 75.70 प्लस 0.15, राइट? तो कितना मिलेगा आपको? 75.85 you will get, right? So what will be the answer? Option number C will be the answer. Yes, absolutely correct. So the forward rate is 75.85. So the key here is understanding when to use a spot rate, the forward premium, and then how to calculate the margin, right? So was this question clear? Is this question clear? क्या ये क्वेश्चन क्लियर है आपको कि कैसे हमें आंसर 75.85 मिला? I hope it is clear. Everyone you have understand. So we have more question, but time does not allow us to share this question at this particular time. So we will cover all the remaining question in the next session, and I will share this particular PDF in the group. Right. There is a Telegram group. I know. Yes, there is a Telegram group. I will share this question. So whether you are able to see the link of this particular session on your homepage of the app, whether the link of this live session is available on the homepage of the app. Or you get any notification regarding the live session? Okay, fine. Okay, fine. I will share the question bank. Yes, okay, fine. I will share this particular question says it in the Telegram group. Fine. So let's in this session here. Hopefully this session was useful to you. If you have any feedback, please drop in the chat box. What this table tells you, that you can see in this particular table that on the row side you will see these are the currencies like US dollar, Saudi Riyal, INR, and these are the years. These are the time period: 3 month, 6 month, 12 month, and interest rate has been given. For USD 3 month, you can see it is 1.5%. For USD 6 month, 2%. For USD 12 month, 2.25%. Similarly, for Saudi Riyal, three rates has been given, and similarly for INR, three rates have been given. I request you to take a screenshot of it because you will require it during the calculation, right? Okay, fine. So now let's begin with the first question of this related to this particular case study. Let's see the first question that we have. The first question is, what will be the 6 month USD forward rate if the spot dollar is 73.75? So you take the data of 6 month USD, you take this data, right? Let me also take a sniping of this particular thing. Okay. Yes. So you can see USD question is, what will be the 6 month USD forward rate if the spot dollar is 73.75? Right. Take a moment to read it carefully and type your guess in the chat. I want everyone to participate. Whatever you think is correct, just type in the chat box. While you think about the answer, let me explain what the question is asking. It is about calculating forward rate using interest rate for USD and INR. It is about calculating forward rate, right? You have to calculate the forward rate. Let me again show you the particular chart, because you will use this particular chart to solve this particular question. Okay, now I hope you have gone through this particular question. Now let's break it down step by step. First, a quick question for all of you. What is the 6 month interest rate for USD and INR in the table provided? Please tell. Such type of case study is asked in the examination. What is the 6 month interest rate for USD and INR? Type your answer. First of all, tell me, what is the 6 month interest rate for USD? What is the 6 month interest rate for US dollar? What do you think? So it is 2%, right? It is 2%. And what is 12 month interest rate? What is 6 month interest rate for INR? Please see in this table. It is clear that what is the interest rate for 6 month interest rate for Indian rupees? It is 6%, right? Right, Dinesh. I think you are able to hear to my voice, right? Is it six? So you can see easily. Yes, 2% and 6%. Very good. Yes, correct. Okay, okay, fine. Okay. So great. Now let's see. Let's move forward. So you know the interest rate is 2% and 6%. Okay. Now, what is the next question? What is the spot exchange rate for USD in the question? Just see what is the spot exchange rate for the USD. The spot exchange rate given is how much? 73.75, right? Right. The spot rate is 73.75 for 1 USD. So let me write it down. USD is equal to 2%, and for INR it is 6% interest rate. Just let me know whether you are able to see the thing I am writing on the screen. I am writing the answer on the screen. Is it visible to you? If it is visible, type yes, clear. Okay. Now let's move forward. You see the spot rate in INR. The spot rate is INR 1 USD. I can write it like 73.75 rupees. Right. This is 1 USD. Okay. Now let's calculate the forward rate step by step in simple terms. Yes, okay, clear, very good. So let's calculate the we have to calculate the forward rate, and we have been provided the spot rate, right? So how to calculate the forward rate? First, we assume that we are dealing with $100. First, what we assume? We assume that we are dealing with $100, right? So, so if you multiply it by 100, you have to do it both the side. So after multiplying it by 100, you will get what? 100 USD, and this will be equal to how much? 7375 INR, isn't it? Next, we calculate interest rate for both the currency. Right, so now let's calculate interest rate for both the currency. How do we do it? So interest rate for both the currency for 6 months, because clearly written 6 month USD. So can you calculate what will be the interest rate for USD 6 month? Suppose I invest this particular amount, right? So what will be the interest rate for USD for 6 month? So how to calculate the interest rate for USD for 6 month? It is nothing but 100. Please calculate. You know the formula for interest rate, right? P into R into T upon 100. Yes, I will. Let me see. Just wait a minute. Okay, okay, fine. Okay, so I hope. Let me again rephrase this particular question. You have been asked to calculate 6 month USD forward rate, right? I think few people are joining. Few people are messaging me to join. Just wait a minute. I'm also joining those people. Okay. Yes. So let's calculate the interest rate. Yes, let's calculate the interest rate for USD for 6 months. How to calculate the interest rate? The formula is quite simple. P into R into T upon 100. Right. I think you all are familiar with this particular formula. So for USD, this is if you calculate the interest rate. So P is how much? 100. What is the rate? Rate already we have seen. The rate is how much? 2%, as you can see. For US dollar 6 month, the rate is 2%. Remember, this question was asked in 2022 BFM examination. This was 5 marks case study, right? So for USD, the rate of interest is 2%. This is for 6 months. So 2 by 100. So our in R will be 2 by 100. So P into R into T. Now T what I take? What we will take? We will take 6 by 12, because you know this is 6 month and we have to convert it into year. That's why we will divide it by 12. So this will be 6 divided by 12, right? So please calculate how much you are getting. This will be equal to 1. If you calculate the interest rate for US dollar, this will be equal to 1. Similarly, calculate the interest rate for Indian rupees. If we calculate the Indian interest rate for Indian rupees, what will that be? So what is the amount? Amount is 7375 P into R. What is the rate of interest? What is the rate of interest for INR for 6 months forward? You can see it clearly. It is 6%, right? As per this chart, it is 6%. So P into R into T. So you just write R 6% into T. What is time period? Time period is 6 months. So into 6 by 12. Can you type what are you getting in the chat? Please type what is the interest you are getting in the chat. I hope you have pen paper and calculator with you, right? So just type what you are getting in the chat box. Okay, so Dinesh has answered 221.25. Exactly. Very good. Very good, Dinesh. Yes, the answer is 221.25. Very good. This will be equal to 221.25. Right? Okay. So let me erase this thing. I hope this is clear now. Till this now, some people have joined late. Okay. So let me again rephrase this particular question for them, so that they can also understand what the question is all about. See, this question is about this particular table has been provided to you. In this table you will see currency and time period, right? Currency, you can see US dollar, Saudi Riyal, INR, and the corresponding interest rate has been provided. So this question is related to arbitrage. You might have heard arbitrage in the BFM unit 1. So I request you to take a screenshot of this particular slide, because we will use it this particular slide in the all the question, all the 5 question. I hope you have taken the screenshot. Now this was the first question asked, that what will be the 6-month USD forward rate if the spot dollar is 73.75. So it means that a spot rate is given 73.75. We have multiplied both side by 100 so that it become easier for us to calculate. So after multiplication, we get 100 USD is equal to 7375 INR. Now this is a spot rate. We have calculated the interest rate for 6 months, right? For USD, we have got rupees 1, and for INR, we have got 221.25, right? Is everything clear till now? Please type okay, yes in the chat box so that we can start for further. We can go further. Are you able to listen to my voice? And also, is the slide clear to you? Everything is clear? Please let me know, because let us make this session interactive. Your response, okay, okay, fine, everything is okay, I assume that. So now what we do, let's add the interest rate to the principal amount, right? Let's add the interest rate to the principal amount. So if we add the interest rate to the principal amount for these two currencies that we have two currency, right? We have two currency, US dollar as well as, on one side we have USD, on other side we have INR. So what if we add interest rate to the principal for USD, how much we will get? 100 plus 1 right? Because 1 is the interest rate for USD, this will be equal to 101. This will be equal to 101 USD. And now similarly, if we add for INR, what will be the total? If we add interest, what will be the amount? So principal is 7375 and interest we have calculated is 221.25. So after addition, how much are you getting? Please type in the chat box. After addition, how much are you getting? Yes. Well, so if you add 7375 plus 221.25, so I think you will get 7596.25, right? 7596.25. Are you getting the same? I hope you are also getting the same. So now finally we have to find the forward rate, right? What is asked in the question? In the question you have been asked to calculate the forward rate. So how to go about calculating the forward rate? It's quite simple. You can see that we have just to equate both of them. We will equate 101 USD is equal to, this is INR, this is equal to 7596.25 INR, right? So just apply the unitary method. So this means 1 USD will be how much? 7596.25 divided by 101. So tell me, what is the value you are getting after this division? Just divide them and tell me the answer in the chat. What value are you getting? Divide both of them, 7596.25 upon 101. I think you will get 75.21, isn't it? Are you getting the same? Please, I request you to take full advantage of this particular session. You should have pen, paper and calculator with you, right? Because once you solve the question and suppose you got the wrong answer, then you will get to know that what mistake I am doing, right? Because you know BFM, in BFM there is a 30 to 40% weightage of numerical part, right? So numerical portion you can only master by just solving it. Assume that you are in the exam hall and this question appear in front of you. What you will do? So assume create such type of temperament, right? So 1 USD is equal to 75.21. So what is the correct answer? Option number B is the correct answer, right? So you can think of it like this: forward rate are adjusted based on how much interest is earned in both the currency over the time. Forward rate are adjusted based on how much interest is earned in both the currency over the time. Now you can see Indian rupees has higher interest rate, which is equivalent to 221.25 as compared to USD. So Indian rupees will depreciate faster, making the forward rate higher than the spot rate. Let me know in the chat if this explanation was clear, and if you have any doubt, feel free to ask. Please let me know if this explanation was clear to you. Yes, 75.21. Very good. So this is our answer to this particular question. This is the forward rate that have been asked to calculate. Okay, clear. Very good. Now let's move to the next question. So again, I request you, I hope you have taken the screenshot of this particular table. Now let's move to the question number 2. The question USD forward rate if a spot dollar is 74.00. Think about the question and type your guesses in the chat. Let us see how many of you can crack this one. Okay, clear. Very good. Okay, I'm showing the question. Just wait a minute. So this is the question, right? This is the question. Please take it a screenshot, right? Please take the screenshot because you will use the data from this particular question to solve it, right? I hope all of you have taken a screenshot of this particular question. So let me show you the actual question, right? The actual question is this one. What will be the 12-month USD forward rate if the spot dollar is 74.00? So all right, before solving, let me ask you a quick question. What is the 12-month interest rate for USD and INR from the table? Right, type your answer in the chat. What is the 12-month interest rate for USD and INR from the table? Right, please see this table. What is the 12-month interest rate for USD and INR? Just type what do you think is in the chat box. 12-month interest rate for USD is how much and for INR is how much? Yes, 2.25 and 6.25. Exactly. Very good. Very good, Dinesh, Shraddha, and Padma. Very good. Right. So it is quite clear from the table that this is this one. Just wait a minute. This one. Yeah, this one is the interest rate for USD for 12 month, and this one is the interest rate for INR for the 12 month, 2.25 and 6.25 respectively. Okay, so the 12-month interest rate, let's break this problem into simple steps so that everyone can follow. Now, what we will do, we will assume 100 USD as the starting amount. We will start with 100 USD, right? We will start with 100 USD. So what is the spot rate? You can see $1 is equal to 74.00. If anyone has solved this question, please type the answer, right? I will appreciate that if you are able to solve on your own. We just multiply both sides by 100. So what will that be? $100 is equal to 7400 Indian rupees, isn't it? So what does this step mean? Why do we multiply the spot rate by 100? Can you tell me why we are multiplying it by 100? Yes, why we are multiplying it by 100? Please let me know. What is the reason behind multiplying both sides by 100? If you think please type in the chat. So let me make you clear that this step ensure that we are working with the round number, making the calculation simpler, right? There is nothing to do because we are just making our calculation simple. That is why we are multiplying both side by 100. Now the next step is to calculate interest for both the currency, right? You have to calculate the interest for both the currency. How to go about calculating that? See, for US dollar, if we calculate interest for US dollar, so the formula is quite simple. P into R into T upon 100. So for US dollar, what is the P? Principal is rupees 100. What is R? Rate of interest, I know you just have type is 2.25. So I will write 2.25 upon 100. And what is T? T is 12 month, which is equal to 1 year. So just multiplied by 1. So how much interest you are getting for US dollar? Tell me how much interest you are getting for US dollar. Okay, so one answer I am getting 1387.5. 1387.5. Okay, so let's see. Okay, I will just do it. Let us see. So let's move step by step. So please tell what interest are you getting for USD just after this calculation. So it's quite simple. If you multiply, you will get 2.25. Right? You will get 2.25. Now similarly, calculate the interest for INR. What will be the interest for INR? The interest for INR, you just calculate it. Okay, so am I getting a response? Okay, so Dinesh is saying after calculating interest rate for INR, this will be 462, right? Yeah, Dinesh, exactly, very good. It will be just see 7400 multiplied by 6.25 upon 100 into 1. So this will give you 462.5, right? So this is interest for INR. Another question for you all: why is the INR interest amount so much higher than the USD? Please tell. See, you can see the interest for USD is just 2.25 and for interest for INR is 462.5. So why is that? Why is the Indian rupees interest rate so much higher than the USD interest rate? What do you think? What do you think is the reason? Yes, yes, exactly, exactly. Yes, good answer. The Indian rupees INR interest is higher because the interest rate for INR is higher than USD. You can clearly see that interest for INR is 6.65 and interest rate for USD is 2.25. So since interest rate is higher, that is why interest value is also higher. Now what we will do, we will add the interest. So for USD, how much we will get? Just add 100 plus 2.25. So this will give you 102.25, right? And for INR, what we will get? For INR, we will get 7400 plus 462.5. So this will give us 7862.5. So this step show the future value of both currency after 1 year. So what the value you have got two values, right? The first value you have got is 102.25 and the second value is 7862.5. What are these two values represent? These values show the future value of both the currency after 1 year. And finally, we will calculate the forward rate by dividing future value of INR by the future value of USD. So we can write that $102.25 is equal to 7862.5 INR. So you have to calculate how much how much $1 is worth. So just apply the unitary method. So this will give you 7862.5 divided by 102.25. So what answer are you getting? Tell me, what answer are you getting after this calculation? So after division, tell your answer. What are you getting? D. Very good, Shraddha. Very good. 76.89, right? 76.89. Yeah, option number D is correct. Very good. So here is a simple way to think about it. We are looking at how much Indian rupees is needed to buy $1 after both currency grow by their respective interest rate for 12 months. Since INR has a higher interest rate, so it loses the value faster, which increases the forward rate as compared to a spot rate, right? So INR has a higher interest rate, so that's why it loses the value faster, right? So which increases the forward rate compared to the spot rate. So did you get this one right? Type got it in the chat if it is clear. If it is clear, you just type got it in the chat box so that we can move to the next question. And if you have any confusion, please ask. Okay, got it. Very good, Dinesh. Okay, so I hope everyone got this particular question. So now let's move to the next question. So question number 3, based on the same data, is in the front of your screen, right? So let's tackle our next question. Let me show you the data. The question is regarding what will be the 3 month Saudi Riyal forward rate if the spot Saudi Riyal is 19.32. Options are 18.99, 19.28, 19.36, 19.98. Take a moment, think it through, type your answer in the chat. Let's see how many of you get it right. So let me again show you the data. Let me again show you the table. So this was the table, initial table. If any one of you have not taken the screenshot, please again take the screenshot, because this is a type of case study, right? So take this screenshot of this particular interest rate. You will use it throughout this particular question. I hope you have taken the screenshot. Now let's move to this particular question again. Yeah, this is the third question. What will be the 3 month Saudi Riyal forward rate if a spot Saudi Riyal is 19.32? Yes, I hope all of you have taken the screens going through this particular question. Okay, fine. So now let us break this question step by step. I have already, I think you are familiar with the step, right? So let's take a step by step. Before we solve this step by step, here is a quick question for you. What is the 3 month interest rate for Saudi Riyal and INR from the table? Please type in the chat box. What is the interest rate for Saudi Riyal and INR from the table? So let me show you the table. So this is the table we are talking about. Yeah, this is the table. So what is the interest rate for Saudi Riyal and INR? Just type in the chat. What do you think? And for just you have to calculate for 3 month, right? What is the 3 month interest rate? So I hope you have got it right. So 3 month interest rate for Saudi Riyal, you can see in the table it's quite clear that it is 6.5%, and for INR it is 5.75%. I have highlighted both of them. So let me write down. Saudi Riyal it is 6.5%, and for INR it is 5.755%. Right. Now let's break this down in step by step to solve this question. So here we are, right? So we know the interest rate. So to make the calculation easier, we take Saudi Riyal 100 as the base amount. So what is the spot rate? So spot rate is given. I am writing SR. SR means Saudi Riyal. For short, I am writing SR. So 1 SR is equal to 19.32 INR, right? And what we do, we multiply both side by 100. So we will get 100 SR is equal to 191932 Indian Riyal. Is it clear? We have multiplied the both side by 100. Okay, so Sudhanshu has answered 17.09. Okay, Sudhanshu, very great. Let us see whether your answer is wrong or right. We will got it further. We will look it further. So this way, you should also have a pen and paper with you, right? You should also try to solve on your own. So yes, just imagine that you are in the exam hall and such question appear in front of you, because whatever question we are discussing right now have been asked previously in the examination, right? So 1 Saudi Riyal is equal to 1932 INR, right? 100 Saudi Riyal is equal to 1932 INR. We know why we multiply by 100, right? We multiplied by 100 to make the calculation simpler. It helps us compare two currency for interest calculation. Now let's calculate interest for both the currency. So for Saudi Riyal, interest will be 100 times, this is P, we know the interest rate, which is 6.5. 6.5 divided by 100. So many of you will ask from where this 6.5 comes. So let me show you. This come from here. This is a table, right? In this table you can see, I again request you to take a screenshot of this particular table. You can clearly see that for Saudi Riyal 3 month interest rate is 6.5, and for INR 3 month interest rate is 5.75. So I hope this confusion is clear now from where we are taking this 6.5. So now P into R into T upon 100, right? P into R into T upon 100. So we know this R, and what is T? T is 3. Now can you tell me why we are dividing this 3 by 12? Why we are doing this 3 by 12? Why not we are taking 3 only? Okay, Sudhanshu, you are correcting your answer 19.28. Okay, fine. Let's see. Please answer my question. My question is why we are dividing 3 by 12? Why not we are just multiplying by 3? So just type your answer in the chat box. So after the calculation, you just calculate and tell me how much are you getting. So I think all of you know it, why we are dividing it at 12. Yes, correct, Shraddha. Very good. It is 3 months. Very good. So we are dividing by 12 because since we are calculating for 3 months, we divide the annual interest rate by 12 to get monthly interest rate. Very good. Right. So to get see, we have been provided month and we have to calculate the annual interest rate. So we are dividing by 12. Okay, so after calculation you will get 1.625. I'm just calculating it. I hope you also get the same. So 1.625 you will get. So this is the interest for Saudi Riyal. Now similarly calculate for INR.
what will be the interest? So principal amount, is 1932 multiplied by interest rate, 5.75 divided by 100 multiplied by 3 by 12. How much are you getting for INR? Please type your thought in the chat. For INR, how much are you getting? I think now such type of question will not trouble you anymore. Yes, Sudhanshu, exactly. Very good. Because rate is per annum. That's why we are doing it. Exactly. Yes. So how much are you getting for INR? Please tell. So I hope you all are getting this much. I am also getting 27.7725, right? I hope you are also getting this much. Now, what is our next step? This is these things, these we have calculated as interest. Now we will add the interest to the principal, right? We will add the interest to the principal. For Saudi Riyal, what will be the total amount? For Saudi Riyal, what will be the total amount? So it is 100 plus 1.625. 100 plus 1.625. So this will give you 101.625. And for INR, what is the total amount? It is 1932 plus 27.7725. So this will give you 1959.7725. Isn't it? Are you getting the same? So this step give us the future value of both the currency after 3 months. So this step give us the future value of both the currency after 3 months. After 3 months, right? Now, what we will do? Finally, we will calculate the forward rate by dividing the future value of INR by the future value of Saudi Riyal. Or just we will equate both of them. We will equate both of them. We will say 1101. Just wait a minute. Let me erase it. So we will say we just equate both of them, right? We just equate both of them. We will say 101.625 Saudi Riyal is equal to 1959.77 Indian rupees. So how much will be 1 Saudi Riyal? This will be 1959.7725 divided by 101.625. And after calculation, you will get 19.28. Option number B will be correct. Great, Sudhanshu. Your answer was exactly correct. And Padma also had answered 19.28. Very good. Very good. Nice to see you are able to solve such type of problem. Right. Okay. P into 1 plus R upon 1 plus R. Exactly. Very good. Very good. Yeah, this is a shortcut. Right. Very good. Very good, Sudhanshu. Yes, this shortcut we can use. Which will help, which will reduce our step. Will also reduce our time. Exactly. So why? Because many things are, so many things are quite we are calculating it twice, so we have to eradicate that, so we can also use that formula. So now let's see the last part of this particular question. I hope this question is clear, right? We are calculating the future value of both Saudi Riyal and INR after 3 months of interest. Once we have the future value, we can figure out how much INR are required to buy 1 Saudi Riyal. I think this calculation makes sense to you. Did this calculation make sense? Type clear in the chat if you understood. If not, feel free to ask your question. I will explain it further. Yes, correct, Sudhanshu. Because time is common, that's why it will cancel. So we are just it is just redundant. Okay, I think it is clear, right? Okay, awesome. Great participation, everyone. So now let's move to our next question. Stay focused and keep those answers coming in the chat. Now this is the last part of this particular case study. So now we will apply the simple formula to solve this particular. I will tell you a trick to remember it. So now, just Sudhanshu has typed in the chat box. We will apply the same trick. So the question is, what will be the 6-month Saudi Riyal forward rate if a spot Saudi Riyal is 19.50? So this is the question. So just see what we are basically doing. So spot Saudi Riyal is 19.50 and you are familiar with the rate. So suppose a small r is the rate for Saudi Riyal and capital R is the rate for INR, right? So basically what we are doing, I'm simplifying the formula for you, right? So one spot Saudi is given, that means 1 Saudi Riyal. You just do your calculation. 1 Saudi Riyal is equal to 19.50 INR. You know it very well, right? We just multiplied by 100. So 100 Saudi Riyal will be how much? 1950 INR. And what we are doing, we are taking a small letter for Saudi Riyal and capital letter for INR. So P into R into T upon 100 is equal to capital P, capital R, capital T upon 100. Right. And after that, what we are doing? So this is these are the interest rate, right? These are the interest rate. So this is the interest for Saudi Riyal, and this is the interest for our Indian rupees. And then what we are doing, we are just adding with the principal. So P plus P into PRT upon 100. Okay. So let's move step by step. So first of all, calculate the interest for Saudi Riyal. How much that would be? So how much interest are you getting? How much interest are you calculating for both of them? For the Saudi Riyal, how much interest are you getting? So it's quite simple. You just multiply 100 multiplied by, okay, let me show you the table again. Let me show you this particular table for, but now the question is for 6 months. So you can see for 6 months, you can easily see for 6 months, the rate of interest is how much? The rate of interest is 7.5% and 6% respectively, right? So we will use this data. For Saudi Riyal, it is 7.5% and interest rate, Indian rupees, it is 6%. So here we are right now. So 7.5 and 6. For Saudi Riyal, SR 100 multiplied by 7.5 divided by 100 multiplied by 6 by 12. We are divided by 12 because we are taking 6 months. So after calculation, you will get 3.75. Right. This is the interest for Saudi Riyal. And for Indian rupees, you will see this is nothing but 1950 multiplied by 7.5. Sorry, not 7.5, it is 6 multiplied by 6. Type your answer. If you have calculated, please type what you are getting in the chat box. Upon 6 upon 100 into 6 by 12. So this will give you 58.5. Isn't it? You are getting the same 58.5 also? Right. I hope you are also doing the calculation. So now we are dividing by 12. You know the very well reason why we are dividing. Not just calculate the amount. Right. So just add in interest to the principal. We have just calculated the interest. We just add interest to the principal. So this will give you the final amount. So this will be how much? For Saudi Riyal, it will be 100 plus 3.75, which will be 103.75. And for Indian rupees, this will be how much? For Indian rupees, this will be 1950 plus 58.5. So this will be how much? 2008.5. So this gives us the future value of both the currency after 6 months. So Shraddha has answered 19.36. Okay, okay, fine. Very good. Nice to see that you have calculated it. Very good. So finally, we calculate the forward rate by dividing the future value of INR by future value of Saudi Riyal. We just equate both of them, right? So we can write that 103.75 Saudi Riyal is equal to 2008.5 Indian rupees. So 1 Saudi Riyal will be equal to 2008.5 divided by 103.75, which will be equal to how much? How much are you getting? Yes, 19.22. One answer I'm getting. Sudhanshu is answering 19.22. No, I think that is wrong. The correct answer is 19.36. Right. The correct answer is 19.36. Please do the calculation correctly. 2008.5 divided by 103.75. This will give you 19.36. Yes, the Dinesh has answered 19.3590. Yes, to round off. See the options. You have to go through the option, right? So the closest option to 19.3590 is 19.36, right, Dinesh? So answer will be option number C, right? So I hope in the layman terms we can think of it like this way, that we are looking at how much INR you will need to buy one Saudi Riyal after 6 months. By adding the interest to the principal, we account for the time value of money in both the currency. This gives us the forward rate. So did this step by step breakdown make sense? You type crystal clear in the chat if you got it, or type your question if there is anything you would like me to explain further. Okay, crystal clear. Very good. Very good. Very nice. Fantastic participation, everyone. Let's keep up the energy and move on to our next question. Stay tuned and keep the answer coming in the chat. I hope this question is clear to everyone. Right. So now let's move to the next question. So now the next question, as you can see, is from unit number 2. So let me first of all zoom out a little bit. Yeah, it is from unit number 2 of BFM. So here's an interesting question for you. Now let us see what is the question is all about. This is a case study type question. I hope the earlier question was clear now. Let's move on to this particular question. So let me read this question for you. What it is saying, that Mr. Rohan planned to travel abroad for private visit to Russia, and want to carry foreign currency in cash. He also intend to gift $2,000 to a friend living in USA during his trip. He visits his bank and informs them that he has already made multiple foreign visits during the financial year. Rohan is unsure about the limits and the procedure for availing foreign exchange under LRS. What is LRS? Liberalized Remittance Scheme. Additionally, Rohan wants to know what he should do with any unutilized foreign exchange upon returning to India, and whether there are any specific provision for traveler to a specific country like Iran, Libya, or Iran. So uh, this is the scenario which has been presented before you. Now let's see the question. So the question, as you can see, basically the question is that Mr. Rohan planned to travel abroad for a private visit to Russia, and he want to carry foreign currency in cash. He also intend to give $2,000 gift to a friend in USA during his trip. So he informed his bank about the multiple foreign visit. So the question is, what is the maximum amount of foreign exchange Rohan can carry in the form of foreign currency note for his trip to Russia? Right. Options are 3,000 US dollar, 5,000 US dollar, full foreign exchange amount requested, 1,500 US dollar. Take a moment and type your answer in the chat. Okay, I will again show you the question. This is the question. So question is, a maximum amount of foreign exchange Rohan can carry in the form of foreign currency note for his trip to Russia. And this is the question. So before we reveal the correct answer, let me ask you a related question. Under the liberalized remittance scheme, what is the maximum limit for remitting foreign exchange by an individual in a financial year? Please answer my question. My question is, under the liberalized remittance scheme, what is the maximum limit for remitting foreign exchange by an individual in a financial year? See, from this particular question, we will ask, we will create 2 to 3 more questions, right? So just answer my question, that what is the maximum limit for remitting foreign exchange by an individual in a financial year under LRS? Is it $2,50,000 or $50,000 or $5 lakh? Yes, Sudhanshu. Yes, very good. It is $2,50,000. Right, great. The correct answer is $2,50,000 per financial year. Now let's look at the Rohan case more closely and solve this question together. So first of all, Rohan is traveling, right? Rohan is traveling to Russia, which fall under the categories of country for which special provision apply. You know, he is traveling to Russia, and this is the country for which special provision apply, right? He want to carry foreign currency note as cash during his trip. This is different from the usual LRS rule. Yeah, usual LRS rule is different. This is different from the usual LRS rule. Do you know what is the usual limit for carrying foreign currency note in most of the country? Do you know what is the usual limit for carrying foreign currency note in most of the country? See, whatever we are discussing are from your Macmillan book only, and this question have been asked in the previous year, right? In 1 marks question or 2 marks question form. So whatever answer question I am asking in between, you should answer, right? So my question is, what is the usual limit for carrying foreign currency note for most of the country? Just type. What do you think? Okay, I think I'm not getting any response. So let me tell you that for most of the currency, individuals are generally allowed to carry up to US dollar 3,000. You should remember this, US dollar 3,000, right? for most of the country, individuals are allowed to carry up to US dollar 3,000 in foreign currency note, FCN. FCN means foreign currency note. The rest can be carried in other form like traveler check or forex card, but 3,000 foreign currency note are allowed for individual to carry, right? However, when traveling to Russia or other country in the CIS, do you know what is CIS? What is CIS? You know about CIS? Please tell. You know about CIS? CIS is called Commonwealth of Independent State, right? You should know it. I have already discussed it in the lecture. Again, I am telling you that CIS is called Commonwealth of Independent State. So for countries like Russia or other countries in the CIS, there is an exception. Travelers are allowed to carry the full amount of foreign exchange requested in the form of foreign currency note. They are allowed to carry the full amount of foreign exchange requested in the form of foreign currency. Can you name some other country where this exception apply? Can you name some other country where this exception apply? Yes, one answer I am getting: Iran, Russia, Libya and Syria. Okay, great, very nice, great answer. Some example include, let me write down the example like Iran, right? Iraq, Libya, right? And Russia. Russia is of course there, right? So in this case, as you can see, since Rohan is visiting Russia, so he can carry the full foreign exchange amount requested. So what will be the correct answer? Please type the correct answer in the chat box. Yes, religious pilgrim. Very good. So what is the correct answer now? So obviously the correct answer is option number C. Option C is the correct answer. Yes, Gopda, please, you have raised the hand. Is there any doubt? Is this clear? Whatever we have talked just now, I have told you that for most of the country, the limit is 3,000 US dollar. But for country which come under CIS, right, the limit is how much? 5,000. Sorry, it is full amount, full foreign exchange amount requested, right? Now, let's not stop there. Rohan has another query. You see, he has another query. One more question can be framed from this particular case study. See, the one more question can be framed. The question can be that what should he do with any unutilized foreign exchange when he returned to India? It's clearly written. What should he do with any unutilized foreign exchange when he returned to India? Let me ask you, how many days does a traveler have to surrender the unutilized foreign exchange to an authorized dealer in India? My question is, how many days does a traveler have to surrender the unutilized foreign exchange to an authorized dealer in India? Option number 1, 30 days. Option number 2, 90 days. Option number 3, 180 days. Type your guess in the chat. My question is, how many days does a traveler have to surrender the unutilized foreign exchange to an authorized dealer in India? What do you think? Yes, Shraddha has answered 180 days. Or the other person, can you also type what do you think is correct? Just type, right? Whether it is wrong or right doesn't matter, because you know such type of question, if you get in examination, you should not get that incorrect. That is our main motive, right? Okay, Dinesh is answering option 3. Right, great, exactly. Traveler must surrender unutilized foreign exchange to an authorized dealer within 180 days to returning to India. This ensures compliance with FEMA. Right. So to recap the point which we have covered in this particular question, first thing is that the Rohan can carry the full amount. Yes, correct, Sudhanshu. 180 days. Right, very good. Rohan can carry the full amount of foreign exchange in cash for his trip to the Russia. Upon returning, he must surrender any unutilized foreign exchange within 180 days. Right. So did you find this question an explanation engaging? Right. Type helpful in the chat if you did. I hope you find this question and explanation engaging. Type helpful in the chat, right? If you did, let's move to the next question. Okay, Dinesh, helpful. Very good, nice. So I think this was your concept is clear now, that for which country how much cash you can take in the form of foreign currency notes, right? We have cleared it. Now let's take another case study. Here is an important scenario for you. Let's see this scenario. Okay, please repeat all limits. Okay, fine. Okay, I'm repeating all limits. Just wait a minute. So what we have learned in the earlier question, that Uh, first thing is that Rohan is traveling to Russia, right? For which a special provision apply. He want to carry foreign currency note as cash during his trip. This is different from the usual LRS rule. For most country, individuals are generally allowed to carry up to US dollar 3000. For most country, for usual country, it is 3000 US dollar in foreign currency notes, right? The rest can be carried in other form like traveler check or forex card. However, while traveling to the Russia or any country under CIS, you know CIS? CIS is called Commonwealth of Independent State, CIS, right? So there is an exception. Travelers are allowed to carry the full amount of foreign exchange requested in the form of foreign currency note. Some other country under CIS are Iran, Iraq, Libya, right? So in this case, Rohan is visiting Russia, so he can carry the full foreign exchange amount requested. I hope this clarify the concept. Now let's move on to this particular question. Right, I hope it was clear now. Okay, so let's move on to this question. As you can see, the question is on front of your screen. Let's repeat. A resident India, Mr. Rajesh, a resident Indian, gives an interest free loan of 10 lakh to his NRI brother, who is Mr. Arjun, who lives in USA. Mr. Arjun planned to use this loan to start a small business in India, but is also considering investing part of it in plantation business. As you can see, he is investing in a plantation business. The repayment period is 2 years, and Mr. Arjun planned to repay the loan using fund from his foreign bank account. So please take a screenshot of this, right? Because we will, this is the case based on which we will do 2 to 3 questions. So I have to again scroll up and down. So better it is you take the screenshot, right? Instead of scrolling up and down, you take the screenshot of it, right? So fine. I hope you have gone through this question. Let us see the first question of this particular case study. The first question is, which of the following condition does this loan violate? Which of the following condition does Mr. Rajesh loan to his NRI brother violate? Option A say the loan should be interest free. Option B say the maximum maturity of the loan should be at least 1 year. Option C say the loan amount should be not be used for plantation activity. Option D says the loan can be repaid from foreign bank account. Please note in this question more than one answer can be one option can be correct. More than one option can also be correct, right? It is not like that only one option is correct. More than one option can be correct, like A and B, B and C, like that, right? So type your answer in the chat. Do you think it violates any one condition or two condition or none at all? What do you think? Let me again show you the case. So question is regarding the violation of the rule. Let me again show you the case. So does this violate any case? Okay, so one answer I am got from Sudhanshu, from Shraddha, sorry. Shraddha has answered option C and D. Okay, fine. Very good. Very nice to see your participation. Very good. So let's see whether it is correct or not. I hope other member will also answer whatever they think is correct. Let me again show you the question. Question is this. Which of the following condition does Mr. Rajesh loan to his NRI brother violate? So Sudhanshu has answered A and D. Okay, fine. So before we reveal the answer, let us break this down step by step with a few mini questions to test your knowledge. Right? See, on the basis of this question, many questions can be framed. I am just presenting before you. Under RBI regulation, can a resident Indian give an interest-free loan to an NRI family member? My question is, under RBI regulation, can a resident Indian give an interest-free loan to an NRI family member? Type yes or no in the chat. Whether a resident Indian give an interest-free loan to a NRI family member. What do you think? Dinesh has answered no. Means the resident Indian cannot give interest-free loan to any NRI family member. See, this question you can answer only when your bit concept is clear, right? So I am getting no answer. I am again repeating the question. Question is, can a resident Indian give an interest-free loan to an NRI family member? So two answer I have got no. Sorry, both of you are wrong. Yes, the correct answer is yes. RBI permits such loan to NRI relative provided certain conditions are met. See, in your BFM book, this case has been written, clearly written. So the answer yes, correct answer is yes. RBI permits such loan to NRI relative provided certain conditions are met. One of those condition is that loan must be interest free. I am again and again telling you, interest free, interest free. See, this interest free plays a crucial role. If the loan is interest free, then in that case, in that case, if the loan is interest free, in that case, a resident Indian can give interest free loan to NRI family member. In this particular case, it is clearly written that Mr. Rajesh is a resident Indian and he is giving loan to his NRI brother, Mr. Arjun, right? And clearly written interest free loan, right? So if this loan is interest free, यदि ये loan interest free होगा, तो Mr. Rajesh is not violating any condition, right? Mr. Rajesh has fulfilled the condition. Now, question number 2. I hope it is clear now. Yes, okay, very good. Now, question number 2. What is the minimum maturity period for loan given to NRI under RBI regulation? What is the minimum maturity period for loan given to NRI under RBI regulation? Option number 1, 6 months. Option number 2, 1 year. Option number 3, 3 years. See, from a single question, we are framing different type of question possible, right? My question is, what is the minimum maturity period for loan given to NRI under RBI regulation? 6 months, 1 year, or 3 years? Minimum maturity. I'm talking about minimum maturity. Yes, Sudhanshu, very good. It should be interest free because any interest earned is taxable. Exactly, very good. Right, you have a clear clarity of concept. Great to know that. Now, my question is minimum maturity period. Can you tell me what should be the minimum maturity? Whether it is 6 months, 1 year, or 3 year, minimum maturity period for loan given to NRI under RBI regulation. Type your answer in the chat. 6 months, 1 year, or 3 year. What do you think? Okay, so the answer is answered 1 year. Rest member can also answer. Don't worry whether it is right or wrong, doesn't matter, right? It doesn't matter whether it is right or one answer I'm getting is 6 months. See, I'm telling you the answer. The answer is 1 year. So the answer is correct. Loan must have a minimum maturity of 1 year. Since Mr. Rajesh loan has a maturity of 2 years, you can see the maturity is how much, repayment period is how much, 2 years. So since Mr. Rajesh loan has a maturity of 2 years, so this condition is also satisfied. Now let's focus on the two key issue in this case. The two key issue are the use of the loan. The first key issue is the use of the loan, right? So the use of the loan condition is that one important condition is that loan cannot be used for certain restricted activity such as investing in agriculture or plantation, right? So this loan cannot be used for in certain restricted activity, and one restricted activity is plantation or agriculture, right? Since Mr. Arjun is considering using part of the loan for plantation activity, so this violates the RBI regulation. That's why option C is the violation. And the second key point is source of repayment. Source of repayment, right? Source of repayment. The repayment of such loan must come from inward remittance from abroad or from the NRO, NRE, or FCNR account of the NRI in India. Two sources should be there. The first source should be either NRO, NRE, FCNR account of whom? Account of the NRI, or inward remittance from abroad. Now, in this case, what is happening that Mr. Arjun planned to, you can see clearly written, Mr. Arjun planned to repay the loan using fund from his foreign bank account. Clearly written, he is planning to repay the loan using fund from foreign bank account, which is not allowed under RBI rule, right? So that is why correct answer is option number C and D. Both C and D violate the rule. And I think Mr. Sudhanshu has answered it correctly. Okay, Sudhanshu has answered A and D. Shraddha, very good. Nice to see that your concept is quite clear. Option C and D is the correct answer, right? So here is a quick question for you. What are some other restricted activity for loan given to NRI? Can you tell me? One restricted activity is plantation and agriculture. What are some other restricted activity? Just type your answer. What do you think are other restricted activity? Can you name one or two? Loan given to NRI cannot be used for some restricted activity. One we have seen is the plantation and agriculture. Can you name one or two more? Okay, real estate. Exactly. Very good. Real estate. It cannot be used in the real estate. Right. The loan given to NRI cannot be used for real estate. Very good. Exactly. And the second is, I'm naming one relending purpose. Relending purpose. Meaning what? Giving loan to other. Right. So these restrictions are in place to ensure proper use of fund under RBI guideline. Let's summarize the key point which we have learned in this particular question. Right. Mr. Rajesh loan violated two conditions. It cannot be used for plantation activity and repayment cannot come from a foreign bank account. Always remember to follow RBI guideline while giving loan to NRI, whether it is regarding this maturity, purpose or repayment source. Did this explanation help you understand this topic better? Type yes in the chat if it did. So we have seen all possible conditions which need to be fulfilled for loan given to NRI. We have seen all possible conditions. So if this explanation help you understand the topic, please type yes. Okay, okay, very good, very good. So now let's move on to the next question. Okay, explain option number D. The loan can be repaid from the foreign bank account. Again, I'm explaining what is happening in option number D is that Mr. See the case study. See the case study. It is clearly written that Mr. Arjun is planning to repay the loan using fund from the foreign bank account. You see the last line. Please see the last line. It is clearly written that Mr. Arjun is planning to repay the loan using fund from his foreign bank account. Right. So since he is repaying the loan using fund from foreign bank account, which is not allowed under RBI rule, right? As per under RBI, the repayment of such loan must come from two things, either from his NRO, NRE, or an FCNR account. Suppose Mr. Arjun has NRO, NRE, FCNR account, so fund must come from either of this account or from inward remittance from abroad. But he is using his foreign bank account, right? That's why this condition violate the RBI regulation. That's why option number D is not correct. I hope Sudhanshu it is clear now, right? Two things you have to remember: either it should come from NRO, NRE, FCNR account, or through inward remittance, right? It should not from the foreign currency account, right? That's why correct answer is option C and D. Now let's move on to the next question. So the next question is regarding the same, right? Just based on the same case study, this question has been framed. Let's tackle another question on loan given to NRI. In the previous examination, in the June, I think July examination, question based on loan given to NRI was asked, right? Yes, okay, fine. Now let's see this particular question is in front of your screen. The question is that which of the following statement is true regarding the uses and repayment of such loan? Right. Let's talk about the uses and repayment. The loan amount can be remitted outside India. Option A. Option B. The loan can be credited to the NRO account of the NRI. Option C. The loan can be used for trading in transferable development right, which we call as TDR. And option D. The repayment can be made from NRO or NRE account. What do you think is the correct combination? Is it just one of them or more than one? Type your answer in the chat. I hope you have gone through the case study. Let me again show you the case study. Just wait a minute. So this is the case study regarding Mr. Rajesh and Mr. Arjun. I hope you are familiar with it. Now this is the question we are dealing with. Usage and repayment of the loan. Type your answer, whatever you think is correct. So Shraddha has answered option number B. Only one. Okay. See, more than one can also be correct. So keep that in mind. I request other member to also answer, because the more you interact, the more your concept will be clear, and though the more you will be easily answered the such question in examination, the more confident you will feel. Okay, fine. So before we reveal the answer, let's start with this. Can the loan amount be remitted outside India? So here the question is, can the loan amount be remitted outside India? Can we remit the loan amount outside India? Type yes or no in the chat. Okay. What do you think? Can the loan amount be remitted outside India? The correct answer is no. Exactly. The loan given to NRI are strict for use within the India. Right. As per the RBI guideline, the fund cannot be remitted abroad. Right. So option A, what it say that the loan amount can be remitted outside India. So this is wrong, right? Option A is incorrect. The loan amount cannot be remitted outside India. Here is another question for you. Can the proceed of the loan be credited to the NRO account of the NRI? Suppose this NRI, who is NRI here? I think Mr. Arjun is NRI. So can the loan amount, can the proceed of the loan can be credited to the NRO account of the NRI? Type yes or no in the chat. Can the proceed of this particular loan be credited to the NRO account of the NRI? Dinesh is answering yes. Absolutely right. Yes, correct. The loan proceed can be deposited into the NRO account of the NRI or PIO. Right. So option B is correct. Option B is correct. The loan can be credited to the NRO account. Right. I think if you are familiar with what is NRO, what is an NRE account, I think you know it. Right. NRO is non-resident ordinary account. Right. You are familiar. We have already talked about it in the lecture. Right. We are seeing the application part. Now, the next question is, can the loan amount be used for trading in TDR? TDR is transferable development right. Can the loan amount be used for trading in TDR? What do you think? Okay, interview question. Okay, great to know that the same question has been asked your interview. Great to know that. Okay, and not in NRA. Yes, exactly, exactly. Whether the gold amount can be credited to NRO. Okay, gold loan amount can be credited to NRO. Okay. And see, this question is from where? Your Macmillan book. So if you go through the Macmillan book clearly, you should have no confusion. And that is what we are doing in this session. That we are using each and every line of the Macmillan book and framing question based on them. Right. Okay, fine. So my question was, can the loan amount be used for trading in TDR? That is transferable development right. See, what do you think? Yes or no? What do you think? And use of fund cannot be used for trading. Exactly, very good. The answer is no. RBI prohibit the use of such loan for trading in TDR, just like it prohibit for use in agriculture or plantation activity. We have seen in the previous slide, previous question. So option C is also incorrect. Option C is incorrect. This loan amount cannot be used for trading in TDR. Now, last question. Can the repayment of the loan be made from NRO or NRE account? Can the repayment of the loan can be made from NRO and NRE account? We have already seen this concept in the previous question. All of you are requested to type yes or no. Can the repayment of loan be made from NRO or NRE account? Already we have seen in the previous question. What do you think? Can the repayment be made from NRO and NRE account? Yes, exactly. Exactly. That's correct. The repayment can be made from inward remittance or from the NRO, NRE, FCNR account. So option D is correct. Option D is correct. Right. So what we have seen, let's bring it all together. The option A is incorrect because the loan amount cannot be remitted outside India. It must be used within India. Option B is correct because the proceed of the loan can be credited to the NRO account of the NRI or PIO. Option C is incorrect because trading in TDR is not allowed under RBI guideline. Option D is correct because repayment of the loan must be made from inward remittance or from NRO, NRE, FCNR account of the NRI. So the correct answer is option B and D. So who had answered B and D? I think B and D. Yes, Shraddha, very good. Nice, nice, very good. I think you are posted in forex department, so you know everything. You are getting all the current answer correct. Nice to see you have conceptual understanding. Okay, 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 fine. Now, can you name one more restricted activity for use of loan given to NRI? Just we have seen credit department. Okay, fine. Great to know. You have a sound conceptual understanding of these things. Very nice. Now real estate activity, relending, right? We have just talked about in the previous question real estate activity and relending, right? So to summarize, always check RBI guideline when while granting loan to NRI, especially regarding the uses, repayment, and restricted activity. Understanding these rules can save you from potential violation and penalties. Right. I hope this explanation helped clarify the thing. Right. Type yes in the chat. Right. If it is clear to you. So that we can move to the last question of today's session. This will be the last question of today's session. So type yes. We will move forward. If anything is doubt, please type. Yes, fine. Okay. So let's see the last question of today's session. So this is the question again a case study, again a type of case study. This will help you clear more concept. Let me zoom it for you so that you can view the question clearly. Okay. I hope it is quite visible now. Now the question is, Mr. Sanjay, a resident Indian, want to invest in a startup company in UK along with his wife and son. Right. To facilitate this, they plan to open a joint bank account. They plan to open a joint bank account abroad, right, abroad, and pool their fund. Since his son does not have enough money, his son does not have sufficient fund, Mr. Sanjay considered taking a loan in India to cover his son's share, He then planned to remit the consolidated amount for the investment, right? So I've highlighted the key point. I have just underlined the key point which you need to know. Invest in startup company with his wife and son, right? And okay, so the question, please take a screenshot of this slide because 2 to 3 questions will be based on the same scenario. Please take a screenshot. Okay, few chapter I completed of which correspondent banking. Okay, okay, fine, fine. Great to know that. Great to know that my PDF help you and classes help you to understand the concept. Okay, great to know. Glad to know that. So, friends, I hope you have gone through this question. You have taken the screenshot also. Let me show you the first question for you. So, the first question is, which of the following action by Mr. Sanjay is a violation of the regulation? Opening a joint bank account abroad for overseas investment, consolidating remittance of family member for investment, taking a loan in India to fund a capital account transaction abroad, making an investment jointly with family member abroad. Type your answer in the chat. Let's say who can get it right. So this is the scenario in front of you. This is the question. So to answer, I have got option C. Number C. Option number C. So let's break it down step by step. First, can Mr. Sanjay open a joint bank account abroad to facilitate an overseas investment? Please answer. Please answer my question. Can Mr. Sanjay open a joint bank account abroad to facilitate an overseas investment? Type yes or no in the chat. What do you think? Can Mr. Sanjay open a joint bank account abroad to facilitate an overseas investment? What do you think? Yes or no? Can joint account be opened abroad to facilitate overseas? Yes, exactly. Very good. Resident Indians are allowed to open bank account abroad for facilitating legitimate overseas investment transaction. So this question is all about overseas investment. That Mr. Sanjay can do, right? I hope it is clear. Yes, he can invest, right? He can open a joint bank account abroad to facilitate overseas investment. My next question is: can Mr. Sanjay and his family consolidate their remittance for investment in UK? Can they consolidate their investment for remittance in UK? Type yes or no in the chat. Can they consolidate their investment? Can they consolidate their remittance for investment in UK? Consolidation, they मतलब सबको जोड़ना, सबको मिक्स करना, सबसे पैसा लेकर एक जगह जमा करना, वही होता है consolidation. That means the consolidation, right? So can they consolidate the amount for remittance? What do you think? Yes or no? Shraddha, through 2% are answering yes. Exactly. You are right. The answer is yes. Consolidating remittance of the family member is allowed, provided all family member are co-owner or co-partner in the overseas investment. Remember this key point. What I'm saying you that yes, consolidation is allowed, but there is a condition. Condition is that they should be co-partner. They should be co-partner or they should be co-owner. In what? In the overseas investment, ODI. Overseas direct investment. We are talking about that ODI. So option B, you can see option A, option B is also not a violation. Consolidating remittance of family member for investment, this is allowed. And opening a joint bank account, this is allowed, right? So option A and B are not violation, right? Now my next question is: can Mr. Sanjay take a loan in India to fund his son's share of the overseas investment? Can Mr. Sanjay take a loan in India to fund his son's share of overseas investment? Because his son does not have sufficient fund, right? So can Mr. Sanjay take a loan in India? Type yes or no in the chat. I request other person also to participate, because this will help clear their concept. Because in examination you should have a sound conceptual clarity. That then only you can tackle the BFM especially. So my question is, can Mr. Sanjay take a loan in India to fund his son's share of the overseas investment? Dinesh has answered no. What do you think? Yes, the correct answer is no. According to the RBI regulation, credit facility or loan cannot be used for capital account transaction. See, this is a kind of capital account transaction. You understand the difference between capital and current account transaction? So this is a capital account transaction, and you must remember, as per RBI regulation, credit facility cannot be used for capital account transaction, and this ODI is just a capital account transaction. I think you are familiar with this capital and current account. Current account transaction means just you are remitting money for medical purpose, for education purpose. That is current account. But since this is investment, which is a type of capital account transaction, आप कहीं प्रॉपर्टी खरीद रहे हैं विदेश में, या आप कहीं इन्वेस्ट कर रहे हैं विदेश में, all these are under the capital account transaction, right? So for that, RBI regulation violate. It says that credit facility cannot be used for that, right? So option C, as you can easily see, option C says that taking a loan in India to fund a capital account transaction abroad, this clearly violated. So this is incorrect. Now last one. Is it okay for Mr. Sanjay to make an overseas investment jointly with your family member? Option D, you can say, is it okay for Mr. Sanjay to make an overseas investment jointly with your family member? Type yes or no. Dinesh has answered yes. Okay, so you are saying that it is okay for Mr. Sanjay to make an overseas investment jointly with his family member. What do all the other members think? What do you think? Whether it is okay or not? Yes, absolutely. The answer is yes. Joint overseas investment with family member are permitted as long as all co-investor comply with the regulation. The condition is that all co-investor, right? All co-investor should comply with regulation. So option D is not a violation, right? Is not a violation. So let's summarize the fact. Option A is incorrect. Let me just summarize the fact which you have learned in this particular question. You can summarize it like this. Option A is incorrect. Why? Because opening a joint bank account abroad is allowed for facilitating legitimate investment transaction. Option B is incorrect because consolidating remittance of family member is permitted if all member are co-owner or co-partner. Option C is correct because loan from India cannot be used for capital account transaction such as overseas investment. Option D is incorrect because investing jointly with family member abroad is allowed if all parties comply with the rule. The question is regarding the violation. That is why option C is correct. Now here is a quick question for you, right? What is the maximum amount an individual can remit? I think we have already gone through it. That is 2.5 lakh, right? So was this question clear to you? On your screen, and you know that this recording of this session is available on our course, right? And I share the PDF also. Now let's start with the first question that we have. So the question says that, so this is a kind of case study like question. Some scenario has been presented before you and you have to answer the question based on the scenario. So let's start with the question. ABC Export, a company dealing in garments. So AB Export is a company dealing in a garment export, availed a packing credit loan of 40 lakh from XYZ bank. Right. So PCL, this company has availed PCL of 40 lakh from XYZ Bank to fulfill an export order. The shipment was successfully completed. An export bill was submitted to the bank. However, XYZ Bank allowed the post-shipment document to be sent on a collection basis without adjusting the PCL. Additionally, ABC Export used proceeds from a separate export order to settle the PCL and did not disclose that they had availed packing credit from other bank for the same export proceed. So this is the scenario. Three things are happening here, right? So what is the first thing? That he availed the ABC Export avail a PCL, packing credit loan, from XYZ Bank. Now shipment was completed. Now XYZ Bank allowed the post shipment document to be sent on a collection basis without adjusting the PCL. And the third thing which happen is that ABC export use proceed from a separate export order to settle the PCL. Now let's see the first question. I request you to please take a screenshot of the slide, right? Because most of the time we will use the data which is provided in this particular slide. So let's see the first question based on this case study. Right now we are in unit number 5 of BFM. The first question is, what is the appropriate way to liquidate a packing credit loan after goods have been shipped? Very nice question. That the what should be the appropriate way to liquidate a packing credit loan after the goods have been shipped? So let's see the option. The first options are option A, allowing post shipment document to be sent on a collection basis without adjusting the PCL. Option B, liquidating the PCL by allowing post shipment finance against export bill. Option C, continuing the PCL even after shipment is completed. Option D, using export proceeds from another shipment against which packing credit is availed with other bank. So this is the question. I hope you have all have read the question properly. Now, let me ask you one question. So, before we dive into the explanation, I have a quick yes or no question for you all. Do you think that the correct liquidation method involve direct adjusting the loan with the export bill? Type yes or no. Do you think that the correct liquidation method involve directly adjusting the loan with the export bill? Yes. So one response I am getting is yes. Okay, so great. I see a lot of yes response. Thank you for engaging. Yes, correct. Yes, obviously, the correct liquidation method involved directly adjusting the loan with the export bill. Correct. Now, let's break down this what this question is asking. Right. The core issue here is about liquidating the packing credit loan. You can clearly see what is the core issue here. The core issue here is about the liquidating the packing credit loan. Let me show you. Here it is. It is about the liquidating a packing credit loan, that is called PCL, right? After the goods have been shipped. Now option is suggests that allowing post shipment document to be sent on a collection basis without adjusting the PCL. However, doing this means that bank is not closing out the loan properly, because if we post shipment, if we allow the post shipment of the document to be sent on a collection basis, it clearly means that bank is not closing out the loan properly, which expose it to the credit risk and leave the loan unrecovered under the WTPCG. You know what is WTPCG? See, this is a kind of MCQ session, but I will make your concept clear. Our main objective is to have a conceptual clarity. That is why I'm explaining each and every option. So again, I'm repeating. The option A suggests that allowing post-shipment document to be sent on a collection basis without adjusting the PCL. However, doing this means that bank is not closing out the loan properly, right? Which expose it to credit risk and leave the loan uncovered under the WTPCG. What is WTPCG? Can anyone write on the full form? I'm also writing. The full form of WTPCG is watch list of trade, watch list of trade and post shipment credit guarantee. I think you all know about this WTPCG. We have covered it in the theory section. Watch list of trade and post shipment credit guarantee. So that is why option A is wrong, right? Because if we do such, bank is not closing out the loan properly, and obviously bank is exposed to the credit risk. So this is not an appropriate way. So option A is wrong. Now let's see the option number B. What option number B suggests? Let's see it. So option number B suggests liquidating the PCL by allowing post shipment finance against export bill. So this option proposes liquidating the PCL by allowing post shipment finance against the export bill. You know that this method ensures that once the shipment is completed, the bank adjusts the credit using the export bill as security. And this is the correct procedure. Yes, Ravanan, your answer is exactly correct. Very nice. Nice to see that you have answered correctly. you have a conceptual clarity over it. Option number B is the correct answer to this particular question, right? Again, I'm repeating that what option number B suggests. Option number B suggests that liquidating the PCL by allowing post shipment finance against the export bill. This is correct. Why? Because this method ensures that once the shipment is complete, suppose shipment has completed, right, the bank adjusts the credit using the export bill as security. So this is the correct procedure. Option C says that continuing the PCL even after the shipment is completed. So this is option number C. See, if you continue the PCL even after the shipment is complete, this does not resolve the underlying risk, as the bank remain exposed without proper liquidation. So that is why C is also wrong. And option D says that using export proceeds from another shipment against which packing credit is availed with another bank. So it further complicates the financial picture and can lead to duplication of credit. That is why option number B is the correct answer. Now, one question for you. Yeah, type yes or no in the chat. Is liquidating the PCL by allowing post-shipment finance against export bill the safest and most appropriate method? Type your answer, yes or no. What do you think? My question is liquidating the PCL by allowing post-shipment finance against export bill the safest and the most appropriate method? See friends, if you want me to talk in Hindi, because there are some person from south who feel difficulty in understanding Hindi. That is why I'm going in English, because this English language can help both of you, right? Either you're from north or south, doesn't matter, right? So my question, listen to my question properly. Is liquidating the PCL by allowing post shipment finance against export bill the safest and most appropriate method? Yes, yes, obviously, obviously. Just now we have talked about it. Just now we have talked about it. This is the, what do you think? That option B is indeed the correct option, because it ensures that bank risk is minimized by properly adjusting the loan against the export bill, right? So that is why option B is the perfect answer here. Yes, live class, the recording of live class is stored in the course, right? It is available in the course. You can watch it anytime as per your convenience, right? To summarize, the key takeaway is that a packing credit loan should be liquidated by allowing post-shipment finance against export bill, right? So you can see the answer of this question. The answer is here. The correct answer is option number 2, that packing credit loan should be liquidated by allowing post-shipment finance against export bill, ensuring that bank's exposure is minimized and the credit is appropriately closed, right? So I hope this make your concept clear. Now let me show you the second question regarding the same case study. The second question is in front of your screen, as you can see. So let me read the question. What is the potential risk if a bank send post shipment document on a collection basis without adjusting the PCL? What is the risk that the bank is exposed to? So let's see the option. Option A suggests the bank loses its cover under the WTPCG, that is whole turnover packing credit guarantee. Option B suggests exporter gain operational flexibility in fund management, reducing risk for the bank. Option C suggests the advance automatically convert to a domestic loan with penal interest rate. And option D suggests exporter become eligible for additional packing credit from other bank for the same proceed. So this is our next question. So what do you think? Please type whatever you think in the chat. So before we delve into the explanation, I would like to ask you a quick yes or no question to get your thought. Do you think that not adjusting the PCL could expose the bank to additional risk? Do you think that not adjusting the PCL, that is the packing credit loan, right, could expose the bank to an additional risk? Type yes or no in the chat. So if the bank does not, if the bank do not adjust the PCL, could it lead to the expose the bank to an additional risk? What do you think? Yes, obviously. Very nice. Thank you for participating. The correct answer is yes. Now let's break down the option and see what is the correct answer. The first option say that the bank loses it cover under the WTPCG, right, whole turnover packing credit guarantee. So it states that bank lost its cover when a bank send post shipment document on a collection basis without liquidating or adjusting the PCL. It fails to properly secure the advance with post shipment finance, right? It fails to properly secure the advance, and this oversight result in the bank losing its cover under WTPG. Obviously option A is the correct answer. Nice to see that all of you have got the correct answer. You have a conceptual clarity, very good, right? So that is why what happened, that this oversight result in a bank losing its cover under WTPCG, thereby exposing it to credit risk, right? And this is the key risk we want to avoid. Now option B suggests that exporter gain operational flexibility in the fund management, reducing risk for the bank, so which might imply a benefit. However, this is misleading because the primary concern here is the increased risk to the bank, not a reduction of the risk. And here what is written? Reduction of the risk. So this is wrong. Option C suggests the advance automatically convert to a domestic loan with penal interest rate. Here the claim is that the advance automatically convert to the domestic loan. This is not typically the case when documents are sent on a collection basis. Hence, such a conversion do not happen automatically. So this is also wrong. And option D suggests that exporter become eligible for additional packing credit from other bank for the same proceed. So finally, the idea is that exporter become eligible for additional packing credit for the same proceed, and this is not accurate in the context and does not directly relate to the risk of bank. So the correct answer is option number A. Option A is the correct answer. Now let me ask you one more question. Do you agree that failing to adjust the PCL exposes the bank to a significant risk by losing its WTPCG cover? Do you agree that failing to adjust the PCL exposes the bank to a significant risk? What do you think? Yes or no? My question is, do you agree that failing to adjust the packing credit loan exposes a bank to a significant risk by losing its WTPCG cover? Just type yes or no. That if a bank fail to adjust the PCL right, if the bank failed to adjust its PCL, it obviously, yes, correct, awesome, thank you for your input. Most of you agreed, which reinforced that option A is indeed the correct answer. So to summarize, let's summarize the fact which we have learned in this particular question. To summarize, if a bank send post shipment document on a collection basis without adjusting the PCL, that is packing credit loan, it loses its cover under the WTPCG, thus increasing its exposure to the credit risk. This is a crucial point to remember while managing the PCL, right? So I hope this make your concept clear. Now let's jump to the next question. This is the third question of today's session, and this is very important because it was asked in the previous year BFM examination. So let me read it for you. The question says that, let me zoom a little bit. Yeah, I hope this is fine now. Now the question says that XYZ Enterprise, an export firm with a strong track record, approached ABC Bank for a pre-shipment packing credit loan, that is PCL, under the running account facility. The firm has not yet lodged a firm export order or a letter of credit, but the bank, satisfied with the company's past performance, approved the request. Separately, XYZ Enterprise planned to export de-oiled cake. So here is the key point, de-oiled cake, for which they use locally purchased oilseed finance under the PCL. However, they delayed submitting the firm export order, and part of the proceeds from the local sale of oil was used to adjust the PCL. Please read it once or either take the screenshot of this slide. So what is happening, that XYZ Enterprise approached ABC Bank for PCL. Firm had not yet lodged a firm export order, but the bank, satisfied with the company past performance, approved the request. So bank has approved the request. Separately, XYZ planned to export de-oiled cake, for which they use locally purchased oilseed finance under the PCL. However, they delayed submitting the firm export order. So this is the key point. They delayed submitting the firm export order. Please take the screenshot of this slide because the case study, this is the case study. The question we are going to see are based on this scenario, right? So I hope you have read it carefully. Now let me ask you first question. The first question is on your screen, as you can see. Let me show you. So this is the first question. Under what condition can a bank extend the running account facility for a pre-shipment credit to the exporter? So you might be aware of this running account facility. So the question is, under what condition can a bank extend the running account facility? Here are the options. Option 1 say that the exporter track record must be satisfactory. Option 2 say exporter must provide letter of credit or firm export order before the advance is granted. Option 3 say bank must insist on prior submission of a license for commodities under the restricted category. And option 4 says the need for the facility must be established to the satisfaction of the bank. So 5 options are there before you. 4 options are there. And in this question, multiple option can be correct, right? It can be possible that 1 and 2, 2 and 3, more than one option can be correct. So type your thought in the chat, what you think is correct. Under which condition can bank extend the running account facility? So this was the scenario. So before we dive into the answer, let me ask you a quick question. Do you think banks should require exporter to provide firm export order or LC before granting an advance? Do you think that banks should require exporter to provide firm export order or letter of credit before granting an advance? Or can there be some flexibility if the exporter has a strong track record? Please type a strict requirement. Please type a strict requirement or flexible in the chat. What do you think? Is there any flexibility for exporter having a strong track record, or the bank should require exporter to provide firm export order before granting an advance? What do you think? If you think that there should be a strict requirement, please type a strict requirement. And if you think that bank should give flexibility, you should type flexible. What do you think? So interestingly, I am seeing that many of you lean toward a strict requirement. Let me again rephrase my question. My question is, do you think that banks should require exporter to provide firm export order or letter of credit before granting in advance, or can there be some flexibility? So some of you are leaning toward flexible and some of you are leaning toward a strict requirement. So the correct answer is flexibility, right? Now let us go through the first option. The first option say that the exporter track record must be satisfactory, right? So while a good track record is important and certainly a factor in the bank decision, the option is a given expectation rather than a strict condition. In our example, let me show you the example just we have discussed. In our example, this XYZ enterprise did have a strong track record, clearly written. Here you can see this XYZ has a strong track record, right? But the key condition for extending the facility lies elsewhere, right? Do you think that a strong track record alone is enough to secure pre-shipment credit? What do you think? Do you think that a strong track record alone is sufficient? What do you think? Yes or no? Now, let us see the option number 2. Obviously, it is no, right? A strong track record is not sufficient, right? So let's see the option number 2. Option number 2 suggests that exporter must provide letter of credit or firm export order before the advance is granted. So this option might sound rigid, but the condition is that while exporter don't need to provide the LC or firm export order immediately before the advance is disbursed, they are required to submit in within the time frame which is specified by the bank, right? So this condition ensures that bank risk is mitigated even if there is some initial flexibility, right? So bank allows some delay in submitting this document. Remember it, bank gives some time, right? What is option number 3? Option number 3 suggests bank must insist on prior submission of a license for commodity under the restricted category, right? So this condition applies only to the specific case involving commodities in restricted category and is not a general requirement. So it does not apply broadly to the scenario we are discussing here, right? And option 4 suggests the need for the facility must be established to the satisfaction of the bank. This is the key condition, right? The bank must be convinced that the exporter truly required the facility based on their export plan, cash flow, and overall business operation. So in this particular case which we are discussing, the XYZ enterprise delayed the firm export order. Clearly written here that this XYZ enterprise delayed, right? XYZ enterprise delayed the firm export order, right? So the bank still need a solid justification for this facility. So do you agree that the establishing the need for facility is crucial for risk management? What do you think? So in this particular question, we can see that option 2 is correct. Why option 2 is correct? Because the bank allow flexibility in timing. Remember, bank gives some flexibility in timing, right? For submission of LC or firm export order. And option 4 is also correct. Why? Because the bank need to be convinced that there is a genuine need for facility before it can extend the credit. So option 2 and 4 both are correct, right? Option 2 and 4 both are correct in this particular question, right? So does everyone feel clear about why option 2 and 4 are the right answer? Please type yes if you are following along, or no if you'd like further clarification. If you think that option 2 and 4 are correct, if you are satisfied, if you understand, then please type yes in the chat. Otherwise I will again explain. Type no. Because there are two important concepts here, that what and under which condition can running account facility be granted to the exporter, right? So 2 and 4 both are correct. What do you think? Are you convinced that 2 and 4 are correct? Is this concept clear? If it is clear, please type yes so that we can move to the next question. Yes. So here you can see that there are two important conditions to be fulfilled. That bank should give some time. That here flexibility is timing. This is the first point, and the second thing is that there should be genuine need for the facility before it can extend the credit. Two things must be fulfilled. Now let me move to the next question. Right. So this is the explanation of a running account facility. When the bank extended to the exporter, this is the condition. Now this is the second part of the question. The second part of the question is, in which case can proceed from a local sale be used to liquidate a PCL, right? So if you want to liquidate a PCL, then in which case proceed from a local sale can be used? So here are the option. Option 1, for any commodity export, provided the exporter submit a firm export order within 1 month. Option 2, when oil seed are purchased for exporting de-oiled cake and proceed from local oil sale are used within 30 days of the advance. Option 3, for commodities under the negative category, if the proceeds are adjusted within the bank policy period. And option 4, for selective credit commodity, provided LC are submitted within a reasonable period. So, in which case can proceed from local sale be used to liquidate a PCL? That is the question. So before we dive into this detail, I would like to ask you a quick question. Have you ever wondered why bank impose a specific timeline for adjusting a PCL using proceed from a local sale? Because if we take the proceed from local sale, then bank impose a specific timeline, right? So have you ever wondered that there is some timeline requirement? Obviously there is, right? So what do you think should be the correct answer to this particular question? In which case can proceed from local sale be used to liquidate a PCL? So let me go through the option. So the first option say, for any commodity export, provided the exporter submit a firm order within a month. So this option might seem plausible because firm export order are important. However, using proceed from a local sale to liquidate a PCL is not a blanket rule for every commodity to export. So do you think having a firm export order within 1 month is enough to justify using local sale proceed for any export commodity? What do you think? Do you think that I have taken a firm order within 1 month? Taking a firm order within 1 month is enough, is sufficient to justify using local sale proceed? Yes or no? What do you think? Obviously, it is no, right? It is no. So that is why option 1 is wrong. Now, option 2 says that when oil seeds are purchased for exporting de-oiled cake and proceed from local oil sale are used within 30 days of the advance. Yes, this is the correct option because in this scenario, PCL is specifically sanctioned for the purchase of oil seed intended for exporting de-oiled cake. So, why PCL is purchased? PCL is sanctioned for the purchase of oil seed. They want to purchase oil seed. That's why PCL was sanctioned. PCL, packing credit loan. This loan was sanctioned because to purchase oil seed, right? And for exporting de-oiled cake from oil seed, they will prepare de-oiled cake. The key here is that the adjustment using the proceed from local oil sale must be made within the 30 days. This is the key point. 30 days of the advance, right? So you should understand that this 30-day timing is very critical in this situation, right? I hope this is clear. Now option 3 say for commodity under the negative category, if the proceeds are adjusted within the bank policy period. So although adjustment period are important, these options don't apply universally. Here the keyword is negative category. This negative category is not relevant to our scenario here, right? And last option say for selective credit commodity, provided letter of credit are submitted within a reasonable period. That means it states that for selective credit commodity, proceed from local sale can be used to liquidate a PCL. So this option again introduce another condition, but it does not directly address the scenario involving oil seed, right? So that is why option number 2 is the correct answer. So let us recap what we have discussed. The only scenario where proceed from a local sale can be used to liquidate a PCL is when first thing oil seeds are purchased for exporting de-oiled cake, and the second point is that proceed from the local oil sale are used within 30 days of the advance, right? So this is the condition. So please tell, does everyone feel clear about why option 2 is correct? Type yes if you are clear, or type no if you like more explanation or have any question. Yes, option 2 is perfectly correct in this particular question. If it is clear, please type yes. That what are the two conditions? That the first thing is that oil seed are purchased for exporting de-oil cake, and the proceed from local oil sale are used within 30 days of the advance. These two conditions must be fulfilled. It ensures that bank risk is managed effectively and aligning with their policy on pre-shipment credit. Tell me if it is clear. I hope it is clear, right? Please type yes in the chat. If you have done with this particular question, keep those response coming in the chat. So let us jump to the next question that we have. So the next question, as you can see here, it is. So this is now a conceptual question. Let us go through it. What it say that ABC exports submit a demand bill or side bill in foreign currency to its bank on 10th March 2021, right? So a side bill was submitted by ABC Export to its bank on 10th March. Now, based on above, what is the notional due date for this side bill, and for how many days is the post-shipment advance available at a concessional interest rate? Right. So the first option is, and the option A say NDD April 4, 2021 and concessional period is 25 day. Option B say NDD 5 April 2021, concessional period is 26 day. Option C NDD March 25, 2021 and concessional period is 15 days. And option D NDD 4th April and concessional period is 26 day. So these are the four options provided before you, right? So what do you think is correct to this particular question? So before we jump to the explanation, I want to ask you a quick question. When you hear this side bill, right? When you hear this term side bill, clearly written, when you hear this term side bill, right? What do you think it implies before the due date? Type immediate if you think that payment is immediate, or type deferred if you think that there is some grace period. Type immediate in the chat if you think that payment is immediate, and type deferred if you think that there is some grace period allowed. Please share your response. When you see this word side bill, what do you think? Yes, I can see that. Great, I can see many of you mentioned. So you are mentioning immediate side bill. Yes, correct. Correct. Right. Demand bill means immediate payment. Obviously, it means immediate payment. Now, what about the question? Let us go through the option that we have. So option A says that NDD. So first of all, you have to understand that NDD means what? Notional due date, right? So can you tell me what is the NTP allowed? You have heard about this NTP, right? NTP is the notional time period, a transit period, right? So can you tell me what is the NTP? How much NTP is provided by bank for demand or side bill? You know about it? Please type the number of days allowed. What is the NTP for a demand or side bill? It is how many? 25 days. Yes, correct. It is 25 days, right? So let's go through the first option that we have. In the first option, as you can see, just wait a minute, let me erase it. Right. So in the first option, if the ABC export submit the side bill on 10th March, when it submitted the side bill, on 10th March. You can see clearly written, right? So NDD is calculated as 25 days from the submission date. So starting from the 10th March, if we add 25 day, tell me what date do we reach? So we will reach 4th April, isn't it? We will reach 4th April. 4th April 2021, right? So 4th April 2021. Now, if you talk about the concessional period, the bank provide the post shipment advance at a concessional interest rate for the entire NTP, which is 25 day in this case. So tell me what is the correct answer? Right, option A, I think clearly satisfy the condition, right? Isn't it? Because you see that if we add 25 day with 10 March, just add 25 day to 10 March, you will reach on 4th April. And that bank, for post shipment advance, the bank provide concessional interest rate for the entire NTP, which is 25 day. So option A is the correct answer. So tell me, I ask you one question. Why do you think the bank allow this 25-day period instead of requiring immediate settlement for a side bill? Type risk management if you believe it is for managing risk, or type operational reason if you think that it is due to processing time. My question is, why do you think the bank allow this 25-day period instead of requiring immediate settlement? Type risk management if you think that it is about managing risk, or type operational reason if you think that it is due to processing time. Why this 25 days is allowed? Because why I'm asking you question for your conceptual clarity, because sometimes this question may be asked, right? So you should also give response that what is the reason why this 25-day period is allowed, whether it is for risk management or there is some operational reason. So option A is correct, right? In this particular question, processing time. No. The correct answer is risk management, right? Which is the key reason, right? So here it is. The explanation. The explanation is that submission date is 10th March. NTP is 25 day. So the notional due date will be 10th March plus 25 will be 4th April, and advance is available at a concessional rate for the full 25 day, right? So is it clear? Is it clear why the correct answer is option number A? I hope it is clear. Let's move to the next question. Please type yes if it is clear. I will see. Let's see the next second question that we have. Right. The second question is in front of your screen. I hope the last question was clear, because once it is clear, then only you can go to this particular question. You can solve this one. Now let's see this question. Now the question is, XYZ Export submit a Ujans bill in foreign currency to its bank on 15th June 2021. The bill carried a Ujans period of 60 days. There is no grace period, right? What will the NDD for the Ujans bill? And how many days will the concessional interest rate be applicable? Two questions are there. First thing, you have to calculate NDD, and second, you have to calculate the how many days will the concessional interest rate will be applicable. Option A say NDD is 5th, NDD is on August 14, and concessional period is 60 days. Option B say NDD is on 10th June, 10th July, and concessional period is 25 days. Option C say NDD is on September 8 and concessional period is 85 days. And option D say NDD is on 8 September and concessional period is 60 days. So there are your option. So before we break down the solution, let me ask you a quick question. Where when you hear this term UJANS or DA bill, either we call it UJANS or DA bill, when you hear this word UJANS, right, with a UJANS period mentioned, do you think that the bank's calculation for the due date include an additional period beyond the UJANS period itself? Do you think that bank's calculation for the due date include an additional period beyond the UJANS period? Type yes if you believe that there is an extra period, or type no if you think that it's just the UJANS period. Let's see what you think. So do you think that when you hear this word UJANS, do you think that bank calculation for the due date include an additional period beyond the UJANS period? Yes, great, right? So great insight, right? Interesting viewpoints. Obviously, option A, yes is the correct, because in the case of UJANS bill, UJANS period is there, but in addition to the UJANS period, there is some extra period which is provided, right? So what is your response? What do you think is correct here? A, B, C, D? Because such question will be asked in the examination, and that is why we are doing practice here. No issue if you make it incorrect, because in the real examination it should not go wrong. That is our main motive. So option C you are saying. Okay, fine. So let's break down how we arrive at the correct answer. Let's break it down. So friends, that for a Eugen's bill, the first of all, you should have conceptual clarity. For Eugen's bill, I think this is, let me solve it here. Okay. Okay, fine. Just wait a minute. Okay. You know that for Eugen's bill, the bank calculate NDD. What is NDD? Notional due date. By adding NTP to the Eugen's period. What it does, it add NTP plus Eugen's period. Right? So in what is NTP? NTP is 25 days. We know it very well. 25 days is NTP. And Eugen's period given is 60 days. Right? And clearly written no grace period allowed. Sometimes there is some grace period also allowed. But here in the question clearly written that no grace period is allowed. Right? So what you will do? You just add these two. So what you will do? 25 days plus 60 day, which is 85 days. Right? This means the NDD is 85 days from the submission date. And that what about the concessional interest rate? The concessional interest rate apply for the entire period for which advance is extended. So the total period is 85 days, right? It apply to the entire period for which the advance is extended, right? So the concessional rate is available for 85 days. Now let's apply the date here. Let's apply the date. Although the exact calendar date require counting through the month, our key focus is on period. So let's start with the June 15. So let me show you here June 15, right? So first you write June 15 plus 85 days. So approximately you will reach, so 30 days, after 30 days you reach July 15. After 30 days you reach August 15. 60 days cover. After 25 day you will reach September 8. 8 September you will reach, right? 8 September you will reach. So this confirm that notional due date is 85 day from June 15 and concessional period is 85 day. Option C is perfect. Very good. Very nice to see you have responded correctly. Option C is the correct answer. I request other member to also type their answer, because such questions are most frequently asked in the examination, and you should have conceptual clarity. What to do, how to go about solving the case of Eugen's bill, how to go about solving the case of the uh, demand bill, right? So why do you think, right? So is it clear now why the answer is 85 days? That did everyone feel clear about how we arrive at NDD being 85 days? Type yes if you are clear, or type no if you'd like further clarification on any part of the calculation. Is it clear that how we have calculated this 85 days? If it is clear, type yes in the chat. Otherwise type no, I will again explain it. So two key concept which we have learned in this particular question is that this particular concessional period is applicable for the entire period, right? For the side bill it is NTP, and for the Eugen's bill it is Eugen's period plus NTP. I want responses from your side. I hope it is clear, right? I am getting that yes, it is clear. Very nice. Okay, fine. Now let's move to the next question. So the next question is on your screen. Very nice question it is. Let me explain it for you. Here is the scenario for the next question, as you can see. So the question say DEF export unexpectedly receive a large export order with USD 2 million for high value perishable goods. Since the order was not planned in their annual projection, DEF Export approved their bank seeking an adjustment in the standard inventory norm to manage the order effectively. Please read it again. This is the scenario presented before you. So what it does, it receives a large export order, right? So it is an exporter. It receives an order of 2 million US dollar, right? And the goods are perishable. Order was not planned in their annual projection, and DEF Export approaches their bank seeking an adjustment. So now, I hope you have gone through this particular question. Let's see the first option, first question based on this scenario. The first question is based on the bank policy. Which of the following statement best describe how the bank is likely to handle the inventory norm for DEF Export in this situation? Option A say that bank will enforce the existing inventory norm strictly regardless of the order's characteristics. Option B say the bank may relax the inventory norm by considering both the size and nature of the export order. Option C say that bank will relax the inventory norm only if the exporter holds a gold card. Option D say the bank will only consider relaxing the norms if additional collateral is provided by the exporter. So this is the case. I hope you have seen the situation also that it received a large export order of USD 2 million for high value perishable goods, right? Now tell me what do you think is the correct answer? Take a moment to think about it and type your initial answer in the chat. Which option do you lean about and why? Please type whatever you think is correct. No need to hesitate, right? A, B, C, D. Because you know the mistake which we'll do here, this will help you to understand your clarify your concept, and this concept you will use in the examination, which will help you to solve the question correctly, right? Okay, so I can see some interesting response coming in. Someone is saying C, option C. Someone is saying option D. Okay, great. Now let's break down the option one by one. Option A says that bank will enforce the existing inventory norm strictly regardless of the order characteristics, right? Enforcing norms without considering the specifics of the order does not usually align with a flexible banking policy, right? You are enforcing the norm without considering the specifics of the order. It does not usually align with a flexible banking policy. Bank often adjusts terms when the order is unusual in size or nature, especially for a perishable high value good. So do you think that a bank would stick rigidly to the norms even if the order is unexpected and perishable? What do you think? Yes or no? Do you think that bank would stick rigidly to the norm even if the order is unexpected or perishable? What do you think? That a bank would stick rigidly to the norms? Obviously no. Yes, correct, it is no. Now let's see the option number B. So option A is wrong. Option B says that the bank may relax the inventory norm by considering both the size and nature of the export order. So this option reflects a flexible approach. Bank understand that an unexpected large and perishable export order may require adjusted inventory norms to manage risk effectively. And the bank is likely to look at both the magnitude of the order and specific characteristics, right? Now let's see the option number C. Option number C says that bank will relax the inventory norm only if the exporter holds a gold card. While holding a gold card might offer additional benefit, in some cases, this option limits the policy to one specific condition, which is not typically the sole factor for adjusting inventory norm. So a gold card is not the only criteria, right? Gold card is not only criteria. Gold card is a criteria. While holding a gold card might offer additional benefit in some cases, the option limits the policy to one specific condition. So do you think a gold card is the only criteria for relaxing norm? The answer is no, right? And lastly, option number D. It says that bank will only consider relaxing the norm if additional collateral is provided by the exporter. See, requiring extra collateral might be a part of risk management, but in this scenario, the bank decision is more likely to be driven by the order characteristics rather than the extra collateral. Right. So, can you tell me, should additional collateral be the only basis for relaxing inventory now? The answer is no. Right. So, the correct answer is option number B here. Neither C nor D. The correct answer is option number B. Right. In this situation, the bank is likely to relax the standard inventory norm by considering both the size and nature of the export order. Since DEF Export received a large unplanned order for high value perishable good, the bank recognizes that a strict adherence to the standard norm may not be practical or fair. Instead, the bank will assess the risk by looking at two things. First thing they look at is the high size of the order, which is US dollar 2 million, which is a significant size of the order. And the second thing is look at the specific nature of the goods, which is the perishable goods, which require a special handling. This flexible approach help manage risk while supporting the exporter unexpected business opportunity. So does everyone feel clear about why option B is the best description of the bank likely approach? Please type yes if you understand, or type no if you have further question or need more detail. What do you think? Have you understood it? Why option number B is correct here? Okay, very good. I hope it is clear now. Now let's see the next question. I think one more question based on the same. Yeah. So this is another scenario. Uh, Before you, the question is GHI Export, a long-standing client with impeccable credit record, and gold card status, need to renew its existing packing credit limit. They have submitted the renewal request to the bank. At the same time, bank is known to give preference to the gold card holder and process different type of credit application within the space. So this question is basically focused on gold card status. If you know about it, then you can answer it quickly. So let's see the question. The key concept is that GHI exporter has a good credit record and a gold card status. Now, let's see the first question. Which of the following best describe the bank processing timeline for GHI export renewal request, and what additional preferential benefit might they expect as gold card holder? All of you, please try to answer. Option A say that the renewal request will be processed within 25 days, and as a gold card holder, they will automatically receive a higher credit limit. Option B say the renewal request will be processed within 15 days, and gold card holder are given preference in granting packing credit in forward currency. Option C say that the renewal requests are processed within 7 days, and gold card holder may be exempted from all collateral requirement. Option D say the renewal request will be processed within 15 days, but gold card status has no impact on processing speed. So before we jump into the answer, please take a moment to think about what you might expect in terms of processing timeline and benefit. Feel free to type your initial thought in the chat. What do you think the answer is? Feel free to type your chat, whatever you think is the correct answer. Feel free to type. So this question revolves around the gold card holder, right? What are the relaxation in processing time, and what are the benefits that they get? So let's break down each option. I see many of you leaning toward option B. That's interesting to see. Now I request you please type your thought in the chat. Right now, let's see the option. Let's break down each and every option. So first of all, option number A says that the renewal request will be processed within 25 days. Right. So although a high credit limit might be a potential benefit, the processing timeline here is too long compared to the guideline for renewal request. Bank usually process such renewal faster for premium client. Do you think that 25 days is a typical processing period for renewal request for a gold card holder? Please type yes or no in the chat. Is 25-day typical processing period? Type yes if it is and type no if it is not. What do you think? Is 25-day typical time period for processing the gold card for processing gold card status holder? The answer is no, right? So that is why option A is wrong. Now let's see the option number B. Option B says that renewal request 15 days, and the gold card holder are given preference. So this option aligning with the bank guideline. For renewal request, the processing timeline is 15 days. You should know it. How much is the processing timeline? It is 15 days, right? And that gold card holder, right, they benefit from preferential treatment, especially in granting of packing credit in foreign currency, right? So that's why option number B is the correct answer. 7 days is also wrong, right? 7 days. Option C says that it should be processed within 7 days. This is a very fast turnaround. It might seem appealing initially, but 7 days is too short based on the bank standard processing time, right? So 7 days is wrong. And option D says that it should be processed within 7 days. This is also wrong. Why option D is correct? Because it is very fast turnaround. It might seem appealing initially, but 7 days is too short based on the bank standard processing time, right? So why option B is correct? Is it clear now? I hope I'm audible and you are able to hear my voice. Is everything okay? Please type okay in the chat so that we can continue our session. Yeah, I hope everything is okay, right? You are able to see the screen, audio and video are okay, right? So the correct answer is option number B here. 15 days, and they are given preference by granting packing credit in the foreign currency. These two are the key condition, right? So please type okay if you think that everything is clear, everything is audio and video are okay for you, because I think there was slight disconnection in between. Okay, let me see some responses coming in. If everything is okay, please type okay in the chat. Now let us move to the next question. Now this is the second question scenario, because whatever question we are dealing in today's session are asked in the previous year, right? So please give a special attention. Yeah, I everything is okay. Please give a special attention to this question, because I have selected a few question. I have selected a few topic from where question have been asked in the previous year, and that is what I am presenting before you. So there is a large chance of this question again repeating in the examination, right? So the first question is, Sunrise Export, a leading exporter in India, has recently entered into a factoring agreement. So this question is regarding factoring agreement. So the Sunrise Export has recently entered into a factoring agreement with a financial institution. Under this agreement, the factor agrees to purchase export book debt generated from sale made on an open account basis. In addition to buying these receivable, the factor also monitored the credit extended to the exporter's customer and manages the sales ledger. Recently, due to slowdown in a customer payment, Sunrise Export is facing liquidity challenge. So this is the scenario. Now let's see the first question. The first question is, in the context of factoring, which service provider provided by the factor is most critical in immediately addressing the Sunrise Export liquidity issue? We know that this Sunrise Export faces some liquidity issue, clearly written that due to slowdown in customer payment, it is facing liquidity challenge. Now question is, which service provided by factor is most critical in addressing this liquidity issue? Let's go through the option. Option A says administering the sales ledger, because maintaining accurate record ensures efficient monitoring of all transactions. Option B says controlling the credit extended to the customer, because it helps in preventing future default. Option C says purchasing the book debt from Sunrise Export. And option D says advising on market trend and customer behavior. So which is the most, all these four options are the function performed by factor, but which is the most critical factor, critical function, right? That is what is asked regarding the factoring. A, B, C, and D. Type your thought in the chat. What do you think? So my first question is, do you think that accurate record keeping would solve immediate cash flow problem? Type yes or no. Do you think that immediate accurate record keeping would immediately solve cash flow problem? Just type yes if you think that immediate accurate record keeping would solve the liquidity problem, and if you don't think so, please type no. See, that is what option A is telling, right? Option A is telling what? Administering the sales ledger, right? Maintaining an accurate sales ledger is important for keeping track of the transaction. However, while it ensures record are up to date, it does not directly convert receivable into cash. We have receivable, it does not directly convert. In factoring, what we have something called receivable. I think you know about it, right? So we have receivable, but if you are maintaining our sales ledger correctly, it does not mean that our receivable will automatically convert into cash. So that is why option A is incorrect. Now my second question is, would you say managing credit risk directly address today's cash crunch? Managing credit risk would address the cash crunch? That is what option B is all about. Would you say that managing credit risk directly addressed cash crunch? Yes or no? What do you think? If we address credit risk, will it automatically address our cash crunch or liquidity issue? The answer is, that is what option B is about. It says that controlling the credit risk extended to the customer. You know that this service help mitigate future risk by preventing defaults. Yeah, yet it is more about reducing future risk and not about immediate liquidity. Because what problem this exporter is facing? Liquidity crunch, right? But suppose the option B says that if we control credit risk, our problem will be solved. That is not correct, because you know that we are controlling credit risk only, right? It will not provide immediate liquidity needs. So that is why option B is also incorrect. Now, option C says that purchasing the book debt, right? So, does converting receivable into cash sound the fastest way to resolve cash crunch? Tell me, what do you think? Option C. If we convert the receivable into cash, we have receivable, right? You know it very well. We have receivable. So, if we convert the receivable into cash, would it solve our cash crunch issue? That is what option C is saying. Purchasing the book debt from the Sunrise Export. Does converting receivable into cash sounds like the fastest way to resolve a cash crunch? Let me know your thought in the chat. Type yes or no. That's what option C is saying. Now, it is saying purchasing the book debt from the Sunrise Export, right? Obviously, yes, right? Because you know this is the core function of factoring. You see this option C. This is the core function. This is the core function of factoring, right? Why? Because by purchasing the exporter receivable, the factor convert future cash inflow into immediate cash. This directly address the liquidity issue, especially when customer payment are delayed. Right? That is why option C is the perfect answer here. Because you know this Sunrise Export is facing liquidity issue, and when this factor purchase the book debt, it will automatically solve the problem. And option D says that advising on market trend and customer behavior. While you know that strategic insight are valuable for long-term business performance, they do not directly solve short-term liquidity as well. Because what is the main issue here? The main issue is here short-term liquidity problem, right? If we provide insight, it does not solve our issues, right? So based on our discussion, the correct answer is option number C. You should know that the key purpose of factoring is to convert receivable into cash. What is the meaning of receivable? You know, what is the meaning of this term receivable? You might heard this term again and again, receivable. Receivable just means exporter book debt, right? So in the case of Sunrise Export, where delayed customer payment have led to liquidity issue, because you know that this Sunrise Export is not receiving payment on time, and that is why this delayed customer payment has led into this liquidity issue. So in this case, the most critical service provided by the factor is purchasing this book debt. You know, besides this purchasing of book debt, factor also provide other service like administering the sales ledger, controlling the credit extended, advising on market trend. But in this particular case, right, option C is the perfect answer. Does everyone feel clear about why purchasing the book debt is the critical service in this situation? Please type yes if it is clear, or no if you have any further question or need further clarification. Because you know these questions are super important. They are asked every year in the examination. You should know the function performed by factors. So if it is okay, please type yes so that we can move to the next question. I hope it is clear. You all have understood that what is the basic thing. Yes, okay, very nice. Let's see the next question we have. So this is the next question, very interesting one. Please go through it. So here's the scenario. If you have any doubt, please feel free to chat in the put your doubt in the chat box. Now the question is: Global Trader Private Limited, an Indian importer, needs to make an advance remittance of $1 1,80,000 for importing a specialized machinery. The overseas supplier insists on advance payment and has provided detailed documentary evidence showing the cost of good. Global trader hold a valid exchange control copy of the import license and goods are not on the negative list. So this scenario has been presented before you that he is an Indian importer. He need to make an advance remittance of this much amount for importing this machinery, and the supplier insists on advance payment and has provided detailed documentary evidence showing the cost of good, and this global trade hold a valid exchange control copy of the import license. I hope you have gone through this scenario. Please take a screenshot of it because most of the question will be based on this scenario only, right? So let me tell you the first question. The first question is based on the AD's guideline. You know what is AD? AD stands for authorized dealer. Based on the AD's guideline, which of the following is correct regarding the processing of global trader advance remittance? Option A says that the remittance cannot be processed as it is below the threshold and require additional verification. Option B says the remittance is allowed without any requirement for a guarantee provided the documentary evidence and valid import license are verified. Option C say that the remittance must be accompanied by an irrevocable standby LC since it exceeds 1 lakh US dollar. And option D say the remittance is only allowed if a guarantee from an international bank is obtained regardless of the amount being under 2 lakh US dollar. This is an advance remittance which an importer is giving to a foreign supplier. Take a moment to think about it. Which option might be correct? What do you believe and why? Please type your answer A, B, C, or D in the chat. Don't hesitate to type the correct answer because once you think whatever you say correct, please type. We will see the thought process. We will how to go about solving such type of problem, right? What should be the thought process? What is the concept behind it? Okay, so let's discuss this particular question. Let's discuss each and every option. So let's start with the option A. So option A says that the remittance cannot be proceed as it is below the threshold and require additional verification. Do you think that below the threshold would cause extra hurdle? Type yes or no in the chat. Do you think that below the threshold would cause extra hurdle? See, the guidelines actually permit remittance up to, what is the guideline permit? No, yes, the guideline permit remittance up to US dollar 2 lakh. This is the guideline permit that you can permit remittance up to US dollar 2 lakh when proper documentation is provided. And the global trader had supplied detailed documentary evidence and he also hold the import license, right? So the option is that remittance cannot be proceed as it is below the threshold limit. No, this is wrong because you know that this is the limit. 2 lakh US dollar is the limit. The guideline actually permit remittance up to 2 lakh. That yes, up to 2 lakh remittance can be done. So the option is wrong, right? Option B says that the remittance is allowed without any requirement for a guarantee. Now, let me ask you a question. The question is, does converting your receivable into cash immediately without extra guarantee sound like a standard benefit for such a transaction? Type yes if you agree or type no if you have reservation. Now, let me again rephrase the question. You are converting receivable into cash immediately. Does converting your receivable into cash immediately without extra guarantee sounds like a standard benefit for such transaction? That is what option B is saying. Now, see it. What it say that remittance is allowed and without any requirement for a guarantee, right? So basically what you are doing, you are converting the receivable into cash, right? So this option align perfectly with the guideline. You know, advance remittance up to US dollar 2 lakh, right? Advance remittance up to US dollar 2 lakh are allowed once the importer provides satisfactory documentary evidence, first condition, including the cost detail and the supplier insistence on advance payment, right? And he should also hold a valid import license, right? So you should know that in no any additional guarantee is needed for amount under US dollar 2 lakh, right? So this is all about option B. Option C says that the remittance must be accompanied by irrevocable standby letter of credit since it exceeds 1 lakh. So what is the threshold? The threshold is 2 lakh dollar, right? Not 1 lakh. So this option is incorrect. And option D says that, right, the remittance is only allowed if the guarantee from international bank is obtained, right? So this is also incorrect, right? So the correct answer is option number B. Based on our discussion and guidelines, the correct answer is option number B. So let me give you the key point here, that according to the authorized dealer guideline, advance remittance up to 2 lakh dollar can be processed when the importer provide, first thing, the first condition is that he should provide what? You can see the answer here, option number B is here, right? So the first condition is that he should provide satisfactory documentary evidence, the first thing is that, and no additional guarantee is required. In this case, no additional guarantee is required, right? Below US dollar 2 lakh, no additional guarantee is required, right? So since global trader is remitting how much? He is remitting, this firm is remitting $1,80,000 and all conditions are satisfied. So the remittance is allowed without any additional condition. So does everyone understand why option B is correct? Type yes if it is clear, or type no if you have any question. Right, based on this scenario we have discussed, since he is remitting $1,80,000, so that's why option number B is correct. Is it clear now? Okay, okay, fine, fine. I see that this concept is clear to you, that two things are necessary, that satisfactory documentary evidence and valid import license. If, and the threshold limit is 2 lakh, 2 lakh dollar, right? If these conditions are being followed, then nothing extra is required, no any guarantee is required to do this advance remittance for the import, right? I hope it is clear. Please, all of you, please type yes in the chat. Now let's see the next question. So this is another question before you. Let's go through it. So the question is, Innovate Import Limited, an Indian importer, planned to make an advance remittance of US dollar 3 lakh for a bulk order of raw material. The supplier has provided the necessary cost documentation and insists on advance payment. Innovate Import hold all required license and is compliant with exchange control regulation. However, as the remittance exceeds 2 lakh, the bank internal policy require additional reassurance. Right, just now we have talked about it. So please read it once, that here the advance remittance of 3 lakh dollar is being made. In the previous case, yes, I think previous question was clear to you. Now in this case, you can see that remittance of 3 lakh dollar is being made. In the previous case, we have seen 1,80,000 was made. Now let's go through the question. The question says, under the AD's guideline, which condition must Innovate Import Limited satisfy to process this advance remittance of 3 lakh dollar? So conditions you have been asked. Option A say no additional condition are required beyond the documentary evidence and valid import license since the amount is below 5 lakh. Option B say an irrevocable standby letter of credit or a guarantee from an internationally reputed bank must be provided unless a board approved policy apply to waive the guarantee requirement within 2 lakh dollar to 5 to 50 lakh dollar. Option C say the remittance can only be proceed if the supplier agree to lower the remittance amount to under 2 lakh. And option D say a waiver from Ministry of Finance is required because the remittance amount exceed 1 lakh dollar. So please type your initial answer A, B, C or D in the chat. What do you think? It is the extension of the previous question which we have discussed. The threshold was 2 lakh, you know it very well, right? So what happen if the advance remittance is larger than 2 lakh? What are the conditions to be fulfilled? That is what the question is asking. Okay, please type. This is a quite easy question, right? We have just discussed it. I provided you a hint also. In the previous question, I have provided you sufficient hint, right? So you can easily answer it. Okay, so let us go through the option. Let's discuss each option in detail. Option A says that no additional conditions are required. See, while documentary evidence and valid import license are necessary, they are not sufficient when the remittance exceed $2 lakh. You know this is the threshold, $2 lakh. When the remittance exceed $2 lakh, this is not sufficient, right? The guideline specifically require extra assurance, right? So it is say that no additional condition are required, so this is wrong. Option B says that an irrevocable standby letter of credit. So this option accurately reflects the AD's guideline. You know that for advance remittance exceeding $2 lakh, right, bank require an additional guarantee, either an irrevocable standby letter of credit or a guarantee from an internationally reputed bank. And also there is a provision for a board approved policy, right, to waive this requirement within this range. If the board approval policy is there, that yes, that we have to waive, they can waive the requirement, guarantee requirement under the limit $2 lakh to $50 lakh, right? So does the idea of providing a guarantee or letter of credit sounds like a practical method to secure such a transaction? Obviously the answer is yes. That is why option B is the correct answer here. So if the advance remittance amount exceed $2 lakh, so an irrevocable standby LC or an board approved policy, right, should be there, right? Then only this condition must be satisfied to process the advance repayment, right? This acts like an extra security. In this case, this condition act like an extra security, right? So option C says that the remittance can only be proceeded if the supplier agree to lower the remittance amount to $2 lakh, right? So this is option C. This option is not correct because the importer is not required to reduce the remittance amount. Instead, they must meet the additional guarantee requirement. No guarantee requirement under $2 lakh, guarantee requirement above the $2 lakh. And what are the possible options we have just seen? And option D is also correct, also incorrect, because you know that Ministry of Finance, this option misrepresent the condition, right? Ministry of Finance is nothing like that. There's nothing like that, right? So you must remember that since the remittance is amount is $3 lakh, which exceed the threshold, which is $2 lakh, so the bank internal policy require additional assurance, right? So this is the correct answer, and let me show you, right? This is the correct answer. Option B is the correct answer. So does everyone understand why option B is correct answer in this particular question? Please type yes in the chat if it is clear. If the concept is clear, what are the conditions to be fulfilled? Basically, here extra assurance is required, extra guarantee is required, right? Either in the form of irrevocable LC or in the form of we have just talked about the irrevocable LC here, and the second form they can do is the board approved policy should be there, right? So this is the condition. Now let's see the next question. I hope everyone has understand the previous question that threshold limit is $2 lakh. Below $2 lakh, just import license copy and documentary evidence is sufficient, and above $2 lakh, do you require an extra guarantee? That is the main point of the question. Now let's see this question. The question is ABC Import Limited, an Indian importer, had remitted foreign exchange for an import transaction through an LC. Once the goods have arrived in India, ABC Import submit to his authorized dealer an exchange control copy of the bill of entry along with a postal appraisal form. And the AD is required to verify and record this detail. So this is the scenario presented before you, that that foreign exchange has been remitted through an LC. Goods has arrived in India. ABC Import submit to its authorized dealer an exchange control copy of the bill of entry along with the postal appraisal form. Right, now let's see, let me show you the question. The question is, which of the following is not a part of the AD's responsibility in processing the evidence of import for this transaction? So which of the following is not a part of the AD's responsibility? That's the authorized dealer responsibility. Option A say cross checking the particular in the bill of entry with the detail of the LC. Option B say issuing an acknowledgement slip containing all detail of the bill of entry received by the receipt from the importer. Option C say preserving the original bill of entry or its summary for verification by the internal auditor or RBI inspector. Option D say waiting for a separate BEF statement from the importer before recording the evidence of import. So which is not a part of the AD's responsibility? This question is regarding this. Take a moment to think about it, and when you are ready, type your answer A, B, C, or D in the chat. So not a part. Read the question carefully. It is not a part I've been asking. Means three options should be a part and one option should not be the part. Right. So this question is based on evidence. What are the responsibility? Right. So while you are thinking about your answer, here is an intermediate question for you. Why do you think it is important for the AD to preserve the original bill of entry or summary? Right. Obviously this preservation is required, right? So some of you are answering option number D, right? Thanks for sharing your insight. Now let's look at the correct answer for our main question. Let's break down. Let's see the option number A. Option number A says that the AD is indeed responsible for cross. Yes, this is correct. The AD is indeed responsible for cross checking the particular in the bill of entry with the detail of the LC. This is the key verification step. Option B, it says that issuing an acknowledgement slip containing all the detail of the bill of entry, right? So this is also a part, because issuing an acknowledgement slip that record all detail of the bill of entry is also a part of the AD's responsibility. So this is also correct. Now, preserving the original bill of entry or its summary for verification by the internal auditor and RBI inspector. Yes, this is also correct, that the AD must preserve the original bill of entry or its summary to facilitate future verification. And option D says that waiting for separate BEF statement. However, AD is not required to wait for a separate BEF statement from the importer. With the you have heard about this IDPMS. You might have heard about this IDPMS. With the operationalization of this IDPMS, all outstanding import remittance are reported directly into the system. Since this system has been operationalized, now no need to have a separate. There was a requirement of separate BEF statement, but once this system has come into picture, right, then there is no need for all. What happened, all outstanding import remittance are reported directly into the system, and separate BEF statement has been discontinued. So option D is not a part. So great to see that you have answered it correctly, right? Yes, very good. Yes, RBI audit is required. Very good. Yes. So option number D is the correct answer. Earlier, this used to be a requirement, that is a separate BEF statement, but now there is not so requirement, right? So the correct answer is option number D. That is, waiting for BEF statement is not a requirement. So great job, everyone. Right. So does anyone have any question or comment about this process? I hope it is quite clear or quite easy to understand. So let us move to the next question. So is it clear now? Please tell me, what are the conditions to be fulfilled? What are the responsibilities of AD we have just discussed now? So option D is not a responsibility, right? Earlier it used to be. Please type yes if it is clear. Let me move to the next question. So here it is. The next question is in front of your screen. Yeah, here it is. XYZ Limited is a company listed on a stock exchange with a net worth of 150 crore as per its last balance sheet. For an import transaction, XYZ Limited remit foreign exchange amounting to US dollar 9 lakh. Sorry, it is 9 lakh. Instead of submitting the exchange control copy of the bill of entry, the company provided a certificate from its CEO certifying that goods for which the remittance was made has actually been imported to India. So this is the condition here. Yes. I will provide. Yes, I'm looking forward to conduct class on the in the morning. So if you all of you agree that 7:30 to 8:30 or 7 to 8 is okay for you, then we can conduct more classes, right? If all of you are satisfied with the timing, because we can take the classes in the morning only, right? If you are okay with 7 to 8 or 6:30 to 7:30, whatever you say, or okay, yes, we can conduct such classes, because solving such type of question, solving such type of question will provide you insight. You will no need to what happened. Yes, I will try, because this way, this case study type question will help to retain the concept, right? Okay, I will share the detail. Yes. So now let's see this question. This question is regarding the as you can see clearly, this question is about XYZ Limited is a company listed on a stock exchange. Net worth is 150 crore. An import transaction, it remit foreign exchange amounting to 9 lakh. Instead of submitting the exchange control copy of the bill of entry, the company provided a certificate from its CEO. Right. So based on the guideline, which of the following statement is correct? So let me show you the question. Based on the guideline, which of the following statement is correct regarding the AV's acceptance of XYZ Limited evidence of import? Right. Option A say that AD must reject the certificate and insist on the exchange control copy of the bill of entry regardless of the company status. Option B say the certificate from the CEO is acceptable only if it is accompanied by the original bill of entry. Option C says the certificate from CEO is acceptable provided that the remittance is less than $1 lakh and the company meets the net worth requirement. And option D say the certificate is acceptable only if it is issued by the auditor, not the CEO. So what do you think is correct? Take a moment to review the question. So let me show you the scenario once more that net worth is 150 crore, remitted 9 lakh foreign remittance. Instead of submitting the exchange control copy, the company provided certificate from CEO. Now the question is which statement is correct regarding the acceptance of XYZ Limited evidence of import? Okay, so one answer I am getting is option number A. So while you are considering your answer, why do you think that net worth of a company and amount remitted play a role in determining whether the alternative evidence like a certificate from CEO is acceptable? So here the two key things are, the first thing is net worth of a company and the second thing is amount remitted, right? These two things. So answer I'm getting is option A. So let us see, let us go through the each and every option. You know, these two things are super important: net worth criteria, and the second thing is certificate from CEO. So let me say, let me tell you the correct answer to this particular question. You know that it has net worth of how much? 150 crore, right? Net worth is 150 crore, you can see, which is well above the, and what is, you know, what is the minimum requirement? The minimum, can you tell me what is the minimum net worth for a company to be listed on a stock exchange? That is 100 crore, right? 100 crore is the minimum net worth, minimum requirement for a company to be listed on a stock exchange. And this qualify the company under the guidelines that allow alternative evidence. So if a company has a net worth larger than 100 crore, right, it can be able to, right? So this qualify the company under the guideline that allow alternative evidence. Now let's talk about the remittance limit. The guideline says that if the foreign exchange remitted is less than 10 lakh, listen me carefully, if the, just wait a minute, I think it is, yeah, 10 lakh. So guideline says that if the foreign exchange remitted is less than 10 lakh USD, 10 lakh USD, right, or its equivalent, the AD may accept a certificate as an alternative to the exchange control copy. So the first thing is that net worth should be larger than 100 crore. Second condition is that it should be less than 10 lakh. What should be less than 10 lakh? That means advance remittance. In this case, what it is? 9 lakh. So this condition is also satisfied. So in this scenario, we can say that XYZ Limited remitted 9 lakh, which is below the US dollar 10 lakh threshold. So this is the threshold, right? And the certificate provided by the CEO therefore meets the criteria. Now let's go through the option. So the option number A says that the AD must reject the certificate. No, this is wrong. Option A is wrong. Option B says that the certificate from CEO is acceptable only if it is accompanied by the original bill of entry. No, this is also wrong, right? Option C says that, right, that the certificate from the CEO is acceptable provided that the remittance is less than. Yes, correct. Net worth requirement is fulfilled here because, you know, 100 crore is the, it should be above 100 crore and it has 150 crore. The first condition is fulfilled, and remittance is also $9 lakh, which is less than the $10 lakh. So though both the conditions are fulfilled, that is why the certificate from CEO is acceptable. So this certificate can act like an alternative to the bill of entry. You know, this bill of entry, every importer has to provide this bill of entry, right? But if it does not have, then they can have the certificate from the CEO, but two conditions must be fulfilled. The first condition is that net worth should be higher than 100 crore, and second condition is that the remittance should be less than 10 lakh dollar, right? So that is why option number C is the perfect answer for this particular question, right? So is it clear? Option D says that certificate is acceptable only if it is issued by the auditor, not the CEO. This is wrong, right? Is it clear? Why option C is correct? Please type yes, it is clear, or if you have any question, right, please type. Okay, I hope, yeah, it is clear. It is clear now. Now let's see the last question of today's session. This is the last question of today's session. Although we have many questions left, we will try to cover in the next session. Right. This is the last question. Let me show you the question. This question is about take equip an exporter of industrial machinery, ship capital good to global industry under supplier credit term. Instead of immediate payment, global industry is granted a credit period up to 3 years from the shipment date. To improve liquidity, Take Equip finance the shipment by discounting its bill with the bank, remaining liable if global industry fails to pay on maturity. The shipment value is $40 million, okay, which is within the 50 million limit per transaction. Again, read it carefully. Capital good is shipped to global industry, right, under supplier's credit. So here is the keyword, supplier's credit. So obviously, Take Equip is exporting something to global industry. So global industry have to make the payment, but he is granted a credit period of 3 years from the shipment date. And to improve the liquidity, Take Equip finance the shipment by discounting it bill. So what it does, Take Equip finance the shipment by, you know about discounting it bill? What Take Equip does, Take Equip has the bill with it. So it goes to the bank, it tells the bank that take this bill right now and finance me at discount, right? And when the bill mature, you take collection from the global industry. That is what is happening here, right? And the shipment value is how much? $40 million. Now let's see the first question. Given the goods are shipped are the capital good, clearly written that goods are capital goods. What is the applicable credit period under supplier's credit term? And why is this said the way? Option A say up to 1 year or the operating cycle, whichever is less, because capital goods need a shorter credit period. Option B say up to 3 years from the shipment date to accommodate the longer financing need of capital goods transaction. A fixed period of 6 months, irrespective of the types of good to reduce the risk, and negotiable without any set limit. So what is the applicable credit period under supplier credit term? That is the question. And why is it is said this way? So what do you think? A, B, C, or D? Given the goods is of capital goods. So before you answer this question, why do you think that transaction involving capital good might require a longer credit period compared to other type of good? Can you tell me why transaction involving capital goods required a large longer credit period as compared to other types of goods? Obviously, we can see that the case was capital good. What do you think? Actually, the answer to this question is written in the scenario itself. That the scenario which we have seen, in that also the answer was written. So I think most of you can easily answer it. A, B, C, or D. What do you think? Yes, more operating cycle. Yes, correct. Industrial machinery. This is the perfect example of capital good, right? So the capital good, like the suppose industrial machinery, which was shipped by Take Equip, it has a higher value and also it has a longer payback period, right? So to account for these two factors, because the value is higher and the second reason is that payback period is also higher. So to account for these factor, supplier credit it extended up to 3 years from the shipment date, right? So the answer is 3 years. Option number B is correct. The supplier credit is extended up to 3 years. This extended period is specifically designed to provide sufficient time for the importer to generate return from the use of this high value good, right? Because these are high value good, so importers should be given time to generate return, right, thereby facilitating their ability to meet the payment obligation. Obviously they have to pay more, right, because the goods are of high value. So it provides the importer a sufficient time to generate revenue, right? Now let's see the option A and C. So option A says that a sorted period of one year. Option C says that 6 months. So which are not in line with the need for the capital good transaction, right? So that is why option this is the correct, right? So option number B is correct. You should remember that it is 3 year for capital goods, right? And here is then where the supplier and bank agree to a trade credit period. Both are financed by AD category 1 bank, and we need to understand the trade credit period of this shipment. So let's see the question. So this is the scenario before you. Now let's see the question based on them. So the question is, which of the following statement is correct regarding the trade credit period and possibilities of any extension? So we have been provided two shipment here, and we have been asked for their trade credit period and extension, right? So let's see the option. So let's see the option. First option say that shipment A credit period will be is 12 month, and shipment B credit period is 36 month. Extension may be negotiated for both. Option B say shipment A credit period is 9 month and shipment B credit period is 36 month. However, no extension beyond this period is permitted by bank. Option C say shipment A credit period is 9 month, shipment B credit period is 24 month. Extension can be permitted only for shipment B. And option D say shipment A credit period is 12 month, shipment B 36 month, and only shipment A period is fixed. So let me show you what is shipment A and B. You can see clearly written shipment A is regarding the non-capital good and shipment B is regarding the capital good, right? So there are four options given. I request you to please take a screenshot of this slide, because of based on this scenario only we have been provided the question. Shipment is regarding the non-capital good and shipment B is regarding the capital good, and these are the options. So take a hint and just type whatever you think is correct into this particular question. So first of all, let me talk about what is the meaning of this term trade credit. Do you understand the meaning of this term trade credit? Let me tell you. Think of it like a loan period the bank gives to importer to pay for the goods. So trade credit, you can think the trade credit like a loan period, right? Which bank give to the importer. And we know that A is a non-capital good. We know that A is a non-capital good and B is a capital good, right? And what is the meaning of trade credit? Trade credit means that loan period a bank gives to importer to pay for the good. And you know what is the meaning of non-capital good? Non-capital good means regular item you might use day to day, right? So can you tell me what is the trade credit period of non-credit good? Whether it is 12 month, whether it is 9 month, option B 9 month, option C I say 36 month, or option D I say 24 month. What is the trade credit for non-capital good? Please type your answer in the chat. Is it 12 month, 9 month, 36 month, or 24 month? We are talking about the non-capital good. What is the trade credit for non-capital good? 12 month, 9 month, 36 month, or 24 month? What do you think? So because the shipment A is regarding the non-capital good, right? Non-capital good means what? Means regular item we might use day to day. So you must know that for non-capital item the trade credit period is how much? It is 9 months, right? For non-capital item, for non-capital good the trade credit period is 9 months. So option number B is correct, right? Now let's talk about the shipment number B. Shipment number B, as you can see, is regarding the capital good, right? Shipment B is the capital good. So what is the meaning of capital good? Capital good means, right, capital good means like machinery, long term equipment, right? So can you tell me what is the trade credit period for capital good? I am providing you four options. Just let me know that what is the trade credit period for capital good. So the first option I'm saying like 12 month. Is it 12 month? Option B 9 month. Is it 36 month or is it 24 month? Tell me what is the trade credit period for capital good? That is our shipment B, which is for capital good. Do you know? Do you know what is the trade credit period for capital good? Whenever I say trade credit period, it means like a loan period the bank give to importer to pay for the good. That is called trade credit. So what is the time period for trade credit for capital goods? Like the shipment of B in this particular case. Please type whatever you think is correct. Is it 12 month, 9 month, 36 month, or 24 month? I think I am audible to you, right? Please type whatever you think. Don't hesitate to type your answer, right? So it is 36 month, right? It is 36 month. Correct answer is 36 month. For capital good, it is 36 month, and for non-capital good, it is 9 month, right? So let us see the option. So we have the 4 option which has been given, right? So now tell me which one is correct, A, B, C or D. 4 option you can see easily that option A say shipment date credit period is 12 months. This is wrong. Option B say shipment date credit period is 9 months and shipment B credit period is 36 months. Right. So this may be correct. Option C say 9 months and 24 months. This is wrong. And option D may be correct. But what about the extension? Do you know whether, so we have eliminated 2 options, that is option A and C. What about B and D? Tell me, out of B and D, which one will be correct? Whether extension period is permitted or not permitted? What do you think? Can you tell me, in the case of capital good, is any extension period permitted? Any rollover or extension is given or not? It is not. Remember, for capital good, yes. So option B, you are saying option B is correct. Okay, very good, very nice. So you must know that for capital good, extension is not permitted, right? For capital good, extension is not permitted because the AD category 1 bank, they don't allow to give any rollover or extension beyond the agreed period. So for shipment B, even though the period is long, it is fixed at 36 months. So what the option B say? Option B says that no extension beyond this period is permitted by the bank. Right. So the correct answer is option number B, right? Because there is no possibility of extension, right? Okay. Now let's see the next question. The second question of today's session, you can see on your screen. There is a Global Trade Private Limited is planning an import transaction and approaches an AD category 1 bank for trade credit. The transaction involves either capital or non-capital good with a total value of $50 million equivalent. So this is the scenario presented before you. So here you can see the 2 term, right? One is the trade credit, another is the guarantee, right? So this is the question for Global Trade Private Limited. What is the trade credit limit? The trade credit limit is 50 million US dollar. This is the limit of trade credit. Okay. Now let's see the question. The question is, you can see this is the question. I hope the question is visible to you. Let me zoom out a little bit. I hope this is visible to you. Yeah. Now question is that Global Trade Private Limited seeks trade credit for import transaction valued at $50 million. In addition to financing, they require a guarantee from the bank to secure the credit facility. Which of the following accurately reflect the bank's guideline on the trade credit limit and guarantee period? So this question revolves around 2 things. The first thing is trade credit limit and the second thing is guarantee period. You know what is the trade credit limit? The bank can finance up to 50 million US dollar or equivalent per transaction. That means no matter what, the bank won't provide more than this amount for a single deal. And the second thing is guarantee period. You know, the bank may issue a guarantee such as LOU. You know what is LOU? LOU stands for letter of undertaking. So bank may issue LOU for a maximum period of how many years, that we will discuss. Now let's see the option. So the question is asking which of the following accurately reflect the bank guideline on trade credit and guarantee period. Option A say the bank may extend trade credit beyond to $50 million if the importer provide additional collateral, and the guarantee period can be extended beyond 3 years upon request. Option B say the bank can provide trade credit up to $50 million or equivalent per transaction, and it may issue a guarantee for up to 3 years from the shipment date. Option C say the bank is allowed to finance any transaction value as long as the guarantee is issued for a period not exceeding 1 year. Option D say that the bank can finance up to 50 million US dollar equivalent. However, the guarantee period is only available for non-capital good transaction, not for capital goods. So let's test your understanding. What do you think? What is the correct answer? Type your answer in the chat. Is it A, B, C or D? What do you think? This is the second question of today's session. So you can think of the trade credit like a short-term loan, right? You can think of the trade credit like a short-term loan, right? The bank give to help pay for the goods you are importing, right? It is just a type of short-term loan that bank gives to help pay for the goods you are importing. And here you can see clearly written that bank has set a maximum limit. What is the maximum limit? 50 million US dollar. This is the maximum limit of trade credit which bank has set. Now a guarantee is like an extra safety net, right? That provides assurance. So guarantee is like an extra safety net that the bank provide. It assures the seller that if something goes wrong, the seller will still be paid, right? So what is the, can you tell me what is the correct answer to this particular question? Is it A, B, C, and D? Just type your answer in the chat. How much maximum trade credit is limit is provided, and how much is the guarantee period maximum possible? So let me answer it. You know, the trade credit limit that bank can finance up to maximum $50 million, right? The maximum finance that can happen is clearly written $50 million, right? And guarantee period, you know, the bank issues and guarantee for a maximum period of 3 years. The maximum guarantee period is 3 years. So these two data you must remember. Like, so what is the correct answer? Correct answer is trade credit limit as fixed $50 million and guarantee period fixed at 3 years from shipment date. And there is no flexibility to extend this period, regardless of the additional collateral or the types of goods involved. Right. So what is the correct answer? Just tell me. Is it A, B, C, or D? So option A says that bank may extend trade credit beyond. No, this is wrong. Option B says that bank can provide trade credit up to $50 million per year per transaction, and it may issue a guarantee up to 3 years from the shipment date. Yes, correct. Option B is the correct one, right? Because both things are written here, right? The maximum period for which it can be offered, its guarantee can be offered is 3 years, and second point is how much amount? $50 million. Is it clear now? Please type clear in the chat if are able to understand the concept behind this question. Then we will move to one numerical question for today's session. If it is clear, please type clear. Yeah, okay, fine. Now let's see the next question. So the next question is regarding a numerical type question. So let me show you what is provided. And this case study is most time asked. So you can see what is happening here. Is that a textile exporter with an export order of 50,000 USD CFR, right? CFR, you know, CFR is a kind of Incoterms. So a textile exporter with an export order of 50,000 USD receive a bank sanction with various facility and sublimit. Like you can see, conversion rate on the order 1 USD is equal to 75.20, right? Insurance and freight cost 12% on the converted amount, margin on FOB value 25%, and the exporter submit document for 48,000 US dollar on 31st August 2021, drawn on a 30-day DL. DM is document against acceptance. On 31st August 2021, the acceptable exchange rate are bill buying rate is given 74.85, 4 paisa premium is added for a 30-day DA bill, and you know the post shipment advance under FBD is margin on DA bill 50%. And how to calculate NDT we have already talked about in the previous lecture. And last thing is given that interest is charged up to the effective value date of credit. Now please, I request you to please take a screenshot of this slide, because you know the question, there will be 5 questions based on this, right? We will cover 5 questions based on this data. So most of the time you will require the data from this slide. So I request you to please take a screenshot of it, right? I hope you have taken a screenshot, right? Now let me see the first question. So these are the data provided before you. Let's see the first question. The first question is, let me just zoom out a little bit. Yeah, I hope this is visible now. The exporter order is for 50,000 US dollar, given the conversion rate of 75.20, and the insurance and freight costs add up to 12% of the converted value, followed by a margin requirement of 25% of FOB value. What is the PCL amount the bank allow against this order? You know PCL, this is called pre-shipment credit. So what do you think is the correct answer here? So let me explain. Let me explain what is happening here. Right. Let me explain what is happening here. So first thing is that have you come across this term CFR or FOB? There are two terms here written. One thing is CFR. You can see written here CFR, and second thing is FOB. Right. So obviously you might have come across this term. These are called Incoterms. Right. Incoterms. Free on board, cost, freight value. So these are Incoterms. You must know it. Right. So our first step is converting the export value into INR. What is the export value here? Let us move step by step. What is the export value here written? Can you tell me the export value is how much? 50,000 US dollar. Clearly written. How much is the export value? 50,000 US dollar. So can you think, how much do you think is the 50,000 US dollar in Indian rupees? Please, I hope you have calculated with you. Please do the calculation and type in the chat. This 50,000 US dollar is equal to how much INR? First thing we have to do is to convert. We have to do all the calculation in rupees, right? So that's why we will convert this dollar into INR. So how much do you think is 50,000 US dollar in INR, in terms of INR? So it's quite simple. It is clearly written. Let me write it. It is clearly written that 1 USD is equal to 75.20. So $50,000 will be how much? So it will be nothing but 50,000 multiplied by 75.20. So how much you are getting after the calculation? Please calculate it. I am getting 3760,000. Are you getting the same? I hope you are also getting the same. 3760,000. Right. So this is the value I am getting after multiplying 50,000 with 75.20. Right. So what does it indicate? It indicates rupees. It indicates rupees. Right. It indicates that $50,000 is equivalent to this much rupees. 37,60,000. Right. So this is our starting point for the calculation. Now, first of all, we have to convert dollar into rupees. Second thing we have to do is to deduct the insurance and freight cost. Right. And what is the insurance and freight cost? The insurance and freight cost, you can see this line clearly written that insurance and freight cost is the 12% of the converted amount. Right. So how much is the 12% of 37,60,000? Any guess? Please type in the chat box how much is the 12% of 37,60,000, because we are deducting insurance and freight cost, right? These are the additional costs incurred. So how much is the 12% of 37,60,000? Please do the calculation on your own. So I'm also calculating, and what I'm getting, 12% of, that is 12 upon 100 into 37,60,000. So it comes out to be 4,51,200, isn't it? Are you getting the same? What is this? What does it represent? It represents the insurance and freight cost, right? Yes, 4,51,200. Great, nice. Right. Now the next thing is apply margin for PCL, right? After deducting insurance and freight cost, what we have to do next is to apply the margin, right? So okay, margin is how much? How much is the margin? You can see written here, margin is 25% for PCL. Currently we are talking about PCL, right? This margin is for post shipment credit, but this margin is for PCL. How much is the margin? 25%, right? So now you subtract. What you do, you subtract 3760,000 minus 4,51,200. How much you will get after subtracting? Please think, please do the calculation. 37,60,000 minus 4,51,200. So what is the value you are getting after subtraction? So I think you will get 33,08,800. Are you getting the same value? I hope you are, right? 33,08,800, right? This is the value we get after subtracting 4,51,000 from 37,60,000, right? So basically, what does this value represent? This value represent that what is the conversion value after deducting freight cost and insurance, right? 33,08,800. Now next we have to apply the margin. So what is the margin percentage? 25%. Margin percentage is 25%. So can you tell me, let me erase all this thing. I'm erasing it. Just wait a minute. So after erasing, can you tell me what is 25% of this 33,08,800? Please do the calculation. So you have to calculate 25% of 33,08,800, right? So can you tell me what is the value after calculation? Just miss 25% means 1/4, right? So I'm doing the calculation also. Please do your honor yourself. I hope you have calculator, pen and paper with you. You must have that so that you can answer easily. So I am getting 8,27,200. Are you getting the same? 8,27,200. So this is the margin amount, right? Yes, correct. Very nice. Very nice to see you are also getting the same amount. 8,27,200. Now what we have to do? We have to subtract the margin, right? We have to subtract the margin from this value, 33,08,800. So after subtraction, how much you will get? just subtract 33,08,800 minus 8,27,200. Tell me, how much are you getting after subtracting the margin? Because you know margin acts like a commission which the bank charge on this particular transaction. So this has to be subtracted. So after subtracting, I am getting 24,81,600. Tell me, are you getting the same or not? So that is the question here. The question is asking what is the PCL amount of the bank that the bank allow against this order, right? That is called pre-shipment credit. Very nice. It is 24,81,600. Very nice to see. You have answered correctly, right? So to summarize, so which is the correct option? Option number A is the correct answer, right? So to summarize, we started with the 37,60,000. We deducted 4,51,200, which was for insurance and freight, and then we applied 25% margin on the FOB value. This brought us to the final PCL allowed, which is 24,81,600. What is the PCL? PCL means what? PCL means pre-shipment credit. So bank will provide this much loan, this much credit, right, before the shipment. So tell me, do you have any question about this calculation? If you have any doubt, please drop them in the chat. I will respond. If you have not, so let's see the next question. Right. So now let's come to the next question that we have. Yes, so this is our next question, as you can see on the screen. So question says that when the exporter submit document for payment, we say tender document. Tender document means he submit the document for payment, right? For how much? When exporter submit document for payment for just wait a minute, yeah, for US dollar 48,000, right? The bank use on 31st August 2021. The bank apply an exchange rate to purchase the bill. Given that bill buying rate is 74.85 and premium of 4 paisa is added for the 30-day DA bill, what is the effective exchange rate used by the bank? So you have to calculate the effective exchange rate used by the bank, right? So basically what is happening, this exporter submit document for payment, right? The exporter submit document for payment. The bank, what the bank use something called bill buying rate, and it has been given to you, which is 74.85 rupees for $1. In this case the bill buying rate is 74.85 for $1. So what is happening here, suppose if you tender a bill for $48,000, what is the initial amount of rupees at the rate of 74.85 per dollar? Can you tell me, if you tender a bill for $48,000, what is the amount in rupees at the rate is given clearly 74.85, right? So can you tell me what will be the amount in INR? Just multiply, just do the multiplication, right? So after, basically I am calculating in INR, so it will be nothing but 48,000 multiplied by 74.85, right? So how much is the value after multiplication? How much is the value you are getting? Right, so it will give us 3592,800, right, after multiplication. But wait, the bill is drawn on 30-day DA bill. You know clearly written that the bill is drawn on 30-day DA bill. So what is the meaning of DA bill? You know about DA, right? Yes, correct. 35,92,800. Do you know what is the meaning of DA? DA bill means what? Document against acceptance, right? That is the meaning of DA bill, right? So the bank, the bill is drawn on 30-day DA basis, which means payment is due after 30 day. After 30 day, the payment will be due. And how does bank compensate for this delay? By adding premium. And what is the premium here? The premium here is 4 paisa. You can see what is the premium here? Premium is the 4 paisa. So how much is the 4 paisa in rupee term? You just divide it by 100, which is nothing but 0.04, right? So now can you tell me the final answer? Can you tell me what is the correct answer to this particular question? What will be the effective exchange rate? I have just told you the method. What is happening here, that this exporter tender document for US dollar 48,000 on 31st August 2021. Bank apply exchange rate to purchase the bill, because bank is purchasing and bank is applying bill buying rate, which is nothing but 74.85, right? And also, you know that this is a DA bill. DA bill means what? Payment is due after 30 days, not side payment. It is not side payment, it is Ujans payment, right? So bank compensate for this delay by adding a premium. So the final answer will be 74.85 plus 0.04, which will be 74.89. So which is the correct answer? So the correct answer is option number A. Option number A is the correct answer. So let us recap for this particular question what we have to do step by step. First of all, we start with the bill buying rate, right? We will start with the bill buying rate. What is bill buying rate here? The bill buying rate is 74.85, right? Then we add a premium of 0.04 paisa. So after adding a premium, we will get 74.89, which is the final exchange rate, right? So is it clear? Is it clear why we take, why we added, why we take the bill buying rate? Is it clear? If it is clear, please type clear in the chat. Yes, correct. 74.89 is the correct answer. Very nice. Very nice to see you are responding properly. Very nice, right? So is it clear now? So I hope it is clear. Now let's see the next question. The third question of this particular case study we have. Now let's see this particular case here. Let me zoom little bit so that you can see it clearly. So the question say, for an export bill of USD $48,000 tendered on 31st August 2021, the bank allow, now till now we were covering the pre-shipment credit. Now we are moving to the post-shipment advance. So for an export bill of $48,000 tendered on, yes, so bill you can see is $48,000 tendered on 31st August 21. Bank allow a post shipment advance under FBD with a margin of 15% using the effective exchange rate of 74.89. What is the amount of post shipment advance in rupees? And you can see four options you have been provided, right? So think little bit, do the calculation. I am giving you 1 minute to solve it. Please. Yeah, so let's start answering this question, how to go about solving it. So what is happening here, that exporter has submitted an export bill worth $48,000 and the bank is ready to provide a post shipment advance. यहाँ पे क्या हो रहा है कि जो एक्सपोर्टर है वो उसने एक एक्सपोर्ट बिल सबमिट किया $48,000 का और बैंक पोस्ट शिपमेंट एडवांस देने को तैयार है. But wait, bank don't just give you the entire value, right? Bank will not give you the entire value, right? So bank apply a margin deduction. In this case, margin is how much? 15% margin is there, right? So you might have heard of this term post shipment advance earlier, right? So what we need to do first, we need to convert this $48,000 into rupee. So how to convert this $48,000 into rupee? Just multiply it by the exchange rate. It will be nothing but 48,000 multiplied by 74.89. How much you are getting? Type your answer. What is the INR equivalent of this is how much? I think you are getting 35 lakh 94,720. Tell me, are you getting the same? 35 lakh 94,720. I hope you are also getting the same. So one answer I am getting is option number C, right? Okay, let's see. Now we have to apply the margin. What is the margin here? Margin is the commission, right? So we have to apply 15% margin deduction. So just find 15% of 35 lakh 94,720, right? So it will give us 15% will give us 5,39,208. It will be 5,39,208. Now what we need to do the next, we have to subtract this margin from the this value, right? So margin is to be subtracted, right? Because bank will not finance the entire amount. bank will keep some amount as commission, right? So because bank is providing advance, so this margin has to be deducted. 35 lakh 94,720 minus 5 lakh 39,208. So if you subtract this margin from it, what is the final post-shipment advance? What are you getting after subtracting? Please let me know in the chat. How much are you getting? So I am getting 30 lakh 55,512. Are you getting the same? I hope you are also getting the same, right? So what is the closest option? I think it is C. Yes, correct. Option number C is the correct answer. Very nice. Well done. Well done. You all have got it right. Very nice to see that you are also answering it correctly. So what is the what we have done here? That we converted this $48,000 to INR at the rate of 74.89, and then we deducted a 15% margin of how much? 5,39,208, and finally we get the post shipment advance, right? Okay, now let's see the next question. The next question is, this is the fourth question of this particular case study. The question says that if the exporter submit the bill on 31st August 2021 with a 30-day DA period and a transit period of 25 days, what is the notional due date of the bill? So I think we have discussed this NDD in the previous lecture. So the bill was submitted on 31st August, 30-day DA period is there, transit period is 25 days. What will be the NDD? That is notional due date. So I think you might have heard of this DA. DA means document against acceptance, right? So for those who are unfamiliar with this word DA means time the buyer get to pay after accepting the shipping document. It is just like a grace period for the payment, right? So it is just like a grace period for the payment. So can you tell me what is the correct option here, correct answer here? A, B, C, or D? What will be the NDD? Is it A, B, C, or D? Just do the calculation on your own and let me know what are you getting. So let me explain how to go about solving it problem. So what is the submission date? Submission date is 31st August, right? 31st 08. This is the submission date. Now we have to add the 30-day DA period to it. Just add 30-day DA period. So after addition 30-day DA period, how much you are getting? So so after adding 30 day to 31st August, I think you will get 30th September, right? You will get 30th September. So this is the DA due date. This is the DA due date. Now we need to add the transit period of 25 days. You can see transit period is written 25 days to the DA, right? So can you tell me what is 30th September plus 25? How much you will get? Is it closer to 20th October or 25 October? You can see the option. Is it closer to 20th October or 25 October? What do you think? What are you getting? So one answer I am getting is option C. Okay, very nice. Let's see it. So if you add 25 day to 30th September, you will get 25th October. You will get 25th October, right? So the correct answer is option number C. Very nice, right? So we can see the submission date is 31st August. DA period is 30 day. So after adding 30 day, we will come to 30th September, and the transit period is 25 day. So after adding 25 day to 30 September, which takes us to 25th October. So the notional due date is 25th October, right? Now let me ask you one question. What would the due date be if the DA period was 45 day? मान लीजिए कि डीए पीरियड 45 डे होता 30 डे की जगह, तब एनडीडी क्या होता? प्लीज टेल. Suppose DA period is 45 day, not 30 day. What would be the our NDD? Can you tell me? Yeah, obviously C is the correct answer. Very nice. Option C is the correct answer. My second question is, if instead of 30-day DA, suppose the DA period is 45 day, then what will be the what will be our NDD? Obviously, it will get extended by another 15 day, right? So just add 15 day to the 25th October. So I think you will land on 10th November, right? So I hope it is clear now how to go about finding the NDD of a bill, right? Is it clear? So sometime what will happen, that transit period may be different, sometime what will happen, DA period may be different. So I hope you can tackle such type of questions very easily, right? Now let's see the next question. So if you have any doubt regarding any step, please let me know and we are moving to the next question. The next question is, interest on the export bill discounted is charged until which of the following date? You know, you have given all the date. You have been asked that this is the fifth question of the case study, that interest on the export bill discounted is charged until which of the following date. Option A say NDD of, that is our 25th October. Option B say the value date of the credit, that is 27 October. Option C say date of realization, that is 30th October. Option D say date of credit to the Nostro account, that is 29th October. So what do you think? So I think you know about this Nostro account, right? I hope all of you know about this Nostro account. Nostro account Nostro account is a foreign currency account that a bank hold in another country, right? It is a foreign currency account that a bank hold in another country, right? So let's break down the option to understand which date is relevant for charging interest on discounted export bill. So the first option say NDD. NDD means notional due date, which is which day? Which is 25th October. So this is just an expected payment date, right? You know, this NDD is just like an expected payment date. Bank don't stop interest here because the fund is not credited yet, right? So why do you think bank need the fund to be credited before stopping interest? Can you tell me why do you think? Tell me when bank will stop deducting interest? When the entire amount is credited. So is the amount credited on NDD? Yes or no? What do you think? Has the amount been credited on the NDD? What do you think? Is the complete amount credited on the NDD, that is notional due date? Just type your thought in the chat. Is it yes or no? Obviously no, right? Obviously no, because bank need the fund to be credited before stopping the interest. Once the fund is credited, then only bank will stop the charging the interest, right? And NDD is not a date. NDD is just a, it's not a expected, just a expected payment date. So bank don't stop interest here. So that is why option A is not correct, right? Let's move to the option number B. Option number B say value date of credit, that is 27th October 2021. So what is the meaning of value date? Value date is the date when funds are effectively credited to the bank account, right? So what is the correct answer here? Please type. You should know about all these three kind of date: notional due date, value date, date of realization, right? So bank will stop charging interest at the value date because they have received the payment. Yes, B is the correct answer. Bank will stop charging interest after the value date, because the value date means when the funds are effectively credited to the bank Nostro account. And the option C say date of realization. You know what is the meaning of date of realization? Date of realization is the final clearing date, but it does not affect the interest calculation. And the option D say date of credit to the Nostro account. This is just a technical entry in the system and not the effective value date, right? So let me ask you one more question. What if the value date was 28th October? Suppose I ask you that value date is 28th October instead of 27th October. So what would happen to the interest charge? So in this case, you know that the bank will stop charging interest on 27 October. Now let me ask you, what if that the value date is 28th October? So what will happen to the interest charge? Type your answer. Suppose the value date is 20th October instead of 27th October, what would happen to the interest charge? Yes, correct. The bank would charge interest for one extra day, right? Up to the 20th October, right? So option number B is the correct answer. So you have a great participation. I hope this session make the concept of interest on export bill discounting clear, right? Is it clear now? Is the concept clear that how to deal with this 5k question? In this question, what is the beauty is that both PCL and pre-shipment credit and post-shipment credit both are included, right? In the 5 questions that we have discussed, both are included. First of all, we learned how to calculate the pre-shipment credit, then we learned how to calculate the post-shipment credit, then we learned how to calculate the NDD, that is notional due date, and then we finally see that till which time the interest will be charged. I hope the concept was clear to all of you. Now let's move to the next question, right? Remember, this case study is asked frequently, so be sure I will share the PDF in the group, so make sure that you go through this particular PDF. Now let's come to the ECB, external commercial borrowing, right? So here is the scenario. The scenario is like Global Tech Limited, right, an Indian company raised fund from an overseas lender through an external commercial borrowing. They get the required loan registration number, that is called LRN, right? They get the required LRN from the RBI, right? But due to financial constraint, you can see, but due to the financial constraint, unforeseen financial constraint, they mutually agree with the lender to reduce the repayment amount. Clearly written, they mutually agree to reduce the repayment amount, right? So now here is the question. So what is happening here? That Global Tech Limited, an Indian company, it raises fund from an overseas lender through ECB, that is external commercial borrowing. They get the required loan registration number from RBI to reduce the repayment amount. I hope you have gone through it, right? So let me show you the first question that we have. The first question is, right, so question is, what should Global Tech Limited do immediately to comply with the RBI regulation, right? So what should Global Tech company should do? Option A says, suggests that inform the RBI within 30 days of the change in the repayment term. Option B, report the change to RBI through a revised form ECB within 7 day of the change. Option C, no reporting is required as the change is mutually agreed upon. Option D, submit form ECB to return within 15 day of the change. Friend, you should know that whatever question we are discussing in this particular session have been asked in the previous year. So make sure that you have understand the basic concept behavior में आ चुका है, तो आप प्लीज इसे समझ लें. Please go through this particular question. Now let's see who answered the correct one. Tell me, what do you think? So just type your thought in the chat. Let me see who answered it correctly. So what is happening, that due to financial constraint, they mutually agree with the lender to reduce the repayment amount, right? So great participation. Let's break it down step by step. When a company raise ECB, the RBI monitor it closely to ensure compliance with international borrowing now. Now what the Global Tech Limited did, that they raised fund and got the LRN. LRN is a loan registration number, right? So that is a green signal from RBI to start using the loan. Now repayment terms change because of the financial constraint. Now does the RBI need to know? Does RBI need to know it or not? Tell me, yes or no. What do you think? The RBI want to be informed of such changes? Tell me, do you think that RBI wants to be informed for such changes, for the like the repayment term change? Type your answer, whether yes or no, whether we need to inform the RBI or not, or RBI needs to be informed regarding it. Yes, good point. Right. The RBI requires the information to maintain transparency and monitor the impact of foreign debt to the Indian economy. Yes, correct. Right. So that is why the correct answer is option number B. Right. The correct answer is option number B. Because you have to report the change to the RBI through a revised form ECB within 7 days of the change. Because why because as per RBI guideline, any change in the ECB parameter such as repayment term, it must be reported immediately through a revised form ECB, right? And in any case no later than 7 days, right? Not later than 7 days. You should remember it, not later than 7 days, right? So option number B is the correct. Now a quick question for all of you: what is the purpose of LRN? What is the purpose of loan registration number? Because from a single question we can learn multiple things. That is our purpose here, right? From this single question we can learn multiple things. Please tell me in simple term, do you know what is the purpose of LRN, that is loan registration number? So let me tell you, right? LRN help. Just type whatever you think, whatever you know in the chat. So LRN help RBI track foreign borrowing, right? RBI can track the foreign borrowing using LRN, and failing to report changes can lead to penalties, right? And And suppose one more question I'm asking you: what will happen if the global tech failed to report the change within 7 days? Suppose the global tech did not report it to the RBI within 7 days. What will happen? These two things you must know. First thing, that why LRN is required. Through LRN, the RBI can track foreign borrowing. Right? This is LRN. And what will happen if this global tech limited did not report it to RBI within the 7 days? What will happen? Obviously there will be penalty. RBI will charge penalty on that, right? So now one more question I want to ask you, that if a company agree to increase the repayment amount instead of reducing it, do they still need to file a revised form ECB? In this case, what we have seen, that they are reducing the repayment amount. Now suppose instead of reducing it, suppose the company wants to increase the repayment amount, so whether they still need to file a revised ECB? Tell me, yes or no, what do you think? Suppose instead of decreasing the repayment amount, they want to increase the repayment amount, so do they need to report to the RBI about the increment also, or not? What do you think? Just type whatever you think, yes or no, in the chat. Yes, correct. Yes, any change, whether increase or decrease, it must be reported, right? No matter whether it is increasing or it is decreasing, right? It must be reported. So here the answer is option number B. Now let's see the next question. The next question is, it is regarding the same case study which we have discussed, that the Global Tech Limited has drawn down the ECB fund after obtaining the LRN from RBI. What is the company ongoing reporting obligation to RBI? Right. So, so this is the question regarding the LRN, that many companies secure international loan to fund their project, but once the money is drawn, what happened next? You can see what is happening. The Global Tech has drawn down the ECB fund after obtaining the LRN. So they have money is drawn. What happened next? Do they sit back and enjoy the fund, or do they have compliance responsibility with the RBI? Let's discuss in the simple term, right? So the scenario is, this Global Tech Limited has successfully drawn down ECB fund after getting the loan registration number from RBI. What is the company ongoing reporting obligation to RBI? Option A suggest submit form ECB2 return annually within 30 days of the financial year end. Option B say report actual ECB transaction in form ECB2 return monthly within 7 working days from the close of the month. Option C say no further reporting is required after obtaining the LRN. Option D say submit form ECB2 return quarterly within 15 days of the quarter end. What do you think is the correct answer? A, B, C, or D? So what is happening here? Once a company like Global Tech Limited drawn ECB. So here the keyword is drawdown. You must note it. This is the keyword, right? Let me highlight it. So this is drawdown is the keyword, right? So once a company draw down ECB fund, the RBI does not just forget about it. RBI want to monitor how the fund are being utilized and ensure that everything is in line with the regulation. Why do you think that RBI needs regular report about ECB transaction? Why does RBI needs regular report regarding the ECB transaction? The answer is quite clear. The answer is transparency, right? The answer is transparency. For transparency, RBI does so, right? For transparency, RBI does so, right? Monitoring foreign debt and making sure that economy stays stable. So what is the correct answer here? The correct answer here is option number B, right? The correct answer here is option number B. That is, report actual ECB transaction in the form ECB2 return monthly within 7 working days from the close of the month, right? Because borrower are required to report every transaction related to the ECB, such as interest payment, principal repayment, outstanding amount, everything. Borrower are required to report every transaction, and these report must be submitted through the company AD category 1 bank. This borrower who they will contact the AD category 1 bank, right? And through the AD category 1 bank, these reports has to be submitted to RBI, right? Now some quick question for you. What form does Global Tech Limited need to submit for ECB reporting? Tell me, what is the name of form? Please write in the chat, which form does Global Tech Limited need to submit for ECB reporting? This question was asked. previously, that what is the name of the form which global tech which company need to submit for this report? The answer is clearly written in the question itself. It is ECB2, right? Answer is ECB2. This ECB2 form, you must know it. ECB2 form, right? The company needs to, right? The Global Tech Limited needs to submit for ECB reporting. Second question: through which bank category should they submit this form? So, through which bank should they submit this ECB2 form? The answer is AD category 1 bank, right? And how many days do they have to submit the report after the month end? How many days are there to submit the report? Please type answer in the chat. What do you think? Yes. What is the answer? How many days are given to them to submit the report after the month end? It is 7. Very good. It is 7. Fantastic. The form is ECB2. It is submitted through the AD category 1 bank, and it must be submitted within 7 working days. So what we have learned in this question is that if a company has drawdown ECB fund, regular monthly reporting form ECB2 is mandatory. Make sure you don't miss the 7 working day deadline, right? Now, before we conclude this question, let me ask you, there's a final question. What could happen if Global Tech Limited failed to submit form ECB2 on time? What will happen if this Global Tech Limited some forgot to, or did not submitted form ECB2 on time? So obviously this delay will cause the penalty or compliance issue with the RBI, right? So this is what we have to know, right? The deadline you should know. Now let's see the next question. So this is the next question. As you can see, this Tech Grow Private Limited, an Indian company, has raised ECB from international lender to finance its new manufacturing facility, right? So they got their loan registration number, which we call LRN, from the RBI, right? From the RBI they got LRN, but forget to report their actual ECB transaction for the first 3 months. Clearly written. So they got LRM, but the company forget, you can see, due to oversight, Tech Grow Private Limited failed to report its actual ECB return for the first 3 months in the form ECB2. So they have not reported it. They failed to report it. So this is the scenario, right? Now they are worried about what to do next. So I hope the scenario is clear to you. What is happening here? What has happened here? Right. The scenario is quite clear that they have obtained the LRN, right? But after submitting form ECB2 through its AD category 1 bank, right? Earlier they have submitted, but they have not submitted the form ECB2 for the first 3 months. Now let's see the question. The question is, what is the company base course of action to regularize the delay? So if you were managing this company compliance, what would you do to regularize this delay? Some options are there. Wait for the RBI to issue a notice and then respond within the required detail. Option B, pay late submission fee for the period of delay and submit the overdue ECB2 return. Option C, ignore the delay since the company has already obtained the LRN. Option D, submit the overdue ECB2 return without paying any fee. What do you think is correct? Drop your answer in the chat. Is it A, B, C, or D? Obviously B. Yeah, I'm getting one answer. It is B. So fantastic response. When a company delays reporting its ECB transaction, it is not something the RBI overlook. They expect timely and accurate submission to monitor foreign debt. But here is the good news. The RBI provide a way to fix it. The correct answer is option number B. If Take Growth Private Limited want to stay compliant and avoid penalty, they need to submit something called LSF. What is LSF? Late submission fee, right? So, and can you tell me, can anyone guess how much is the late submission fee might be? How much it might be? In which range it can be? The late submission fee? Is it in thousand or hundred or lakh? What do you think? Per year. I'm talking about per year. How much is the late submission fee can be in amount? So let me tell you, the amount can vary from 5,000 to 1 lakh per year. So the amount can vary in this range, 5,000 to 1 lakh, depending on how long the delay is. If the delay is larger, obviously the penalty will be larger. Late submission fee will be larger, right? Right. So, so what is that? So these are the common pitfall that you should always, obviously for ECB, what they should do, they should always track reporting deadline to avoid any delay, and the AD category 1 bank can guide the firm, right, regarding submission and compliance, right? So this is what we have learned from this particular question. Now let's see the next question. This was quite easy question. Now let's see. Take Growth Private Limited has obtained the LRN from RBI and is now ready to draw down the ECB fund. What is the critical compliance requirement before drawing down the fund? So this is a good question, right? Take Growth Limited has obtained the LRN from RBI. Now they are all set to draw down the ECB fund from their international lender. But wait, what is the most critical compliance requirement before drawing down the fund? Option A, submit form ECB2 return for the previous financial year. Option B, ensure that the drawdown happened only after obtaining LRN from the RBI. Option C, obtain approval from the overseas lender for the drawdown. Option D, wait for 30 days after submitting form ECB to the 80 category 1 bank. So before drawing down the fund, what is the critical compliance requirement? You know, this drawing down was asked previous year. That is why I am focusing more on this term drawing down. What do you think? Is it A, B, C, and D? You know, LRN is the loan registration number. It is just like a tracking number. It is a tracking number for your borrowing. It is how the RBI keep track of foreign borrowing and ensure that everything stays transparent. Right. So what do you think is the correct answer? A, B, C, and D. So let me tell you that RBI always mandate getting LRN before drawing down the fund. Right. Without the LRN, it is like starting a journey without registering your vehicle. Right. You are bound to run into trouble. Yeah. So what do you think is the correct answer to this particular question? LRN is so important, right? So the correct answer is option number B. Ensure that the drawdown happened only after obtaining LRN from the RBI. Right. So RBI don't just stop at issuing the LRN. Besides issuing LRN, RBI monitor how the fund are used and it requires regular reporting. Can you tell me the name of form using which after LRN regular reporting is done? Just name the form. I have just discussed in the previously. Right. What is the name of the form? So first of all, they have to obtain the LRN and then only they can draw down. The company can draw down, right? So what is the name of the form? Let me know. The form is called ECB2, right? Through which regular reporting is done, right? That is called form ECB2 return. And can you tell me that how frequently company need to submit form ECB2 return? How frequently? Just I'm revising. Yes, correct. ECB2 is the correct. And the next question is how frequently does the company needs to submit this ECB2 return? Is it monthly, quarterly, or yearly? Tell me how frequently the company needs to submit the form ECB2, monthly, quarterly, or yearly? The correct answer is monthly. Yes, after every month within 7 working days. You should know the 7 working day. So here is a quick recap. This Take Group Private Limited must ensure that they obtain the LRN before drawing down the fund. LRN is essential for RBI tracking and compliance, right? So this is the point which you have learned now. Now let's see the next question. So these three questions deals with the same thing. I hope it is clear. Now let's see this question. What is asking here that XYZ Limited, an Indian fintech startup, is in talk with a Singapore-based venture capital firm for equity investment. Their company CFO is evaluating compliance requirement under Indian foreign investment regulation. During an internal discussion, concern arise about regulatory approval, valuation norms, and reporting obligation. So basically, what is happening that XYZ Limited, which is an Indian fintech started firm, is in talk with a Singapore-based venture capital firm for equity investment. Right. So now let's see the question. The question is, just wait a minute. Let me enlarge it so that you can view it clearly. Now you can see XYZ Limited is receiving foreign equity investment. Which of the following regulatory body will play a role in governing this transaction? So here are your options. Option A say Department of Economic Affairs, Ministry of Finance for notifying the NDI rule. NDI means non-debt instrument rule. Option B say Reserve Bank of India for valuation and reporting compliance. Option C relevant government ministry for approval if required. DPIIT under Ministry of Commerce for formulating the FDI policy. And option E say all of the above. What do you think is the correct answer? Basically, which regulatory body play a role in governing this transaction? That is what is happening. On the left side, you can see the name of 4 governing body. And on the right side, you can see what are the things done by it. So what do you think is the correct one? A, B, C, D, or E? Great. everyone so far. Let's break down each option in simple language. Let's see the first option we have. The first option is regarding the DEA. This DEA is responsible for notifying the NDI rule. NDI rule. So these rules govern the condition under which non-debt instrument, like, can you name one non-debt instrument? Can you provide the name of one non-debt instrument? Like, equity. Equity investment is a non-debt instrument, right? So these rules govern the condition under which equity investment can be raised, right? Option B is regarding the RBI. You know that RBI monitor valuation and reporting compliance, right? When a company receives foreign equity, RBI makes sure that valuation of the investment is fair and the company report all the transaction as per regulation. Just now we have seen in the previously. Option C suggests relevant government ministry, right? Various government ministry may need to approve the transaction if required by the law. And option D say DPIIT under Ministry of Commerce. The Department for Promotion of Industries and International Trade. This is the full form of DPIIT. Again, I am repeating, Department for Promotion of Industries and Internal Trade. So this DPIIT formulate the foreign direct investment policy. It formulate the FDI policy, right? So the FDI policy set the guideline under which foreign investment are allowed, right? So, do you think that every aspect of foreign equity investment is monitored by just one regulatory body? Type yes or no. Is every aspect of a foreign equity investment is monitored by just one regulatory body? What do you think? Is every aspect of a foreign equity investment monitored by just one regulatory body? The answer is no. It is a coordinated effort by several body. So when put all together, the correct answer is option number E. Very nice, right? So let me summarize the fact. You must know it because sometimes the question will be asked that who governed the NDI rule? Yes, correct. Obviously correct. So who governed the NDI rule? Who governs everything? So you must know. Again, I am just revising it. Let me revise. So this DEA deals with NDI rule, right? RBI handles valuation and reporting, relevant government ministry approval, and DPIIT sets the overall FDI policy, right? So I hope it is clear. So it is important to remember that foreign equity investment are closely monitored by multiple regulators. There are multiple regulators who closely monitor the foreign equity investment. That is what you should know it. Now let's see one next question. This is a very nice question. Let's understand it. So question says that imagine you are with the Global Export Limited. I hope you are able to see the question clearly. Imagine you are with the Global Export Limited. This is an Indian company. This is an Indian company that export goods globally, right? They rely on ECGC for insurance against trade credit. So this is a company, this is an Indian company that export goods globally, and this company rely on ECGC, that is Export Credit Guarantee Corporation, right? For what? For insurance against trade risk. Now, ECGC classify country into different category, risking from A1 to D. A1 means very low risk and D means very high risk. And this classification help exporter decide where to expand their operation. And today we have to consider country X. You can see here. Just wait a minute. Let me show you the question. Yeah. So here is the question. Here is the question. So Global Export Limited is planning to export goods to country X. Country X is what? Country X is classified as B1. Okay. And country Y is classified as C1. Okay. The question is based on ECGC risk classification, which of the following statement is most accurate? So option A say that country X is in the open cover category and country Y is in the restricted cover group 1, right? It means country X is considered less risky than country Y. Option B, both country X and country Y are in open cover category, but country X is riskier than country Y. Option C say country X is in restricted cover group 1 and country Y is in restricted cover group 2. And option D say both X and Y are restricted cover group 1. So what do you think is the correct answer here? So this question is related to the ECGC risk classification. Have you gone it before? I hope you might have gone it through ECGC risk classification. If you know it, then only you can answer it correctly, right? So basically, there are two categories. Let me tell you, one category is called open cover category, and other category is called restricted cover category, right? Open cover category. Do you know that which countries are included in open cover category? Which country are included in open cover category? It is from A1 to B2, right? You must know it. A1 to B2 open cover category, and restricted cover category, which includes C1 to C2, right? So basically, A1 to B2 are the countries are considered low risk because they have a strong economic and political environment. Open cover category means the risk is very low. Why? Because they have a strong economic and political environment. And restricted cover category, the country are seen as riskier. They are high risk because there is a high chance of trade or payment issue. Now please answer it. I have given you sufficient hint now. You can clearly see everything is written in the question that country X is B1, country Y is C1. Now tell me which one is open category and which one is restricted category. I have given you the hint. Just answer now. Tell me whether X is in open cover category or restricted cover category. First question. Whether country X is in open cover category or restricted cover category. Based on the discussion, so you can clearly see that this country X is classified as B1, right? B1. And we know now please tell me whether it is open cover or restricted cover. So we know that open cover category vary from A1 to B2, and B1 fall between these range. B1 fall in this range, right? B1 fall in this range. So that is why country X belong to the open cover category. What about the country Y? What about country Y? Country Y is classified as C1, right? And you know this C1 is belongs to the range C1 to C2, right? So C1 is this range C1 to C2, which is in restricted cover category, right? So can you tell me which is less risky, whether X or Y? Please type in the chat. What do you think? Whether X is less risky or Y is less risky? You should know this category. There are 7 category: A1, A2, B1, B2, C1, C2. Which is less risky? X is less risky than Y or not? Which country do you think is less risky? See, country X is less risky, right? Country X is less risky. Why? Because you can clearly see that country X is classified as B1, which is moderately low risk, and country Y is categorized as C1, which means moderately high risk. So country X is less risky, right? Now let's revisit our option. Option A say that country X is in open cover category, country Y is restricted cover category, meaning country X is less risky, right? Yes, correct. The correct answer is option number A. This is the correct one. Other option, what it does, that other option mixes it. Please tell me, is it clear to everyone why country X is less risky than country Y? Type yes or no in the chat. If it is clear, type yes. And if it is not clear, type no. So also tell me, why do you think a company might choose to enter a lower risk market first? Why will a country, I hope it is clear, yeah, why will a company enter a lower risk market? What is the reason? Why will a company enter a low risk market first? Because company often target lower risk market to build confidence, right, and secure reliable revenue. So what we learned from this question is that ECGC classify country to help exporter assess the risk. And here you can see country X is classified as B1 and country Y is classified as C1. So the correct answer to our question is option number A. I hope this make your concept clear. Let's see the next question. The next question is based on the same concept which we have discussed. Imagine you are running a company whose name is Global Exporter Limited and want to expand your operation, right? You want to expand your operation. But guess what? One of your target country Z, is classified as very high risk, that is D, by ECGC, right? What should you do? How do you protect your business while still exploring opportunity? So the scenario is country Z is classified as D, very high risk, by ECGC. Okay. So Global Exporter Limited is concerned about the potential challenge of doing business in such a risky environment. So what should the company do to protect itself while exploring this market? This is the question. Which of the following action would be the most appropriate for the company to mitigate the risk associated with exporting to country Z? Option A say that avoid exporting to country Z altogether. Option B say seek comprehensive insurance coverage from ECGC and negotiate secure payment terms. Option C say export to country Z without any additional risk mitigant measure. Option D say export to country Z but limit the volume of goods to minimize potential loss. So have you ever heard of the business facing payment issue from international buyer? I hope you must have, right? High risk country often come with challenges like delayed payment or political instability, right? So what do you think is the correct answer here? So one answer I'm getting is option number D. Okay, very nice, great participation. Let's see the correct answer. Let me explain it. You know that here the keyword is very high risk. This is the keyword, very high risk. So this is called restricted cover category group 2. Under the restricted cover category we have group 1 and group 2. So this belongs to the group 2. These country are those where the risk of not getting paid or facing trade related problem is very high, right? Now let's dive into option one by one. Option A says that avoid exporting altogether. This is the safe choice, but also it means losing potential market opportunity. What do you think? Should business completely avoid risky market, or should they try to manage the risk? Type your thought in the chat. Should business completely avoid the risky market, or should they try to manage? Type manage if you think they should manage, or type avoid if you think they should avoid. Obviously, avoiding risk is the one way, but business thrive by taking calculated risk. They should take the calculated risk, right? They should not avoid it. They should take the risk. Option B says that seek comprehensive insurance coverage and negotiate secure payment. This is the practical approach. ECGC provide insurance that cover exporter against non-payment risk. You know about non-payment risk? So ECGC provide what? Insurance. So what they do, they secure payment terms like advance payment or letter of credit, which further protect the company, right? So letter of credit, you have heard of this LC, right? So this LC are issued by bank and ensure payment if conditions are met. Option C says that export to country jet without any additional risk mitigant measure. This is not advisable, right? Option A is wrong, option C is wrong, because C is not advisable, because business should never ignore risk assessment. And option D say that export but limit the volume of good. This might minimize loss, but it does not fully protect the business. So D is not the answer. Correct answer is option number B. Right. Seek comprehensive insurance coverage and negotiate secure payment term. Right. So option number B is the correct answer, right? Yes, correct. So why is this B important? Because high risk market can be profitable but unpredictable, right? Insurance and secure payment terms acts like a safety. They allow company like Global Industry Limited, global exporter, to explore opportunity without worrying too much about losses. So to wrap it up, high risk market, just like D, just those classified as D by ECGC, it required a smart risk management. Seeking insurance from ECGC and negotiating secure payment terms is the best approach. We should not avoid the opportunity, just manage the risk wisely. I hope it is clear now. Right? Let's see the next question. So the next question you have on your screen, as you can see, imagine you are an exporter in India. Right? Let me zoom a little bit so that it become more visible to you. Yeah. So you are an exporter in India, right? And you have signed a deal to sell medical equipment to a foreign buyer. So you are selling medical equipment to a overseas buyer or foreign buyer. Everything is going well. You have produced the goods and ready to ship, but suddenly the buyer country changed its import rule. Everything is going good. Buyer country announced import restriction, right? That means and cancel their import license, invalidate the import license. Now your buyer tell you that they can't take the good. Your buyer tell you that they no longer accept the good, right? You are stuck with losses. Now here is the big question: which ECGC policy will cover the loss? So I hope you have understood the scenario, what is happening here. That let me again rephrase. You are an exporter in India. You have signed a deal to sell medical equipment to a foreign buyer. Everything is going well. You have produced the goods and that is ready to ship. But suddenly the buyer country changes its import rule and cancel their import license. Now your buyer tell you that I can't take the good. You are stuck with the loss. So which ECGC policy will cover this loss? Option A say shipment policy. Option B say contract policy under political risk. Option C say contract comprehensive risk policy. Option D say shipment political risk policy. Type your answer. I will wait for a few seconds before revealing the correct answer. Just make a guess, right? What do you think is the correct here? Just make a guess. Suppose this question appear before you in the examination, what will you answer? Just make a guess. Okay, fine. So let me ask you a few questions. What if the goods were already shipped and then the government blocked them from entering the country. See, this situation fall under political risk, because because of a country restriction this situation is occurring, right? So it's fall under the political risk, because the loss happened due to sudden decision by the buyer government, something beyond the buyer's control. And this, tell me whether it happened before the shipment or after shipment. Tell me whether this particular risk has arisen before shipment or after shipment. Tell me please, these words are important, because if you will not identify this word, you will not be able to solve such question. Two things is important. First thing is that, yes, it before the shipment or after the shipment. Tell me. Obviously clearly written it is before the shipment, so you should know how to go about solving such problem, right? Clearly written before the buyer country shipped it, when it was preparing to ship, right? It was happening. So this policy so the issue happened before shipment. So the right policy is contract political risk policy, because that it protect exporter from risk that arise after signing the contract, but before goods are shipped. So suppose contract is signed here. Suppose today is 5th February. So on 5th February contract is signed, right? And suppose that shipment was done on 10th February, and suppose that on 8th February the buyer country decide that I will cancel all import license of the buyer. So in this particular case, since it has not been shipped yet, the contract has been, sorry, this license has been cancelled before the shipment date. So that is why the appropriate answer will be option number B, that is contract policy. Let me ask you a quick question. What if the goods were already shipped and then the government blocked them from entering the country? Would it still be covered under the contract policy, or would it require a different policy? See, I am not just telling you answer to this question. I am telling you the main concept which you must remember. My question is, what happened if the goods were already shipped? Suppose now it is 10 February. 10 February I have shipped the goods, and today suppose 12 February is here. What would happen on 12th February? Whether this contract's political risk policy, if this risk will be covered under it, or it will require a different policy. Tell me. Because one from a single question you can learn many things, right? That is our main thing, right? Suppose the goods has been shipped, and then the government decide to impose the contract. Yes, correct, very nice, very nice. Then it would be shipment political risk, because the contract has been, the goods has been shipped, right? So we might be wondering why this policy matter. Well, in international trade, exporter face many uncertainty, payment default, government restriction, and even wars can happen. So ECGC help exporter by providing coverage. Now, so can you tell me what are the other kinds of political risks that ECGC can cover? So one example I have seen. So can you tell me what are the other kind of political risks that ECGC cover? So to name a few, I am naming it. Like you can see that war is also type of risk. Political violence, foreign exchange restriction, confiscation of goods by government. So these are the kind of risks. So to summarize today's discussion, to summarize this particular question, what we have learned is that ECGC offer different policy to protect exporter, right? ECGC offer different policy to protect the exporter. But you must remember that suppose this is the shipment, right? So if this issue occur before the shipment, then contract political risk policy is the best choice for sudden government action. And if this issue after the shipment, means goods are already shipped, then shipment based policy will provide coverage. That means shipment political risk policy will provide the coverage. I hope this make your concept clear, right? If you have any question, please drop them in the chat. Now let's see the next scenario. The next scenario you have in you can see, let me zoom out a little bit. So this is the scenario before you. ABC Limited, an exporter from India, ships goods to the global trade, an agent based in Germany. Global trade jobs is to receive, store and sell. You can see receiving, storing and selling the goods, right, on the behalf of ABC Limited for a commission. Sounds like a regular business deal, right? But here is the twist. ABC Limited later find out that Global Trade is actually their own subsidiary, not an independent company. Later it found that this Global Trade is a subsidiary of ABC, not an independent legal company. So this is the twist which comes into the picture, right? I hope you have understood. So ABC Limited is exporter. He shipped a consignment of goods to the Global Trade, which is an overseas trade based in Germany. right? So global trade will receive, store and sell the goods on the behalf of ABC Limited, but later it discovered that global trade is a subsidiary of ABC Limited. I hope you have seen it. Now here is the big question. The question is that under Consignment Export Stock Holding Agency policy, which statement is correct? Option A, the policy covered the shipment because the global trade fulfilled all the operational responsibility. Option B, the policy covered the shipment as long as the goods are sold on ABC Limited behalf. Option C, the policy does not cover the shipment because the global trade is not an independent legal entity. Option D, the policy does not cover the shipment due to the commission based agreement. Very nice question. If you have understood this, if you know this commission export policy, you might have answered it. Just type your answer in the chat. So what do you think is the correct here? Yes. So the correct answer is option number C. No, it is C. Option number C is the correct answer. Under the consignment export stock holding agent policy, the overseas agent must be an independent legal entity. This is a very important thing. The overseas agent must be independent legal entity. This is super important because ECGC need to make sure the agent is not directly controlled by the exporter, which could lead to biased business practice, right? It could lead to biased business practice, right? You should know it. And in this particular case, this global trade private limited, this global trade private limited is a subsidiary of ABC Limited, so it is not truly independent. That is why the policy won't cover this shipment, even though the operational risk was done properly, operational work was done properly, right? So now tell me, what is the most important requirement for an overseas agent to be covered under consignment export policy? What is the most important requirement? Just I have told you what is the most important requirement. So the most important requirement is that independence. You must read this word independence carefully. So this word independence is the key, right? They must be independent legal entity. They should not be subsidiary, right? Think of it like this. Think of it like this. Imagine you are running a business in India. Listen to me carefully. Imagine you are running a business in India and you send product to your cousin company in Germany. Even if their company is registered separately, if it is technically controlled by your family, it is not independent. ECGC want to avoid such conflict of interest situation. This is a conflict of interest situation because that particular country in Germany is your cousin country, right? Is your cousin company. So there is a conflict of interest issue which may arise. So ECGC wants to avoid such conflict of interest situation. That is why they don't cover such arrangement, right? Now let me ask you one more question. Listen to me carefully. If ABC Limited had sent the good to a completely independent German company, but that company refused to pay after selling the goods, would the policy cover the loss? Let me ask you. Let me check whether you know this concept or not. My question is that ABC Limited had sent the good to a completely independent company, right? Not their subsidiary. But that company refused to pay after selling the goods. That company had sold the goods, right? Because the responsibility was what? They will accept, they will receive, they will store, and they will sell. That particular company has sold the good. But will the policy cover the loss? Yes or no? Type your answer in the chat. Whether this policy cover the loss. What do you think? Have you understood what I'm telling you? My question is that suppose the particular global trade company is not is an independent company. There is nothing, no correlation, right? And the global trade company received the goods, stored it, and sold it, but it refused to make the payment to ABC. Then in that particular case, whether ECGC this policy cover the loss or not? The correct answer is yes, right? It will cover the loss because as long as the agent is independent, ECGC can cover the payment risk, right? As long as this is an independent entity, yes, it will cover. Obviously, it will cover, right? As long as agent is independent, ECGC can cover the payment risk. So what we have learned? We have learned is that under consignment export policy, the agent must be an independent legal entity. Subsidiary of the exporter are not covered, right? That is the point. Now, this is the last question of today's session. Let's see the last question. This is another policy, I think. So here you can see the question is Imagine this situation: Bank Alpha, which deals with the foreign exchange, gives post-shipment advance to two clients. So two clients are there to whom this bank give post-shipment advance. One is the exporter A, which is ECGC policy holder. Another client is the exporter B, which is not an ECGC policy holder. Both get advance against their export document following RBI guideline. Later, both face financial trouble. Both banks face financial trouble and they defaulted on payment. But here is the twist. Bank Alpha had insurance under WTPS policy, right? So let me show you what is happening. Is it clear? So there are two exporter. Exporter A is ECGC policy holder, right? Now, an exporter B is not an ECGC policy holder, and this Bank Alpha has extended post shipment advance to both this client, right? What happened later that both the exporter A and B faces financial trouble and default on payment. But what happened here? Let's see. This Bank Alpha has ensured it post shipment advance under the WTPS policy, right? WTPS policy, and the coverage depends on whether the exporter is an ECGC policy holder or not. Now, considering the difference in ECGC status, which statement is true? Let's see the option, right? So basically, what option A say that exporter A being an ECEC policy holder is covered for the loss up to 95%, while exporter B, a non-policy holder, is covered up to loss up to 75%. Option B, both A and B receive a uniform coverage of 90% on the post-shipment advance, regardless of their ECEC policyholder status. Option C, if the advance are against export bill drawn on associate of exporter A, the coverage reduced to 50%, and for associate of B, it reduced to 60%. Option D, the premium for the WTPS insurance is borne by the exporter client, and their ECGC status has no impact on the coverage percentage. So, what do you think will happen in this case? So exporter A ECEC policy holder, exporter B is not ECEC policy holder. If you know this WTPS policy, then you can answer it clearly, right? Well done, well done. Those who have picked option A, they are absolutely correct, right? So simple breakdown, you must know it that this exporter A, which is ECEC policy holder, they will get coverage up to 95%. And exporter B, which is a non-policy holder, they will get coverage up to 75%. Why? Because this WTPS policy reward exporter who already have ECGC coverage. It is like getting extra protection for being proactive. This exact percentage depends on the claim premium ratio. You must know it. Claim premium ratio. The exact percentage depends on claim premium ratio. It is a kind of bonus for having a good track record. And for non-policy holder, ECGC see it at higher risk, so the coverage is lower. Almost it is, it is 50 to 75% for non-policy holder, right? So, why does the ECGC offer higher coverage to policy holder? What do you think? Whether it is because they export more good or whether it is because they already share the risk with ECGC. What do you think? Yes, correct answer is because they already share the risk with ECGC. Think of it like car insurance. If you already have car insurance and you follow the traffic rule, you might get discount or extra coverage from another insurer. But if you have no insurance history, the new insurer will charge you more because you are a higher risk. So ECGC work the same way with the exporter, right? Now one question I want to ask you: what if Bank Alpha give advance against bill drawn on associate of exporter A? Let me ask you one question: what if Bank Alpha gave advance against bill drawn on associate? This is the key point: bill drawn on associate of exporter A. Like, when I say export associate of exporter A, it just means subsidiary, right? Like their own subsidiary abroad. What percentage cover would ECEC provide? Suppose this Bank Alpha gave advance against bill drawn on associate. What percentage coverage would ECGC provide? Option A 95%, option B 75%, option C 60%, option D 50%. What do you think? Instead of this directly providing post shipment advance to exporter A, Bank Alpha is providing advance to the subsidiary of exporter A. Then in that particular case, how much percentage coverage would ECEC provide? Tell me whether it will reduce the coverage or increase the coverage as compared to this one. Suppose the two cases are there. One is the A exporter A, and the other case is subsidiary of exporter A. So will it reduce or will it increase? Obviously it will reduce. The correct answer is 60%. Correct answer is option number C, 60%. You know, when dealing with associate, ECGC reduces the coverage because the risk of friendly default is higher. What is the risk of friendly default? You know, the risk of friendly default is higher, right? So what we have learned in this particular question? So we have learned that ECGC policyholder gets a high coverage up to 95% coverage. Non-policyholder gets a low coverage up to 75%. And for bill drawn on associate or policyholder, coverage reduced to 60% for policyholder and 50% for non-policyholder. And bank pay the WTPS premium. The WTPS premium is paid by the bank, not the exporter. So friends, this was today's session. If you find the session helpful, please type helpful in the chat box if your concept is clear now. And we will cover there is more question to this particular PDF. I will share the PDF and there's more question and I will cover the next question in the upcoming session, right? I will share the timing of the upcoming session. So I hope you have covered many. I hope it was helpful, right? Okay, very nice. Very nice to see you are getting conceptual clarity bit by bit. We are covering every unit. We are left nothing. So make sure that whatever question we are covering, you revise all of them because they have been asked in the previous year. Yeah, they're super important from examination point of view. So that is how. So let's end our today's session. Good night. Thank you.